when putting together our business. But it is not the main focus, and this is where you want to know why 98% of traders fail, or 95 or 90, or whatever you want the number to be, whatever you say the number is, okay? If you want to know what to do, look at what 80 to 90% of the market is doing, and then do the opposite of that. How many people have been sucked in by the new Bitcoin craze or the new binary options craze? Anybody been researching that, been looking at that and saying, oh yeah, maybe I'll sit in on a little sales pitch on that so I can hear a little bit about it, right? It's the constant search for the new, for the interesting. Oh, I want to learn about this. Let me go check that out. Oh, there's a new way to trade. Maybe that's the way that's going to fix my problems. This is the same basic concept, is that we have a natural inclination to move away from what we're currently doing into something else and to constantly be on the lookout for the next shiny object. But here's the deal. Your trading system should have a positive expectancy. And that is the only critical piece of the puzzle. So it doesn't matter whether your trading system is a little bit profitable or super profitable. For our purposes, the only thing we're looking at for is a positive expectancy. Now, I'm going to admit to you guys, there's no sense in trying to say that if you have a system that does basically a little bit better than break even, that is not going to perform as well as one that produces a 300% yearly return. No matter what money management we apply to that, it's going to be tough to make those two systems equal out. But most traders spend far too much time jumping ship from a system that makes or promises to make a few extra percentage points. So what we're really looking for is we see, oh, that system's 80% accurate, or that one's 70% accurate. We're jumping system from one to another, or this one creates this one has less losing trades, or this one lets me trade in 3 or 4 different markets. You know, all these different things. We end up jumping around from system to system, and I see this from guys even who have been through our programs, who, when we put out new trading systems or we do new products here, is they end up calling us up on the phone and saying, hey, you know, I'm thinking about buying this, you know, what do you think I should do? And the conversation we always have is okay, how is your current trading going? You know, whatever you came in doing, how is that going? If you're going to change strategies, why? Is there a specific reason for that, or is it just the fact that, hey, I haven't followed the rules on the strategy I'm using now, so now I'm going to transfer over and I'm going to buy something else? And we tend to dissuade people from doing that. I don't want you. I'm not going to tell you how to spend your money, but if you ask me, I'm going to tell you, hey, if you're not focusing on what you're doing now correctly, there's no reason to change strategies into something else. Trust me, I don't need your money that bad. I don't want to put you into a position where you're just going to make the same mistakes again. Let's focus on what you're not doing right. Maybe what you should be doing is going to BJ Nash and having a course on trading psychology. Maybe you should be running through one of those programs that he puts together, you know, so that you can focus on that aspect of your trading rather than just buying another system. Okay, but your goal should be to find a system with a positive expectancy and then add money management to the strategy. So the question may be, what is positive expectancy? Well, I wrote, refill your coffee cups, people, because we got to do some math. And as much as I would like to avoid doing math, because I don't particularly like doing math, it's, when we talk about money management, there's no way around it. But what I am going to do is try and make this simple enough that even a knucklehead like me can figure it out, because I did the PowerPoint presentation, so it's got to be easy. So positive expectancy is defined as a mathematically proven probability that a trader will end up with profits, not loss. Now, how much profit? I have no idea. Depends on what the expectancy of the model is. But when you have positive expectancy, you have a mathematically proven probability that if you do the same thing over and over again, you will have a profit rather than a loss at a given period of time. Everybody got it? Now that equation is expressed like this: 1 plus WL times P minus 1. And while that might seem a little crazy, we're going to go ahead and break down the numbers, and I'm going to simplify it for you by adding in some actual digits. So let's take a look. Let's throw some numbers at it and make it make a little more sense. So the first thing we're going to look at is this WL, and the WL stands for win-loss. So what is your average win and your average loss? So let's throw a couple of numbers in there. Let's say that our average win is about $535, right? Maybe, let's say we either got a big account or we're swing trading or we're position trading, and yeah, we got a pretty good system here. When we win about 535 bucks. Pretty good. Nice little profit there. And then our average loss is going to be somewhere around $310. So right off the bat, we got a pretty good system, right? We got the start. We're making good profit when we win. Our profits significantly outpace our losers. And we've got the start of a really nice system. We're winning more than we're losing. Okay, that's a good sign. We're on the right track. Now, we take that $535 and we're going to divide it by $310. Okay, what we get is 1.72. 535 divided by 310 is 1.72. Then we're going to take that 1.72 and we're going to add 1 to it, giving us 2.72. Now, the P in the equation stands for probability. What percentage of the time are we correct? So we're winning $535 and losing $310 every time we right, every time we're wrong. Now here's a question: how often are we right? So what are the two things I always tell you need to know? What are the two questions you ask yourself when looking at a trading system? How much do I make when I win? How much do I make when I'm right? How much do I lose when I'm wrong? How often am I right? Correct? This is something that I've talked about for years. If you've been following me for any length of time, this is what we discuss. How much money do I make when I'm right? How much do I lose when I'm wrong? And how many times, or how often am I right? Now, why do I tell you to do that? Because that's how we determine expectancy. So for P here, we're going to have to make a determination. So let's say that we're about 58% profitable. Okay, that's pretty good, right? We're winning $535 every time we're right. We're losing $310 every time we're wrong, and we're right about 60% of the time. This is an example of the type of trading system that we want to look for. This type of system will crush the market, especially after you put money management on top of it. But in this particular case, 58% profitable. This is a great system. This is exactly what we want to see. So we take 2.72 and we multiply it times 0.58. That's going to give us 1.577, and then we're going to subtract 1. That gives us 0.58. A positive 0.58. Now, does everyone understand what I just did? Are there any questions on that? This is going to be important. You guys are sharp cookies, but I know we have some people who some ESL students. English is not their first language, and I want to make sure that the math challenged in the room understand what we're talking about here. If you don't, then when your recording comes out, rewind it, watch it again, watch it 15 times until you figure out what it is that we're doing here. The math is very, very simple. If you've been to high school, you should be able to do this. So now we have a system that is 0.58% profitable. The outcome of this equation must be greater than 0. The greater the number, the better the system. If the number is less than 0, then you have a losing system. Before you can apply any money management strategy, your system must first produce a positive expectancy above 0. Now, the question becomes, how far above 0 is a good strategy? Yes, that's a fair question. I don't know the answer to that question. It's going to depend entirely upon your risk management, or what you're willing to risk, your risk tolerance. Okay, so some of you may be willing to trade a specific strategy if it has a very narrow expectancy, and you're saying, look, I don't have a point, a 0.58 probability. I've only got a 0.35, but I've got a positive expectancy. I'm extremely disciplined. I know my numbers. I know this thing is solid, and I'm going to go ahead and trade it. Some of you may say, hey, 0.58, that's not good enough for me. I want a 0.7. Good luck with that. If you find one, let me know. Why aren't you using pips? As everybody deals with a different account. Well, we're talking specifically about win to loss ratio in a dollar figure. So it doesn't it doesn't matter if it's 1,000. Your position sizing doesn't make any. If you have a different account, if you've got let's say you've got more money, so you're using so it's $1,500 for every winner and $1,100 for every loser. It doesn't make any difference. Your average win versus your average loss. This is how you figure out the expectancy. We wouldn't do it in points if we were in the futures market. We're going to use the actual dollar figures. I just didn't unprivatize the room. We can unprivatize the room. I don't care. Hang on. So we don't use pips. We use the actual dollar amount. And it's not going to make any difference because your profit and loss is going to be different based on what you're doing here. So anyway, I lost my train of thought. Good grief. The reason that we apply money management, that it must be greater than zero, is because we really, although there is technically a way, no, there's not. There's not a way. I thought that I was thinking over this last night as I was reviewing the training material for today, and I thought, well, is there a way if we had something that over time lost money, but we were able to increase position size during the winning periods and decrease position size during the losing periods, that we could end up reversing that and creating a profitable trading strategy out of one that produced a negative PE. And if it is possible to do it, I don't know how it would be done. Okay? So we want to have a positive expectancy that is greater than zero. Once that's done, now we can apply money management to it, and we can try and get the absolute most out of that particular trading strategy as possible. Okay? Now this is an important consideration. There are many things that can affect your results. A PE above zero can quickly go negative in the hands of a trader who does not utilize good discipline and manage their trade state. So what are we saying there? Okay? One of the best things that I ever heard Todd Brown say is that the greatest trading system in the world is worthless in the hands of a trader who will not follow it. Right? Guys, it doesn't matter. I get traders who come through the program, they do all of the work, they put in the effort, they do the back testing, they spend time in the live room, they do all of their money management spreadsheets, they do it all, and they have this solid plan together, and they're like, look, I've written out the trading plan, I've done the testing, I know it works, I've got my money management strategy set up, and then they go out into the market, and guess what they do? The exact opposite of what they should be doing. Instead of following the plan, they end up going back to all of their old bad habits. They end up running into the drawdown. They know the drawdown's coming. They anticipated the drawdown, but for some reason, instead of trading through the drawdown, instead of continuing to follow the plan, they start to modify the plan. And guys, when you do that, you erase all of the work that you've done. All of that testing, all of that preparation means nothing. You understand? An expectancy above zero can quickly turn negative in the hands of a trader who does not utilize good discipline and manage their trade state. Everything that we're doing here is going to be worthless if you get out into the market and don't follow the plan that you've laid out. Myth 2, money management and risk management are the same thing. How many people thought that they were interchangeable? That I can just flip-flop money management and risk management, it's kind of the same thing. To be honest, a lot of people bundle these together, but they are very different strategies, okay? They deal with two separate issues, and one of the reasons we break this up is because I want to clearly define what we're talking about, okay? Risk management is a process of ensuring that you are never in a position of exceeding your maximum allowable drawdown limits. Now, who sets your maximum allowable drawdown limits? You do. You set those. If your broker's setting your maximum allowable drawdown limits, then you're in trouble, Mark. But you set your drawdown. What are you willing to lose on this system? Okay? Too many people look for the system that has a specific, it says, okay, this system takes a maximum drawdown of 30%. No. The system will take whatever drawdown you assign it based on your position sizing. Now, you may not be able to reduce your position sizing low enough to get the type of risk that you want, and in that case, you would have to switch systems. But in most cases, you can assign a specific drawdown limit and say, hey, I don't want to lose more than 20% of my account. I don't want to lose more than 30% of my account. Right? Could you lose 50? Could you lose 60? Sure, it's up to you. I'm not going to tell you how to spend your money. I'm not going to tell you what kind of risk you should be using. I can tell you if you absorb more than a 50% drawdown, you're in pretty significant trouble, because now you've got to double your account to get back to zero. The more you lose, the harder it is to regain that that new structure high, that new equity high. But risk management, the only thing that we're dealing with is protecting capital, right? We're not interested in growing capital when we talk about risk management. I want to make this very clear. Risk management has to do with protecting capital. It is the most important thing, in my opinion, for new traders, is risk management. How am I defining my risk? Now, we do this on a portfolio basis, not on an individual trade basis. So we're gonna talk more about that in a minute. But when we talk about risk management, what we want to do is make sure that we do not exceed our maximum allowable drawdown limits. Now, money management is the act of increasing or decreasing position size to create maximum return with the lowest possible drawdown. So money management deals with, okay, when things are going well, at what point do I increase my position size? At what point do I start risking more money on the trade? When it goes the other direction, when do I start pulling back? When do I begin decreasing my position size? Which one of these does Akil do in his live room? Which one of these two? Risk management, yes. Why does he not do money management? Anybody have an idea? Because we always use the same lot size. Basically, the reason that we do that is because you've got too many different people with too many different account sizes. Okay. So what if I came in there and I had a $250,000 account? Okay, and I was trading 20 lots. And I started increasing and decreasing my position size based on the profit or loss that I was making. Do you think that your increase and decrease might change if you had a little different risk tolerance than I did and you were trading a $5,000 account? Absolutely it would. Do you think it would be confusing to people in the room to try and take that very personal aspect of money management and try and blanketly apply it to people from half a dozen different countries and varying position and varying account sizes? It absolutely would. So what do we focus on? We focus on risk management, making sure that you don't lose all your money. So we say, hey, if you got a $5,000 account, we're going to trade too many lots, and we're going to produce a 40% return over the year. And hey, guess what? If you've got money management, you turn that 40% into 140% potentially. Does everybody make sense? Is there any question about the difference between the two of these? Yes, he does. He trades the same position size every day in that room. I see you typing, Monty. I'll wait for you. Okay. So risk management, how do most people do it? Ever heard this one? I'll never risk more than 2% on any trade. Okay? That's my risk management. Okay? Now this really, it's not really a risk management strategy, and I'll explain why. It's really more of a form of fixed fractional money management. So this does not fall into the risk management category. It really falls into more of a money management strategy, but it doesn't protect you from, and it doesn't do that for several reasons. Okay? Number one is that it doesn't take into account how many positions you have open at any given time. So if I say, oh, I only risk 2% on any given trade. Well, what happens if you have 8 trades open at once? Now you don't have 2% risk on your trade. Now you've got 16% risk. You think that makes a difference? Well, it should, because it also doesn't factor in the maximum number of losing trades in a row. So I've got 16% exposure, and I've at one point taken 16 losing trades in a row. Guess what that could mean? It could mean all 8 positions that I have open at any given time take the maximum loss of 2%. I lose 16% on my account, and then I take another 8 losing trades for a total of 16 losing trades at 2% per trade loss. What is that, 32%? You just lost 32% in your account. Does that meet or exceed your maximum allowable drawdown limits? Is that within them or outside of them? It doesn't factor in maximum drawdown in pips. How many total pips am I going to have? Because you got maximum number of losing trades, right? Let's say, hey, the most number of trades I had in a row that were losers was 16. Shoot, let's say it was 6. All right? And inside of those 6 losing trades, I lost about 150 pips. But my maximum drawdown in pips is 500. Because just because I have 6 losing trades in a row, then I might have 2 winners, then another 6 losers. Then 1 winner, then another 6 losers. Right? So we need to not only be keeping track of how many losing trades do we have in a row, but what's the maximum drawdown in pips that we're going to receive? Does that type of money management strategy address any of those issues? Absolutely not. Therefore, we haven't really created any sort of risk management in our trading system, have we? We've given the illusion of that, but that's really all it is it's illusion. All right? Now, this is how risk management should be done. You need to ask yourself some questions. Number one, what is my starting account balance? These are writer-downers, guys. If you don't have your pen and paper out, writing this stuff down, you need to be doing that. What is my starting account balance? Okay. What is the maximum drawdown for the testing period? So for my testing period, my back testing, what was the maximum drawdown? This would be in pips for the testing period. How many pairs or markets do I trade inside of my portfolio? Like I said, we're not going to do this on a trade-by-trade basis. We know that you're going to trade more than one currency pair. All we say to do is define which ones. Are you going to trade one pair or are you going to trade 20 pairs? Define them. Which ones are they? And make sure you've tested every one of them to make sure whatever you're doing produces a profit on those currency pairs. And then 4, what is the maximum drawdown I am willing to accept? Everybody got it? Okay. The math looks like this. Let's say I have a starting account balance of $10,000. I'm using $10,000 because I want to keep the numbers easy. The math will be easier this way. So I got $10,000 account balance. I have a maximum drawdown. For my back testing period, the maximum drawdown in pips, not in dollars, the maximum drawdown in pips was 300 pips. Okay. The number of pairs that I trade is 4, so I'm trading 4 currency pairs. And my maximum allowable drawdown is 30%. So I say I don't want to take more than a 30% drawdown. What's reasonable? I mean, if you're going to be aggressive as a trader, 30% drawdown, I mean, it's more than I would probably want. I mean, I really don't want to see. I mean, I think about it in terms of, if I have a $100,000 account, would I be comfortable losing $30,000 of it? Just watching that vaporize. Regardless of how much money I could potentially make on the back end, let's say, oh yeah, you got to take a 30% drawdown, but you'll be able to create a 100% return a year. Are you willing to do that? I don't know. For me, it's a little too much because, you know, I've been around the block once or twice. I don't need to create massive returns a year in order to be very comfortable. So what I tend to look for is, how do I create, 3 to 5% a month in return? 2% would make me just chipper. But on net, how do I create a 25 to 30% return a year? And what do I have to have in terms of a drawdown in order to achieve those results? That's for me personally. It has nothing to do with you. But for the purposes of our argument, we're going to look at this and say, okay, $10,000 account, 300 pip drawdown, trading 4 pairs, maximum allowable drawdown of 30%. This is a definition that I make. Okay. Now, in order to figure out what the maximum drawdown is, because I'm saying, hey, I've got a maximum drawdown of 30%, take 10,000 divided by 30, you get $3,000. So the maximum drawdown in dollars that I can take is $3,000. Does everybody get that? Like I said, I don't want to make anybody feel stupid, but I mean, I just want to make sure that we understand the process that we're going through, the math that's being done here. So I'm going to figure out what a 30% drawdown is of $10,000, and that's $3,000. Like I said, it makes the math easy to do it this way. If I have $3,000 and I'm taking and I've got a 300 pip drawdown, that means I can risk no more than $10 per pip, right? Because if I risk more than $10 per pip, then I am going to exceed at some point my $3,000 drawdown. Everybody understand? Say yes. Let me know you're with me. Thanks. Thank you. Okay. Now, but remember, I have 4 pairs that I trade. So that means that $10 has to be spread loaded across 4 pairs. Because can you foresee a time in the future when I may have all 4 of my pairs open at the same time? Therefore, we have to spread load those 4 pairs, that $10 across 4 pairs. That gives us about $2.50 per pair. Now again, guys, one of the things that I'm doing is I'm being ultra conservative here. Ultra conservative. Because what percentage of the time do you have all 4 pairs out? Technically, you've got 300 pips of total exposure, of total risk. So could you potentially trade $10 for every single pair, so trade 1 standard lot for every single pair and not exceed your maximum drawdown? It's possible. I'm being ultra conservative here to ensure that there is almost no chance of you ever exceeding your maximum allowable drawdown. So if I spread load across 4 pairs, that's $250 or $2.50 per pair. That means that for each pair, you can risk no more than $2.50. If you trade 2 targets, you will need to risk no more than 1 mini lot per target. By doing this, you will give yourself the highest probability of staying within your predetermined allowable drawdown. Okay? But this is the process of looking at risk management and saying, okay, how do I ensure that this 30% is never exceeded? Any questions on that? How much would be a reasonable drawdown? Yeah, I can't tell you that, Raphael. I don't know what, I can't tell you what your reasonable drawdown would be. Some of you guys will be very aggressive. You will say, I am absolutely willing to take a 30% drawdown if I can create an 80% return a year. Other guys will look at that and say, there's no way I could stomach that. And I would caution you guys, when you say that you would be willing to do that, oh, Jason, if I knew that I could create a 100% return a year, I'd accept a 30% drawdown. Oh, yeah, absolutely. Until they watch their $10,000 account go to $7,000, or until they watch their $100,000 account go to $70,000, and they realize they just lost $30,000. Normally, it doesn't take that long. Normally, they hit $10,000, $15,000, $20,000, and they start sweating bullets. Because now all the questions start to crumble. Oh, maybe my system's not working anymore. Oh, maybe this isn't, even though it's completely within their allowable drawdown limits, even though it's something that they talked about before they started trading, when they actually get out into the market and they start putting their money at risk, now everything changes. Now the money is real. It's not just numbers on a paper anymore. It's my real money that I put into that account. And all of a sudden, what they thought that they were willing to accept as a drawdown is nowhere close to the amount that they're really willing to accept. How many of you guys have put a position on and you put your stop out there and you knew what your stop was when you put it out there? You knew how much you were risking, but you thought the market was going to go in your favor. And then when the market started to go against you, now all of a sudden the idea of losing all of that money became almost unbearable, to the point that you had to move your stops. Does that sound familiar? Anybody ever moved a stop because they got freaked out about the risk? Okay. That if you've, and we've all done it. So I mean, yeah, absolutely, I've done it a million times, a dozen times. I've done it many, many times. Okay. A person who does that is someone who did not accept the risk at the beginning of the trade. They might have said, oh yeah, I'm willing to risk $200 on this trade until I come to the realization that I might actually lose that $200. Now all of a sudden, maybe I'll just make it $100. Don't really want to lose $200. So you got to be careful. You got to make sure that what you're saying you're willing to accept as a drawdown is what you're really willing to accept, because the way you're going to set up your risk management is to ensure that you don't exceed that. Not that you don't hit it, not that you don't come close, but that you don't exceed it. All right. Although this process provides you a reasonable assurance that you will not exceed your drawdown limits, it does not guarantee it. There are important factors that can affect your actual numbers, and they are the amount of data used in your testing, the length of time covered, the risk that performance will degrade over time, reducing return and increasing losses. And this is something that I want to discuss this just briefly, because you get a lot of traders who are very worried, and not so much guys who do structure trading, but guys who do system trading. So, for example, a Liberator or something like that. Guys who trade systems, they're constantly, one of the major concerns they have is, how do I know when the system is not performing right? And they have this, I call it an irrational fear, that one day they're going to wake up and the system is just going to explode. Just not going to, it was working fine, it was making me 20% a month, and then I wake up on a Tuesday and it wipes me out, right? System totally blows up on me. Number one, a well-designed system with solid back testing, that doesn't happen. Well, I'm not going to say it doesn't ever happen, but it's very rare. We've never had that happen here. What we do see happen here is a degrading of the system over time. One of the things that people don't realize is that for whatever reason, and I've asked Todd about this because he develops all the systems for our company, I asked him, why is it that day trading systems tend to need more tweaking than higher time frame systems? Because it's all charts. I mean, shouldn't, you know, a 5-minute chart perform the same as a daily chart or a weekly chart? And he said, yes, it should, it just doesn't. And he said, I don't know why. But if you're going to have a day trading system, you have to monitor it and you have to make sure that you don't need to make any adjustments. One of the big things about day trading systems is that you see wide variations in average range. Okay, so for example, the first time I taught this course, we were talking about oil, the oil market, and I said, you know, 6-8 months ago, oil was trading. The daily range of oil was about $4, and I said now that daily range has shrunk to about $1.25. Now, do you think if you go from a $4 range to a $1.25 range in a given day that you're going to affect the trading, the performance of a trend trading system? And the answer is absolutely you are. So you've got to be constantly on top of that and be diligent about making sure that you're not seeing it. But what you don't see is you don't see a thing go from making money hand over fist to just exploding and blowing up your account in an afternoon. Excuse me. What you typically see is, hey, market goes from trading at $4 down to $3, down up to $3.50, down to $2. So you see this kind of over several months, a degrading of a strategy where, hey, it's just not producing the same results that it was producing 6 months, 8 months, 10 months ago. And now you've got to look at it and say, what's changed? Now, the better you are at it, you'll start to recognize these things early on. You'll start saying, well, man, this was a terrible week. Look at the ATR. We're just not seeing a lot of, you know, range-bound movement. We're seeing a lot of range-bound movement here. There's not a lot of directional movement, and it's showing up in my account balance. But that's something that can affect the performance of a trading strategy over time. Also, if you didn't select enough data, you're doing a day trading system and you only did 2 weeks worth of back testing, that is not enough back testing to have a reasonable assurance of how your trading strategy is going to perform in all markets. So you have to do that as well. And we have really a deeper process. We do some manual testing first, and then we go into some longer-term back testing, typically 6 or 8 months. Then once the numbers look good there, we do our tweaking. We make sure that we are kind of in the pocket for that 6-month period of time. And then we go out and we've got some software that we use that tests back about 5 years. And for everything that we do here, we do a 5-year back test. And we say, okay, if we performed well over the last 8 months, we think we've got it kind of dialed in here. Now let's look at 5 years and find out what the performance was. Because we do find at a given time, at certain times, that a trading strategy has performed well over the last year, but lost money the 3 years prior. And that's not a system that we want to use. Now, it doesn't mean that we can't, you know, tweak that system to get a smoother equity curve, but in many cases, we just have to drop it because it's not profitable. How would this calculation be modified if you consider different leverages? Well, it doesn't change. Okay. Your leverage is only determines how many positions you could have, what your total risk allocation could be, you know, how quickly you could go broke. But, you know, because you got to put up margin. The only difference between when you're with your leverage is how much margin you have to put up for the trade. So for me, I mean, the only thing about that 50 to 1 does is it means I can't have as many trades open. Because what do we know about, did any of you go to the Trader Summit that we held in January of this year? Did anybody go to that? Okay. One of the things that we talked about, and I tried to pound into guys' heads when we were there, is that if I have a machine and I put a quarter in that machine and I turn the little crank and 50 cents falls out, that's kind of what I want to see, right? If I have a machine that does that, how many times do I want to put a quarter in the machine? How many times? As many times as humanly possible, right? How fast do I want to do it? As fast as I can. Because the faster I can put quarters in that machine, the faster it'll kick money out. So if I have a trading strategy that produces me a 20, 30, 40, 50% return a year, if I just follow that strategy, take for example cipher patterns, okay? If I know that the cipher pattern produces a profit about 80% of the time, and I'm right somewhere around 70% of the time, how many times do I want to trade a cipher pattern? Every freaking time I find one. What are my only limitations there? The amount of capital I have to use. Now, every time I place a trade, my broker says, all right, I will give you that money and I will give you some margin to trade it on, but I'm going to give you money to trade that position on, but you're going to have to put up some margin. Every time I pull margin out, that reduces my ability to trade something else. So one of the things that high leverage will do for you is that if your numbers are tight, if you know what you're doing is working, then you can take out 6, 8, 10, 12, 14 positions at a time. And you will have the margin to cover that in your account. If you get down to 1 in 100, 1 to 50 margin, well, now all of a sudden you can't take out as many positions. Does that make sense? But in terms of your risk management, in terms of your drawdown, your actual margin has absolutely nothing to do with that. The only consideration is, hey, do I have enough margin to take out all the positions that I want to take out? I know a lot of guys say, well, I follow 20 currency pairs. Really? How big is your account? How big is your account to handle 20 currency pairs? It's going to have to be big. Otherwise, you're going to be in situations where you can't take out trades because you're tapped out your margin. Does that make sense? Okay. Now, let's talk a little bit about money management. And I just want to share with you some of the different kinds of money management so that you'll have an idea about some of the other stuff that's out there. This isn't anything that we use, but it gives you a brief overview of some of the different strategies that you can use. First one is called the martingale strategy. Is anybody familiar with this? This is really a gambling strategy. And what it says is that every time I lose, I'm going to double my position. You see this strategy used a lot at roulette. So I put $100 on black and I lose. So then I put $200 on black. If I lose again, I'm going to put $400 on black. If I lose again, I'll put $800 on black, right? It's a martingale strategy that says I'm going to double down every time I lose, because then when I win, I'm going to win back my money much, much faster. Okay? This has been proven time and time again to be a losing strategy. It may work well for you for a very long time, but when it goes bad, you will erase your account. And the reason being is because you will run out of money before you run out of drawdown. Okay? Every time that roulette wheel spins, what are your odds of it coming up on black? 50-50. Once you've taken 50 losing trades in a row, it's come up red 50 in a row, what are the odds that the next time it's going to come up red? 50-50. Exactly. The fact that you've had 80 losing trades in a row, the next trade, the probability is still 50-50. One of the things that people don't get about trading is, let's say you've got a trading system that over an extended period of time, several years, that you have an average, you're right about 80% of the time. Okay, so about 8. People look at that and they say, wait, 8 out of every 10 trades will be a winner. Okay, the problem is how those trades get dispersed. Could you realistically have 2 losers, 1 winner, 2 losers, 1 winner, 2 losers, 1 winner, 2 loser, 1 winner, 2 loser, 2 winner, 2 losers, 1 winner, 2 losers, 1 winner, 2 losers, 18 winners? You could potentially have a disparity that works like that, right? There's nothing saying that is after you get 2 losers that, hey, I could potentially have, now the run should come. I've had my 2 losers, now the run should come. What's going to tell you, what is going to be the important piece of information that you're going to need to know in addition to what % profitable you are? What's going to be critical in you knowing how that disparity may work out? Yes, what is the maximum drawdown in pips? Good job, Neil. What's the maximum drawdown in pips? Because what does that tell you? That tells you what to expect. It gives you an idea of how those percentages may be dispersed out. But even that is not 100%. We're dealing with some broad ideas here and some stuff that we can do to kind of limit our drawdown. But if we know what our drawdown is, now we can prepare in terms of our risk. So martingale, not a very good strategy. The other one's called the anti-martingale, and what it basically says is as you are winning, every time you have a winning trade, you will reduce your position size. Because the idea being that every winner takes you 1 step closer to a loser. Again, what we know about the dispersion of wins to losses, this just doesn't play out. There's a 50-50 chance on any trade that you're going to have profit or not. Over time, those the averages play themselves out. Fixed fractional. This is a money management strategy that we will talk about. It's actually one that a lot of large funds use. That basically says, I'm only going to risk a certain percentage, or I will only risk 1 contract for a given account balance. So say 1 contract for every $10,000. I'm going to trade 1 lot for every $10,000 I have in my account. That's fixed fractional. Cost averaging. And cost averaging is basically a process. Some of you who are investors may be familiar with dollar cost averaging, and it basically says as the market decreases, I'm going to continue to buy. So it's one of those things. Have you ever heard a lot of investors say, well, I love it at 10, I liked it at 10, I love it at 8. At $10 it was a good buy, at $8 it's a steal. So I'm going to continue to buy. I'm going to average my cost down. Now, if you are an investor, I can see times when dollar cost averaging makes sense. If you are looking at the numbers and you believe that a company is extremely undervalued and that you're buying value, this is a strategy that can be utilized. I still don't think it's the best strategy, but it's one that you can use effectively. Because although companies do go to zero, it's not it's not that big a deal. You want to make sure you're being very careful with your leverage if you're using dollar cost averaging, because it can wipe you out if you're using leverage. And then the other one is pyramiding. And pyramiding is basically the process of as the market moves in your direction, you continue to add to the position. So you're averaging the other direction. I don't like pyramiding, although a lot of traders have used pyramiding to create astronomical returns. I've never liked it because I'm averaging my position the wrong direction. I'm averaging my, I got in, what I try and do is pick the best entry price with the least amount of risk and the highest reward. Okay? It may have been a strategy that the turtles used. I don't remember. Okay? But when I pick entry points, I try and pick the place that will give me the least amount of risk and the highest potential reward. Every time I pyramid, I move that line. And I don't like doing that. So I don't use pyramiding. Now, what we do, the foundation of what we do, I told you smooth ratio money management is what we teach, but fixed ratio money management is actually the strategy that smooth ratio is based on. And the easiest way to explain this concept is to use a variable known as a delta to determine when to increase or decrease position size. And let me show you what this means. Okay, this is the formula for fixed ratio money management. Now, for those of you who are getting freaked out at all the math here, the spreadsheet does all this for you. I am simply showing it to you and giving you the recording so that you can go back and review it if you guys decide that this is something that you really want to understand. Okay? But if we're looking at this, basically what we're looking at is required equity plus the number of units times the delta equals when to increase position size. And if we throw some numbers in here, let's say we have a $10,000 account balance. Okay? We're trading 2 units. Now, a unit can be whatever we decide it to be. It can be 2 standard lots. It can be 2 mini lots. It can be anything. It's a unit size. Okay? It can be two S&P contracts. It doesn't matter. $10,000, 2 units times the delta. Now, here we've chosen a 2,000 delta, essentially a $2,000 delta. And we're saying, okay, this delta is, I think delta, I'm not a math wizard or anything, but I think delta actually means variable in math. This delta can be anything you want, and we can adjust how aggressive or conservative the money management strategy is based on what that delta number is. So we've got a $2,000 delta multiplied times 2 gives us $4,000. If we take 10,000 plus 4,000, that means we're not going to increase our position size until we hit $14,000. Once we hit $14,000, we're going to go to the next position size. We're going to add a contract. We're going to add a unit. Okay? Now, what happens if we take this 2,000 and we make it 1,000? Well, now instead of increasing at $14,000, we're going to increase at $12,000. So we're going to by reducing the delta, we increase the rate at which we increase or decrease our position size. Does that make sense to everybody? Is there any questions about that? It's okay if there are. I went through it really fast. Like I said, the software does, the spreadsheet we have does this for you. All you have to do is put in what you want the delta to be. No. It doesn't mean 2 trades at a time, Ronald. It means I trade 2. So let's say on a Gartley pattern, we trade 2 mini lots, right? Target 1 and target 2. That's 2 units. So every time we put a trade on, we're going to trade 2 units. If you trade some of our other trend following systems, you might trade 3 units. Make sense? Okay. Is there a way to know what delta should be used? Yes. Once you have your backtesting data, I'll show you in a minute. Once you have your backtesting data, now you can play with the delta to see how that affects your equity curve. Okay? I'm going to show you in a minute, guys. We didn't give you the spreadsheet ahead of time because I don't want you guys playing around with it. I just want you listening. Okay, so here are some I told you fixed fractional money management versus fixed ratio money management. Now, this is basically how we increase position size. Now, fixed fractional, what I told you is that's where we say, okay, I'm going to trade 1 contract for every $10,000 I have in my account, or 1 lot for every $10,000 I have in my account. So in this particular, with fixed fractional money management, what happens is you trade $10,000 until it hits $20,000. At $20,000, you increase your position size. At $30,000, you increase your position size again. At $40,000, you increase your position again. Now, the problem with this is if you are a new trader, you're a trader with a small account, like a $10,000 account, you have to double your account before you use any money management at all. Before you get to apply any money management, you have to double your account. Now, I said a lot of large funds and institutional traders will use this type of money management, but they're starting out with, say, a $100 million account. So they're going to start out trading 300 contracts, and literally every day they're going to have the ability to adjust position size based off the profit and loss that they're seeing in their portfolio. A trader with a small trading account, this makes it very, very difficult to apply any money management as you're getting out of the gate. So what we do is we move over to a fixed fractional money management strategy that allows you to increase your position size at relatively consistent intervals. One of the other things that you'll notice about fixed fractional money management is that the more money I make, the quicker I increase my position sizing. So it requires less and less capital to increase my position sizing the more money I make in fixed fractional. Okay? This also exists some in fixed ratio, but what it allows us to do is get out of the gate a lot quicker. So for those of you who have smaller accounts, which is pretty much everybody in here, this is going to help you be able to employ some money management without having to wait to double an account. Okay? Fixed ratio allows for accelerated growth in your account, allowing you to ramp up your position size much quicker as your system produces positive trades. It also allows you to decrease position size more rapidly as your system moves into drawdown, allowing you to increase the rate of equity growth while not conversely increasing the drawdown at the same time. Now, one of the cool things about this is it's tough for you guys to see the equity curve growth here. But on the top, I have a fixed fractional money management strategy, and below here I have, on the lower chart, I have a fixed ratio money management strategy. And all we've done is we've grabbed some sample data here. Over the course of the sample period, the fixed fractional money management strategy yielded about a $12,000 profit. So it went from $0 to about $12,000 in profit. A nice, really nice profit out of that particular trading system. The fixed ratio money management strategy generated a 15%, or I'm sorry, a $15,000 return. So that is a 30% increase in equity with virtually no increase in drawdown. Okay? What we can do with fixed ratio money management is we can increase our drawdown, or we can increase our return without increasing our drawdown relatively. So normally you would think that, hey, if I'm taking a 10% drawdown and I'm getting a 20% return, then if I want to create a 40% return, I got to take a 20% drawdown. It doesn't necessarily have to work that way. Depending on how you increase and decrease the position size, you can increase your overall return without adversely increasing your drawdown. Does that make sense? Because look at these two equity curves. They're almost identical. Right? You don't see any wild pullbacks here because we're increasing and decreasing position size quickly as our account moves into new equity highs or drawdowns. And we're able to create a 30% additional profit out of the same trading system without really increasing our drawdown at all. Now, what are the major drawbacks? I'm trying to get through this, guys, because we've been here an hour so far. The major drawbacks of fixed ratio money management, because of the way fixed ratio calculates the delta, as you continue to trade, it will require smaller and smaller increases in equity to add position size. This causes parabolic moves in equity if traders consistently, if traded consistently, and creates the potential for violent equity swings. And that's evidenced right here, where you see this market shoot all the way up, and then we have this very violent action here at the end because you're trading so many contracts that is bouncing around. Now, this happens late in the day, and it's not terribly important, because in reality, have you guys ever seen those equity curves where guys are like, oh yeah, all I need to, it's like I generated a 300% return a year. or I generate 100% return a month. That's what I do. And here's the evidence to prove that I generate 100% return a month. And you're thinking to yourself, well, hang on, 100% return a month. If I put $10,000 in there, that means month one I'm at 20,000, month two I'm at 40,000, month three I'm at 80,000, month four I'm at 160,000. It's like at the end of 2 or 3 years, I'm going to be a trizillionaire, right? You're like, that doesn't make any sense. It's because what's happened is the guy has taken a very simple trading strategy. Maybe it's profitable. Maybe it's just nothing but fake numbers. But then they've applied a money management strategy to it that generates them the return that they want. Is that return reasonable? Probably not. But this is the type of stuff that they will do to show you the massive returns that you can get by trading a specific system. Our answer to this, to the problem of having violent equity swings at the top of the equity curve, is to use what's called smooth ratio money management. And all smooth ratio is, I'm not even going to explain it to you. There's a document that talks about it that it should be in your training material. It's basically a calculation that says, I won't allow you to increase position size more than X amount per interval. And you do not need to understand this to use it. All smooth ratio is it just they add a slowdown multiple that says, okay, even though technically your next level should be 10 units, I'm only going to let you increase by 3. And what it does is it smooths out the equity curve and it creates something else. This is the same set of data, okay? The same data. The difference is that this one went from about $0 to about $200 million, and this one went from $0 or $10,000 to about $400,000 over the same period of time. The difference is, when did we increase position size? And how much position size did we increase? With the smooth ratio, what we do is we limit the number of contracts or the number of units that you can increase at any given time. Again, I know it's complicated stuff. You don't really have to know this stuff if you don't want to, but I feel the need to explain it to you so that you understand at least foundationally what we're doing here from a money management perspective. Are there any questions with this? The next thing I'm going to do is walk you through the platform, the spreadsheet, and show you how you can use it. Any questions at all? Nothing. Not a single one? Okay. Now what I want to do is I'll let you guys mull that over for a little bit. I want to take a 10-minute break because I need to get some water. And then we're going to come back and I'm going to show you guys the spreadsheet. We're going to walk through the spreadsheet, and then we're going to go from there. Sound good? Big discussion in the office. Darren came out and was questioning my 50-50 flip scenario. And I don't know that I've convinced him that I'm correct, but he said he's gonna go dig up some more research and come back and confront me later. But now we're going to take a look at, did anybody come up with any new questions? Let me shut my door. Okay, well, it's all right if you don't have questions now. You can always have questions later. That's why we're here. We'll answer them. I guarantee you, as you start to move into the spreadsheet and you start playing with some of the numbers, that some questions will probably come up. So what we're going to do now is look at the actual spreadsheet. Now, on the first page here, Darren, if you have this spreadsheet, actually, I'm going to send you in HIP chat. I'm going to send you a document over, Darren. This is the new spreadsheet that we used at the technical trader workshop. I'm sorry, the summit. Let me find it here. Documents. And I'll show you the guys the spreadsheet in a minute, but I have this spreadsheet has sample data in it. Let me see here. Hang on, I'm trying to find this here. There it is. All right. Coming to you, Darren. Okay. So this has sample data in it that I can use, you know, for testing purposes. So on the first page here, what you've got is your pip values, and these guys, you can plug these in if you want to give you a more accurate reading on what your actual unit size will be. So if I know that the euro is the dollar yen's trading at $12, a euro USD is at, you know, $10, you can adjust these position size, and you've even got a little link in here that takes you to the pip calculator, so that you can use that as well. So we got a little pip calculator, and so you can tell what the current pip values are for each one of the pairs that you might trade. So on the next sheet is the backtesting sheet, and the cool thing about this is, I'm just going to run through this kind of at the top. You've got your, this is going to give you a readout of some information that's going to be ready access. So your gross pips on a per unit basis, your average losing streak, your maximum losing streak in pips, total units traded, your account equity, and then over here you've got winners versus losers versus scratch trades. So how many did I win, how many did I lose, how many broke even. And then over here, of course, we've got errors made. So I've got a place in the spreadsheet that actually lets you discuss or lets you write in what your problem was. Okay, so if you had any issues on the trade, let's say that you took the trade and you ended up moving your stop. You know you shouldn't have done it. It was against your rules. You made a mistake. You can put that in there. You can say, hey, I moved my stops. I got stopped out here, and I made a, you know, it was an emotional mistake or whatever. Now, inside of this trading spreadsheet, we've got several different things in here. Now, some of them you will use, some of them you won't use. We basically put this spreadsheet together to encompass a lot of different trading strategies so that you could use it for whether you're using a liberator system or whether you're using pattern trading. We've got entry date, entry time, the currency pair that you're using, the chart interval, you know, whether on an hourly chart, a 15-minute chart, what is the trading system that you used? Okay, because what if you're using Gartley patterns and butterfly patterns and all of those different types of things? You've got a type of entry. Now, type of entry is typically restricted to some of our mechanical trading strategies where you've got first strikes and second strikes and those types of things. So it's not really pertinent for your use as a structure trader. But you may want to identify, hey, that this was a DSR double top or something like that. ATR, average true range, you don't need. CTS, if you're a CTS trader, one of the things you can do is you can write in what was the CTS score so that you have that in your backtesting. And again, one of the things that when we talk about backtesting is, what do you want to make sure you do when you backtest? You want to make sure you collect as much information as possible. Everything that you think you're going to need, you want to have, because you don't want to have to go back through. There's nothing worse than doing 20 hours of backtesting and realizing that you forgot to record the date. The dates of the trade happened. Now, I know this happened to me. No one bothered to explain this crap to me when I was learning how to backtest. And I did 20 hours of backtesting and realized that I didn't write down any of the dates. I wrote down the days. I was smart enough to write down the day of the week, but I didn't write down any of the dates. So guess what I had to do? I had to go all the way back through my backtesting again and write down all of the dates. It was a huge pain. I hated every minute of it, but learned my lesson. Now, also have your entry price, your initial stop loss, your target 1, target 2. If you have a target 3, that would be in there. If you want to put in the day it was closed and the time it was closed, what are the benefits of having that? If you know when you opened the trade, and you know when you closed the trade, you also know how long you were in that trade for, right? How long was that capital at risk? And also, if you're doing day trading, you can put in the closed time so that you know how many hours your money was at risk. Then you have your exits, position 1. Where did you exit the market? Exit price 2 and exit price 3. Okay. Then maximum favorable excursion. MFE and MAE are not things that you will use here. Chart notes. Any chart notes you want to put in here. Anything you want to add about this particular trade, like big news event or something like that. Anything in here that you want to have, that'll go in your chart notes. Rules followed 100% of the time, yes or no? Did you follow the rules? Errors made. Okay? We've got a few of them in here. We've got emotional, trade management. You can also add others if you want to add more so that you can add in additional issues that you might have. Order entry, trade management, fear and greed, emotion. So all of those are in there, and all you got to do is you just highlight there and you click on the little tab to the right, and that gives you the issue. And then it updates, of course, here in your spreadsheet. Okay? Then all of this stuff, closed pips, all that stuff is already pre-calculated. It's done for you, so you don't have to worry about it. So you don't have to add in any of this stuff. It actually does the calculations. And you can see up in the top here in this scroll bar, I don't know if you guys can see that. Can you guys see this at the top? Yeah, you can. You can see where there's actual code. So if there's code in there, don't touch it. If you touch the code in there, you're going to screw everything up. So that's my disclaimer. Don't touch where there's code. Anywhere where there's not code, you can put in whatever you want. But if there's code there, leave it. So what we can do is we come down here and we just start adding in all of our data. Every single trade. Yes, it is a very, very comprehensive spreadsheet. We wanted something that would really work for you guys, okay? So you have all of your data here from every single trade that you took in your back testing. You can also, for your back testing, okay? That's what this is. It's for your back testing. Then we move on to the money management section. This is the part that everybody wants to see, okay? So now we have fixed size. So if we use no money management, and then we have our trade empowered money management or our smooth ratio money management. So you can see right here starting account balance. What do we have? Well, let's say we've got a starting account balance of $10,000. What's our maximum acceptable drawdown? What are we going to allow our drawdown to be? I don't want more than 20% in my drawdown. Lot size. What am I trading? Am I trading micros? Am I trading minis? Or am I trading standard lots? Okay, I'm going to trade mini lots out of my $10,000 account, and I don't want to accept any more than a 20% drawdown. Okay, so these are my points in here. This is going to give me some of my position sizing. My starting units, I'm trading 2 units, so I'm trading two targets here. Okay, can you make mistakes emotionally on back testing? If you're making emotional mistakes in your back testing, Peter, I'm going to tell you to hang it up. You will feel some of the emotion behind it, which can be helpful to you, because when you're taking those losses. But if you're not taking a trade in back testing because you don't want to feel the pain of losing back testing money, then you need to not be trading. That's going to be my advice to you, because you are so emotionally on tilt that this is not the industry for you. And I'm not saying that's you, Peter. I'm just saying that if you're running through backtesting and you're literally like fudging your backtesting numbers and you're not taking trades in backtesting because you don't want to feel the pain of that being a loser, then you are definitely in the wrong business. Now, Here's our delta. Our delta tells us when we're going to increase or decrease our position sizing, right? So how aggressive do we want to be? So let's take a look at this. Now right now we've got it super aggressive. We're at 200. That means every time we get a $200 increase, we're going to increase our delta. And that creates, as you can see here, if you look at the left here, all these are the same unit size, right? This is just like a Keel would do it in the live room. It's 2 standard contracts every single time, all the way down the line. Then look at what happens here. 2, 285, 752, 790, all the way up, right? So now we get into our money management strategy here. Now, our slowdown multiple is at 16, which means it's basically not doing a lot for us in terms of slowing down this rate, but I'm going to change some of these numbers up and I'm going to show you what a difference it can make, okay? So take a look at this here. We got 2 units, 85 units, 75 units, but we're increasing every time we get a $200 winning trade, or we increase our equity by $200. So what if we made this $2,000? What do you think it's going to do to our overall return? Okay, let me go back to 200. At 200, we basically made, what is that, $350 million. Again, this is simulated data. It's not important. This is something that we threw in here. We had some more realistic data. I don't know, Darren, where that spreadsheet went, but this is, this looks like something that we would fake, you know, for training purposes. But this is not real data. So we got $350 million in profit. Now, if I change this to a $2,000 delta, it drops to 35. Oh, it actually drops to, what is that? 3.5. So a significant decrease there, and look at what happens from the way we increase our position size. It increases much slower because it's taking us a lot more time to increase our position size. Does everybody get that? So we're trading, instead of every $200, we're increasing every $2,000. Now what happens if I make this $5,000? If I make it $5,000, well, now I'm increasing position size even slower, and now I only made about 1.4 million instead of 3.5. So I'm limiting my overall return, but what do I also limit when decreasing my position size, or when decreasing my or increasing my delta? I also decrease my risk, right? So now, let's play with the slowdown multiple. Let's say, okay, you know what? I get this, but the rate that I'm increasing position size, look at this. I go from 5 contracts or 5 units to 17 to 24 to 25, then to 33. It increases so fast. I'm really nervous about, you know, one day I come in and I'm trading 2 units, and then 2 days later I'm trading 17 units. That's just too much for me. I really am not comfortable with that amount of risk out there. So I'm going to take my slowdown multiple from 16, and I'm going to take it to 5. Okay? So now I've got my $5,000 delta, and I've got my slowdown multiple at 5. Now look at what it does. Now see how we've got a nice, even, steady climb as we increase our equity? And we don't have these wild jumps from 5 to 17 to 33. And we get a much smoother equity curve as the market runs up because we're increasing our risk. We're increasing our position size at a steady predefined rate. I can reduce this down to 3 if I want to. Okay? And again, it's just going to slow down the rate at which I increase my position size. It's going to give me a much smoother equity curve, not this, you know, not a lot of jumping around. Now, one of the ways that this will help you, that you'll notice when you put in your live data, and Darren, we just make a note, I want to get some data in here that actually shows some drawdown, because this is not very valuable in terms of the drawdown. I want to be able to see that. One of the benefits of this particular, of having a slowdown multiple, is when you have something that that is not as streamlined from bottom left to top right, when you have some significant, say you have a 10 or an 18% drawdown. One of the things that can happen is that if you are increasing your position size really rapidly, you can get violent corrections in price. Because let's say that you just increased your position size from 17 units to 25 units, and then you immediately run into a drawdown, and you have a couple of losing trades, and now all of a sudden you are up 30%, and now you're dropped, and you've lost half of your profit. You go from being up 30% up 15% in a couple of trades, because you're increasing your position size so rapidly. So one of the ways that we avoid that is by adding in the smoothing factor, the slowdown multiple, and that slows down the rate at which we increase our position size. Make sense? Any questions on that? So what you have to do is you have to come in here based on your back testing data, and you have to say, okay, I've got a $10,000 account. I'm willing to accept a 20% drawdown. I'm trading mini lots. I'm trading 2 minis. My starting unit size is 2 minis. Okay? And now you can, once you've got that information in place, now you can play around with your delta and your slowdown multiple and the number of pairs traded in order to find the equity curve that you're comfortable with, the amount of return, the amount of drawdown that you're comfortable with. And you're going to be able to see, okay, what does it do to my account if I get a little bit more aggressive on my money management? Am I willing to accept that? Did you say that this could be adjusted to reflect futures? Yeah, it's very. This is set up for. This is set up right now for Forex. I think we have one for the futures as well, because you'll need a little bit different. You'll need it'll be able to be a little bit different. Any questions on this part of it? Now, one of the things that we can do when we get this dialed in and we say, okay, that's about the best that I can do for this particular strategy. That's based on all of this backtesting data that I've done, looking at my money management sheet, this is about the best equity curve that I could come up with. Now we're going to roll over to the backtesting tune-up sheet. This is where this really gets cool. Okay? So I have here, I should probably have, these are the different types of trades, okay? So if I go back here to my backtesting sheet, I'm going to zoom in here. Here are the different trading systems, okay? We got the HARM trading system, we got the GXC trading system, we got the GXBC trading system, and if I go to my tune-up sheet, you're going to see all of those different trading strategies, okay? So if you were a pattern trader, you might have Gartley, butterfly, bat pattern, crab pattern, that type of stuff, right? That might all be in here as a different strategy that you're trading. Now, also in addition to that, you have your type of entry. So for us, that really doesn't matter. We can just take a look at the trading system. But if you have a type of entry in your backtesting tune-up, I can drop down and I can look at, these are all the different entry types that I have. Now let's break this down a little bit further and let's take a look at the days of the week. Now, were there any days of the week that my trading system didn't perform very well? Look at that. Oops. Well, for the RC entry, Sundays was a terribly losing day. That didn't perform very well. Let's look here. Well, again, Monday for the GXC didn't perform well at all. That was a net loser. The BAT lost 13. That was a net loser. Again, the RC lost Monday, Tuesday, and Wednesday. The only day it made money was Thursday. So over net, the GBC trading strategy or entry trading system did not perform well, or entry did not perform well. Okay? Now, why is this valuable? What can I do with this? Well, let's break it down. Let's open up Sunday. Let's look at times a day. What time of day didn't perform very well? Or what times of day performed really well? Well, the only time that really performed well was about 9:15. It was the only time we actually made any money. So really, maybe I shouldn't trade this particular strategy on Sunday. I could potentially erase that from my trading strategy. I can remove that as one of my trades. Down here, I can look at this particular trading strategy, and I can say, look, this thing lost money Monday, Tuesday, Wednesday, Thursday. Maybe I just don't want to trade this one. Or maybe I don't want to trade it Monday, Tuesday, or Wednesday. I only want to bring that in and trade it on Thursdays. What you're going to find here is all kinds of hidden information. You may find out that, hey, your trading system, while it performed really, really well, lost money every Monday morning. Monday afternoons was great, but Monday mornings was terrible. Lost money every Monday. You may find that a specific currency pair, you might have looked at, say, Aussie dollar, and you might have traded cipher pattern on Aussie dollar. And what looked like, when you looked at your initial back testing, like, hey, Aussie dollar just doesn't produce a profit with a cipher pattern. Okay, I'm just pulling a number out here. So, well, Aussie dollar didn't produce a net profit in my back testing, so I don't want to trade that. But when you have this sheet, you can actually break it down and you can take a look and say, well, maybe Aussie dollar lost money on Mondays and Fridays, but Tuesday, Wednesday, Thursday, it made money. And if you got rid of Mondays and Fridays, you would take a losing system and you turn it into a winning system. Do you see how being able to drill down all of this backtesting data that you've collected, being able to come back into your backtesting tune-up sheet and actually look at that data, look at all of the different things. Every single variable that you plugged in over here on your backtesting sheet is available in your backtesting tune-up. You can literally go through and look at anything. Winners, losers, where do you make the most money? The options here are really limitless as to what you want to look at. And you can break down your trading system. You can break it down on on a system basis. You can break it down on a time basis, on a day of the week basis, on a monthly basis. Anything you want to do to look at the data, you can break it out however you want to. Can you see the benefit of having that? Of being able to break your numbers out that way? It's incredible. I'm very excited about this. This really is huge. And nobody else, to my knowledge, does this or teaches this. Nobody else gives you guys this level of, a product that allows you to go out and reach out and look at your trading strategy and to make adjustments, right? And see where the money's really coming in. Then we move on over. Now we have our live trading log. Because the real question is okay, got my money management, I know what I want my setup to be, how do I trade it? When do I know I need to increase or decrease my position size? Well, that's in your live trade log. You're going to it looks exactly the same as your backtesting log. It's just in real time. So you're going to enter every single one of your trades into your spreadsheet, and then you've got your live equity. And your live equity is based off of the tune-up, the backtesting money management that you've lined out here. And it will tell you, you just need to go in here and take a look at it and say, okay, yep. Time to increase position size. What's it say I need to be trading right now? 2 units, 3 units, 6 units? What do I need to be trading? And then, of course, you also have a live tune-up sheet as well, so that in real time you can be running through and checking your numbers and making sure, okay, how are things panning out? How are my numbers looking? See how this is getting more and more like a business every day you guys are here? Hey, we're keeping good records. We're making sure we know what our strategy produces. We're looking at the books every night to make sure that our profit and loss is good, to make sure we don't have money leaking out here or there. We got the tools at our disposal that we need to really understand what it is that we're doing. And now all we have to do is get out there every single day and trade the plan. And my goal has always been to provide you as many of the tools as possible for you guys to be independently profitable traders. And this piece, I think, is critical for you guys to have and for you guys to understand. Now, we do have a new spreadsheet. I'm going to show you that because I added a couple of things to the new spreadsheet. New spreadsheet looks just like the old one. You've got your tick values, you got your back testing, your money management, you've got but you also have this back testing review, okay? And what this does is it gives you some representations on a chart of what your average win, average loss is. There's a bunch of stuff in here that that's going to give you some nice graphs that are really easy for you to look at. And then you've got, of course, the same thing in your live trading. So I'm going to give you both of these spreadsheets for you guys to use. Any questions about anything we've talked about today? You guys are kind of quiet. All right. How do you know how fast you should increase your trading lots as you put in the initial number? Well, that guys, you don't know. That's why you play around with these numbers. You have all your backtesting data, right, that you enter into the spreadsheet. Then you come into your backtesting money management tester and you start looking at what's my starting account balance? What am I willing to accept as a drawdown? I'm trading mini lots. Am I trading 2 pairs or am I trading 4? Okay. If I trade 4, it's going to change some things up. And all the math here is done for you. So all you have to do is take a look at your equity curve, take a look at your drawdown, take a look at your increase and decrease in position sizing, and then play around with your delta and your slowdown multiple to make a determination. I would use, yeah, John, he showed you how to use, how to create a backtesting spreadsheet because we wanted you guys to know how to do that, because down the road, you know, you may want to have that skill, and it's important that we walk through the logic of it. But take your information that you've got in that spreadsheet that you've been doing your backtesting on and transfer it into here, because this is where you're going to get all your money management information. Yes, this is an Excel spreadsheet, yeah. Yeah, this is typically, you know, people are just like, man, I'm a little lost when they get done with this lesson. When you get into this and you start looking and you watch the video again, you start playing around with the spreadsheet, it's going to make sense, okay? You're really only looking at 2 things. You're taking all of your back-tested information, and in your money management sheet, it's programming this stuff in here, and then all you're doing is really adjusting your delta and your slowdown multiple to determine when to increase and decrease position size. Darren's going to be emailing this to you. Is it email, Darren? Is that what we're doing? Or is or are you going to put it underneath this video in the recordings on the site? Uploaded. Yeah, that's probably best. Okay, so Darren will have it uploaded to the site today as soon as the video is posted, so you guys can download all of it and play with it. Okay? Any other questions? Like I said, I'm going to be in the live room this week, so we can talk about this more if you guys want to talk about it more. You guys better be more entertaining if we're in the live room this week, because I got to tell you what, I like feedback. Yeah, John, if you're going to be transferring the information, you're going to need the same. Again, look, you've got entry date, entry time, currency pair. If you don't have the chart interval as one of the things that you recorded, you can just leave that blank. That'll be just one thing that you cannot access when you come to your backtesting tune-up sheet. One of the things that won't be in here on the sidebar is that function, is that field. Okay, so if you didn't record all of this information when you were doing your backtesting, then you won't have that field to access, but you can just come and plug in the information in the appropriate field. But there's no need now that you have this sheet to do your own backtesting sheet. Good question, though, John. Anybody else? Catherine, I see you typing. And again, it's a long lesson. When we increase our position size, do we increase the number of contracts on a trade or increase the lot value on the trade? Catherine, I think those are the same thing, unless I'm misunderstanding. So if I trade, let's go to the money management sheet. So starting units is 1. So let's make our starting units 2 units because we're trading 2 mini lots. Okay. So here we go. 2 mini lots, 2 mini lots, 2 mini lots. Now we're trading 3 mini lots. Now we're trading 4, 4, 4, 5, 6, 7, 6, 7, 7, 7, 7. So you're trading mini, 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 3 minis, 4 minis, 5 minis, 6 minis, 7 minis. All you're doing is increasing those. Can you lock cells for us that have your formula so we don't mess it up? I don't think those cells, some of the cells you can't access, maybe all of them are unlocked. Look, be careful. You can always download. I would save when you save this, John, to your hard drive. Save one copy and then open up a new copy and then save it as your backtesting sheet. So that way you've always got a master copy. That way, if you happen to screw it up, but if something happens and you're like, I guarantee you, there's going to be more than one person who's going to call us up and say that our spreadsheet is broken, that it's not working right. And what we're going to find is that somebody has cleared out one of the cells that has important information in it. Okay? It happens. Just recognize you'll be wrong when you send us an email to tell us that our stuff's messed up. And it will end up that you are messed up. But that's okay, because we'll fix it. Okay? We've been using this spreadsheet for quite a while, and it works great. You can skip the odd lots. Mark's saying, well, what about 3? Because I've got 2 targets, then how do I trade 3 minis? Well, you tend to trade 3 minis. You can take off, you can take off 2 and 1. You can take off 1 and then 2 on the secondary targets. You can do that however you want to, or you can just go straight to 4 if you want to, and then increase in intervals of 2. I would not recommend that. I would just follow the strategy and say, okay, well, I'm trading 2 targets. I got 3 mini lots on, so I'm going to trade, 2 and 1. I'm going to take, half, 2/3 of my position off at the first target, and then I'm going to have a runner. Otherwise, you're increasing your position size quite a bit more. You're doubling it. But it's up to you. Yeah, absolutely. I've traded patterns that way. Yeah. Look, your percentage accuracy comes from your initial target. Your follow-on target is nice because you pick up some runners up to those 618s in the secondary targets. But if you're right 70-80% of the time and you're taking off 2/3 of your profit on the initial target, there's nothing wrong with that. And if things are profitable and you're doing what you're supposed to be doing, it's not going to be very long before you're going to be trading 4 units anyway. Sorry for asking again. No, it's all right. We just vary the delta and the slowdown multiple until we see an increased level of contract over time, which seems like, yeah, what you're basically doing is I've given you the ability to play with the numbers and find something that you are comfortable with. Okay? This can be very dangerous ground for me as an educator. because I cannot give you personal advice. I cannot give you a spreadsheet that just blatantly tells you when to increase and decrease position size. Number one, that would be wrong of me because it doesn't take into account your own individual financial situation, and it doesn't take into account your risk tolerance. Okay, those are things that I don't know, so I can't make a blanket spreadsheet that says, okay, this is when you increase and decrease. What I can do is I can teach you how to do that for yourself, and I can give you the tools to determine what's comfortable for you. So I teach you about how a delta works, how a slowdown multiple works, how you do back testing, and how you get the information into the spreadsheet, and then I teach you how you can modify delta and slowdown multiple and maximum acceptable drawdown to potentially modify equity curve. And then it's your responsibility to go do that testing, to put it into the spreadsheet, and then to find something that you're comfortable with, that meets your standard or your criteria. That's my obligation. That allows me to deliver the information to you while at the same time not crossing any legal boundaries that would get me into trouble. Cool? Yeah. There's a reason I teach this, and I don't allow anybody else in our organization to teach this, okay? Anytime we start talking about dealing with money, people's money, I want to make sure that we're very, very clear. So it's not that Akil could not teach this program or could not teach you money management. It's that I want to make sure that what's put out here in this class is correct. It's very, very important to me. Any other questions? Those are all good questions. If there's nothing else, then we have been running 2 hours, and I'm just going to let you guys go. Sound good? All right, guys. Well, thank you so much for your time. I will talk to you all tomorrow in the live trading room. So bring your A game, be ready to discuss, be ready to trade, and I'll see you guys then.
Mic check, 1 2 1 2. Can you guys hear me? Good, good, good. I'm gonna give you a warning. I may be muting the mic a lot. I've got a mean case of the sniffles. If I randomly cut out, it's okay. If I'm not back for more than a minute or so, then something's probably wrong. I had a meeting with my realtor last night, really late last night, and she had a cold and she was coughing all over the place, and if you know, there's a million things of paperwork, so each time she's coughing, her hands are touching the paperwork, and I'm touching them, and the wife is touching them. It's just, I can see the germs spreading all over. Could I adjust the screen size? If you want to make it fit, there's a thing in the top left corner, or the top toolbar, where you can adjust it and make it work. Let me do this for all of you guys. Boom. Better? Hope so. But all right, guys, welcome. Cool. Yeah, that's in the top right whenever you guys want to use it. You guys are a week in to your 12-week transformation. That's actually 2 weeks in, but really a week in. And the point, many of you have been in the live room. And hold on, here comes the sneeze. Gosh, man. You and Darren's names are taking a lot of real estate. Okay, I think I'm probably seeing something you guys are seeing. If it is, there's some buttons you can adjust it on your side of things. Just play around with little triangle clicky buttons, and you can adjust stuff around on your desktop. But there, like, looks like Darren adjusted. Is that better? Hopefully. There we go. But yeah, play around, click the buttons. It makes it better. But you guys are a weekend. to the 12-week transformation, a week or two in. Many of you have been in the live room. What do you guys think of the live room so far? Good, bad, confusing, information overload? Are you following everything? The live room is like being shot, like being fed with a big fire hose. All good, all good. Too fast, too fast. Never been there, looking forward to it. I like repetition, learned a lot already. And as I mentioned, there's about, I've been doing a live room for 2 years. What I've noticed is there's about a week and a half to 2 week learning curve in the live room as far as the speed goes. Now, as far as understanding everything in there, that's going to take time, and you guys are actually going to have the advantage because you're taking a formal training course. You're going to have the videos that are slower and explain it more in detail. But for the speed-wise, it's usually about a 2 week learning curve. At first, it's like, Gartley pattern, double bottom, ABC deacon pattern, completion, 127 extension, Fibonacci rejection, sell right here, buy right here, okay, profits hit, target, stop, loss, break even, and you're like, oh. And before you know it, a half an hour has passed and you didn't learn anything. But you'll see next week as you come back, it'll slow down and slow down. And the key is the repetition. Because basically, not basically, I do essentially the same thing each day. There's only a certain amount of trades I involve myself in. I try my hardest not to look at trades that I don't use. So if someone's mentioning, hey, is that a crab pattern? I usually ignore it. Is that a shark pattern? I usually ignore it because it just doesn't make sense in my trading, so I don't even want to waste time going over that. But we do the same thing every day over and over again, and that's how you train the skill. We talked about that in the Technical Trader Workshop, that free video I put out about dribbling a basketball. Well, how do you get, if you're a basketball player and you notice that, hey, I can't really dribble with my left hand as good as my right hand, well, how do you get better? Well, you just dribble more with your left hand. You just do it over and over again until it becomes familiar. And that's what the live room is gonna be to you guys. And as you go through the modules and you start to learn more and more, and I've been reading the comments, some of you it's clicking already. So that's good to hear that we're doing a good job with the pace of the training, meaning that it's slow and it's clear and it's starting to make sense. I'm glad I'm hearing that feedback from you guys. Once that all clicks in, it's going to make perfect sense. And again, me and Jason, we structure it so one topic builds on another. And that's why I say this over and over again. I try to urge you guys, don't blow through the course in one day. Don't try to, I shouldn't be having questions about, hey, what's a CTS? Because, well, if you took the time to understand everything, by the time we get to CTS, you're going to know everything that's involved in it, and then it's basically just putting it all together into one thing. So that's pretty cool. But today is our training session, which is really a big question and answer session. I want to answer your questions, help clear up any issues you guys are having. I'm going to try my best again to stick to the topics that we're talking about. So this is going to be a structure, harmonic movement type day. So I don't want to see questions about, hey, can you find the Gartley for me? Because we're not on Gartley patterns yet. So I apologize if you're coming here looking to take this, but again, my goal is to really try and keep pace with this course because it's going to benefit you in the future. So with that being said, let me know what questions you have. Questions I know Alvin or Andre asked about the fib thing as well. You can ask questions about that, stuff about NinjaTrader, stuff we covered in the orientation. Again, just try not to get too far ahead, but shoot them in. If it's relevant, I'll answer them. If it's not relevant, I'll say, hey, bring that, send me an email or shoot that back to me, and we'll get to it. Here's what you do, Andre. Andre was asking about how do you lock in the fib extensions and fib inversions. You go to your fib tool, you bring it up. I use F9 because that's my shortcut. Boom, let's bring one in. Let's get the phone out of here. Just way too popular. Yes, this is recorded. Yep. You double click the fib, guys, whether it's a fib retracement, fib extension, and then you can play around with whatever you want to put in there. You can make it different colors, green, coral. What I do is I right click down here. All right. So right click after you change whatever you trade. After you change whatever you changed, go to manage templates and then save it as default. So again, I'll do this again. This is how you keep whatever fibs you wanna have locked in. Draw your fib out, draw your tool, double click it, change what needs to be changed, right click, so right click on your mouse, go to manage templates, and then save as default. And in that way, every time you draw it back up, it'll be that same, whatever you switched it to, it'll be that. So you don't have to worry about going in and editing it every time. Does that work for you, Andre? No. I don't know what to tell you then. It should work. Are you saving it as default? And then when you draw it again, it doesn't come back up. What's happening when you redraw it out? Make sure this box is selected. It's not going to show unless this box is selected. Make sure they have check marks on them. So if your 886 doesn't have a check mark on it, it won't show. But that should work. If that's not it, may want to call Ninja up and ask for some support. But that's I mean, unless Darren knows another way, that's how you do it. Original keeps. Yeah, I'm not sure. I would just say to walk through it slow and make sure you're changing it. Make sure you're going 50%, because you should. If I put this 50% on here, if I right click, go to manage templates, save as default, save current template as default, click. When I redraw my fib, look at this. That 50 cent is now on there. 50% is now on there. Yeah, so I don't know what to tell you then. Contact Ninja Trader, see if they can help you out. But that's how you do it. Yeah. All right, guys. This is your day. Can you explain why you have picked specifically certain fib levels? Those are the ones I was taught. Or now I know. I'll tell you this. These are the major fib levels. The major fib levels are going to be your 382, your 618, which is the 618 is the big one. This is the golden mean. This is the big fib level that basically controls everything. This is the major one. But the 382, the 50%, and the 786 are your major fib levels. I have the 886 up here because I use that. I trade a lot of bat patterns, which you guys will learn about later. And the 886 and the 50%, those are used in bat pattern analysis. So that's why I have those on as my minors. I don't use the 886 and the 50% too much as far as when I'm doing structure-based trading. But as far as the bat pattern, I need that for my analysis, so I have those two on there. But the three major ones are 382, 618, 786. Why those specific numbers? I don't know. Other than the fact that we know how Fibonacci percentages work, but I don't know why the 618 and not the the 23.6 is one or something like that. I don't know why the 786 aside from the 76.4 or a 707. I don't know. I just know that they work though. I'm sure you can search the internet and see why these why which percentage is important. But I know that when I was taught how to trade, these were the ones I were taught. These are the ones that were the major ones, and of course, again, the 50% and the 886 for bat patterns. I don't know why fibs work. They just do. Yeah. But if you trust me, if you got, I dibbled and dabbled in Fibonacci research a little bit just because it's interesting. I didn't do it specifically to trading, but just in general, once I learned about it, I was like, oh man, this stuff is magical. But if you search the net, you can find out a lot of info on fib. So they may be able to tell you, hey, why is the 786 more important than the 707, or why is the 886 less important than the 618, stuff like that. But they work. Yeah, it's amazing. the length of our bodies and our arms compared to legs and flowers and how petals and seeds and it's fibs are in everything, guys. It's kind of scary. That's why I usually don't go too far on that rabbit hole. I figure I may not come out. Start looking at the world differently and breaking down everything into a fib. I do that already. There's this one TV show that came out. I think it got canceled. It was called Touch, about this little kid, and a big premise of the show was based on Fibonacci's, and I'm sitting there like I was in love with the show. I'm not even sure if it was good or not, but the fact that a lot of the stuff was on fibs, I was looking at it and I was just, I use this. I'm yelling at the wife, look at that, it's a 618. And of course she's staring at me with the crazy face, like a 6-1 what? What does that even mean? I'm like, it's a pattern thing. It's whatever. Forget about it. Can you explain how the candle is formed? For instance, when the close of one candle is not the same level as the opening of the next, how is that possible? That is by a gap, Dennis. You'll see that a lot on range bar charts. But a candle is formed. You'll have and guys, I told another trader, if you go to Baby Pips, they have a great lesson on candlestick formation and a lot of the basic questions. But the candle has an opening mark. So if we're looking at, I guess it's red, so let's make it a bearish candle. If we're looking at a bearish candle, this is going to be our opening right here, our initial level. Obviously, as the candle moves, if it puts in a higher high and gets sucked back down, the wick or the shadow is going to represent the movement of it. And then this bottom level is going to be the close. And then again, if during that period, if we push any further down, we'll get a shadow or a wick representing how far the candle did break down or break up. But the original base of the candle where this thing starts at, this is going to be the opening of the candle in a bearish candle, and then the lowest point is going to be the close if it's in a bearish candle. Now, why we see gaps sometimes, meaning why do we see, if this candle closes like this, the next candle should start right here. Sometimes we'll see it push right here, and that's just because the market does gap sometimes. If you look over the weekend, you'll see bigger gaps in it. But sometimes you'll see a gap by a pip or so. And if you're on a range bar chart, every candle is going to be a gap because it's formed on a range. So it's always going to be a one-tick gap between the close of one candle and the opening of another. Now, if you ever get any strange gaps, I recommend reloading your charting history, reloading your data, and see if you can fill that. And you'll see gaps a lot, especially if there's a say there's a non-farm payroll, if there's a big news event. You'll see gaps during that, or usually during the weekends. Not so much during day-to-day price action inside here. Akil, can you explain what Jason often says when using fibs, swing low to swing high? Yeah, we use the swing high to swing lows for the Fibonacci extension tool. Now, if you have NinjaTrader, it's going to be like this. On other platforms, it may not be the same. So let's just say we're taking a Fibonacci extension from this leg to this leg. Let me see if I have a different chart, different color. There we go. Oh, same chart. What do you know? Boom. All right, that's weird. Here we go. All right, whatever. Same. Do this chart. Say we're taking a Fibonacci extension tool, and we want to measure from this swing low to this swing high. For NinjaTrader, here's how you use your tool. We're going to start from the swing low here. Start from the swing low. We're going to go to the swing high, and then we drag our Fibonacci extension tool back down to the original swing low to use our Fibonacci extension tool. Now, there are ways you can program it, especially if you're on other platforms. I know maybe MetaTrader, where you can just have the extensions and Fibonacci retracements all on one tool, so you don't have to use separate tools. I personally like using this because it again, that swing low to swing high and back down, it ingrains in my mind the process of this impulse leg. So swing low to swing high and back down. So you'll hear us, some of these terms like that, like look left, structure, leave clues. You'll hear me and Jason say that over and over again because, well, that's just the process that we're running through in our analysis, in our heads. But from NinjaTrader's Fibonacci extension tool, you're going to take the swing low to the swing high. You're going to drag it back down, and that's what's going to bring your extension levels up. Yep, no problem. I'm trying to get through the Fib Talk. Have you guys also researched DW GAN? I haven't. I've read some, but it was nothing I was interested in using. So I try not to. I try not to get too deep into stuff I don't use. That's one of the reasons I never finished the Elliott Wave course, which it was a pretty good course. I just never finished it because just knowing my personality, I have a personality where like I just want to try everything. If there's a new toy, I want to play with it, and I don't want to sabotage my trading by overthinking stuff. So I've read a little bit about GAN, but not too deep to the point where I've considered trading anything like that. Hold up, let me get a sneeze. Here we go. Wow, that's bad. Explain when a market opens, there is often a big move, a big gap. How can you avoid such uncertainty? And there's not always a big gap on open. If there is a major news event or something like that, you may see it. You'll see gaps in the stock market, not in the Forex as much. Every once in a while. But the question was, how can you avoid such uncertainty? Easy way. Don't be involved in it. Don't be involved in it. Don't trade it. Peter says over weekends just today. Yeah, and there's no opening for the market on during the week. The only opening we have for the Forex market is I know New York time is gonna be Sunday at 5 o'clock. Because remember the Forex market is 24/7, so there's no open or close of the market other than from Friday New York time at 5 p.m. and Sunday at 5 p.m. But here's the easy way: don't trade it. Don't trade it. Someone said this in the live room was really great. You can't you can't lose money if you're not in a trade. So put in a rule if you're worried about gaps over the weekend. Put in a rule. I don't hold trades over the weekend, or I don't enter trades until Monday. I give the market a day to breathe. I know I personally don't trade the lower time frames until Tuesday, so I won't take any 5-minute or 15-minute trades today. But put in a weekend rule. Say I won't hold trades over the weekend, which means you get flat everything on Friday, or you get flat on Friday and you have a rule that says, hey, I'll re-enter on Sunday that current position after analyzing the market. That's how I would handle it. Either just don't trade or make sure to have a rule about getting trades off and then putting them back on. Do you have any experience in backtesting with using candle bodies versus wicks as retracement levels? No. I've always used the wicks because with the retracement levels, I want to measure the entire move. Fibonacci retracements and extensions are based off the move, and the move is from the lowest low to the highest high. That's the full move. So I always want to measure that, not the bodies of the candle, because that would give me a false representation. I haven't tested it, so I don't know, but with Fibonacci retracements and extensions, you want to measure the entire move. So, like I said, in this case right here, I want to go from this lowest low, this wick right here. I want to bring on my correct tool. I want to go from this lowest low, this wick right here, to my highest high right here. I don't want to measure the lowest of the body to the highest body here. This is going to give me a false representation. More touches on the retracement again. Yep, no problem. You could have it in your trade. Let's go. Trade rules up. Alvin got it killed. Guess I had to shut down. Reopen. Try that and it works. Quick question. Quick yes or no question. For a three-wave pattern, do the outside returns have to be equal measure moves also, or just impulse leg? You're talking about a three drives pattern. I want to avoid the word three waves, Mark, because then people start thinking about Elliott waves, and that's a whole different beast. But for a three drives pattern, so here's what Mark's talking about, and we haven't. Well, yes, this is harmonics. We can talk about this. We're talking about a move up, and then remember we talked about how the market will move harmonically. So if it's moving very harmonically, we'll get an equal move. We got some good examples of this in the live room. Come on. And we're looking at 1, 2, 3. And we'll call this a three drives pattern. The question was, do the retracements so do the pullbacks right here, the outside returns, do these have to be equal as well? And the answer is no, they don't. Now, when they are, if the market's moving perfectly, you'll see that these retracements are also equal, but they don't have to be. The extensions are the main thing that we're looking for. But like I said, with that being said, if you're doing analysis and you're looking at predicting a level of retracement, an outside return, you could do something like this. And this is not going to be, probably not going to be able to find a good example here. Let's see if it works. You can often do something like this. You can take, we have our initial move up here, and this isn't going to be a harmonic move. Obviously, we don't extend as far, but if you measure the inside move here, the retracement, you'll often see that the next retracement, look at that, is the same distance as well. You see that, guys? So if you were a trader here, if you were a trader here, this gives us, this is a potential trend continuation trading opportunity. What happens? We get our impulse leg up, right? Our swing low to swing high. We get our outside return right here. We can bring in a fib to see if that lines up with anything. Could be a 382. Right on the 382. What would we expect next? Obviously, you see it already. Boom. A new structure high right here, right? If I'm losing anyone, just type in slow down. New structure high right here. It's cheating. You already see it, guys. But where do you expect the market to come back into, right? Previous structure high, right? Yep. Previous structure high. But we don't notice at the time. At the time, we're right here. What you can do is you can take the previous outside return. So you can take this move right here and I'll make this a different color for you guys. You can take this move in orange, copy and paste it. You can drag it on to your new structure high up here, and you can use that to help with your prediction of where the market's going to come into next, what level. And you can see in this case, what do we have? An equal move would bring us right back into previous structure. And of course, we always want to use our Fibonacci retracement as well. And in this case, we're going to get a 50% retracement. We get a 382 and a 50% right in that mix. So you can use those inside retracements. Look at that, right on a 50%. Golly, check that out. Take this out the way. Right on a 50% retracement. So you can use this to keep building a case. Now, instead of just having structure looking left, instead of just having a Fibonacci retracement level here, now you have structure, a Fibonacci retracement, and you have a harmonic move from our last retracement all at the same level. What does the market do? It stops right at that level and turns around. Right? Pretty cool. That was a great, I'm glad you brought that up, Mark. Glad you brought that up. Any questions about that? You guys are getting it. Either you're getting it or you're very lost. Is one of the two. I get it. Good, good, good. And for you guys that have been in a live room, you'll see that I do a lot of my analysis is just taking these equal moves and predicting levels. So any tool you can use to predict another level, it's great. And this is a great example that was obviously, we didn't have this on, didn't even think about teaching this, but you can see we came right back to that level. So that's pretty cool. Peter says, are we going today to the double top high? I still have issues. Nope. Double tops and double bottoms are not till what, module 3? So we're not going to be talking about those yet. Can you repeat the larger steps in setting up a trade? What type of trade, Art? The process. Well, it's the IPDE. IPDE. 4-step process in setting up a trade. We want to identify what the market is doing. Are we in a bullish trend? Are we in a bearish trend? Are we at structure? Are we in no man's land? We want to predict what the market's going to do next. We just saw this right here. We've identified that we had a bullish trend here. We had our starting point to our initial structure high. We've had our outside return. We just saw a new structure high here, confirming that we're in a bullish trend. Next, we predict, what is the market likely to do up? Well, if the market continues to go up, it's probably going to extend to another structure level, which we don't have on this 5-minute chart. If the market goes down, we're likely to get an outside return. If we do get that outside return, then where's that outside return likely to come to? Look left, structure leaves clues. Fibonacci retracement tool, swing low to swing high of our last move. Equal move from our last outside return here, copy and paste that. We make a prediction. Then we decide how we're going to enter. Am I going to be an aggressive trader? Do I just put a limit order there and say buy at that moment? Do I wait for confirmation? Do I wait for a doji candle, a pin bar? Am I a candlestick pattern formation? Do I wait for a higher high, higher close candlestick formation? Do I wait for a double bottom? What do I need to trade? And then last, E is execute, pull the trigger. How far back are you looking left? You can look back as far as you want. Yeah, there's no specific limit. What are you doing? I just look back. I look back for recent structure. I don't have a specific time period. So I don't say I look back for 10 days. I look back for 2 months. I'll do this. I'll measure right here, put a line in. I'll scrunch up my chart and then look back for structure. Do we have any structure here? Maybe I need to go to a higher time frame. Let's go to a 60-minute chart. I see structure right here. There we go. Yes, I don't have a specific time. I'll look back. Look at that. More structure. 1, 2, 3, 4, 5. No coincidence the market decided to stop at that level. Yeah, so I'll look back once I have confirmation. So once I see, and this right here isn't a structure level I would necessarily trade, but let's say these spike highs didn't happen. It was just this. Once I see this is the confirmation I need. This is structure. Now, if I want to look back for more, if I'm like, well, this is, in this case, you can see this is not a real clear level of structure. We do have structure right here, but the market spikes above. So it's not really giving me the confirmation I need. Then I'll keep scrolling back until I get that confirmation. So I'll look back and say, all right, do we have structure anywhere? Do we have structure anywhere? If I can find my bar. Do we have structure anywhere? Okay, we do have structure right here. Now I can use structure as my score. Yes, that would be minor structure. Once you scroll back more and you see that the market does hit this 2 times, 3 times, 4 times, 5 times. I know Jason likes to look for 3 times for major structure. or for structure, this would be major structure now. Minor structure is most recent structure. Major structure is going to be structure in the past or structure in a higher time frame. So if I'm looking on the 5-minute chart, I'm sorry for bouncing around charts. If I'm looking at the 5-minute chart, this previous structure high, this is minor structure to me. This previous structure high, this is minor structure. As I go into the 60 and run through what I just showed you guys, now that's going to be classified as major structure for me. John says, if they aren't, then the final extension will not be a fib level. Yeah, if you can re-ask that, John. I'm not sure if that was in response to someone's question or what. What if the market price is at the very top and has never been higher? Well, in that case, I would not look to take a short position. Structure is key in my trading. I need structure for every single thing I trade. So if we're at the all-time highest highs, meaning the market's highest highs were there and we're up here somewhere, and there's nothing ever in the past up there, I just wouldn't look for a short position. If anything, I'd wait for a long position. I'd wait for the market to retrace back here to previous structure and then look for a chance to buy it up. But I would just stay out of it if it's up here. And I don't care if it's like at a psychological number or anything. I'd stay out of it until maybe, until maybe new structure is created. Say we channel off a little bit like that. You guys will find out. Despite the how fast live room goes, I'm really a conservative trader. I do not try to involve myself in opportunities where I don't think I have a really good chance of winning. Finish out your prediction on this trade. Let's see what did we just do? We just put in a lower low, lower close. So if I were to make a prediction, I would say that we're looking at a bearish rotation. So I would say this. The market's going to retrace somewhere up here. We shouldn't break these higher highs or these previous structure highs. And that will most likely continue down into this area. So I would think bullish, bearish, I would think bearish, bearish, bearish. If the market came up here, I'd be looking for an opportunity to take a short. Meaning I'd look to sell somewhere in this area around this previous structure, get stops right above here in anticipation that the market's going to continue down. Maybe put in another equal harmonic move. We also have a potential bat pattern here as well if we do come down. But when I see this lower low, lower close, you see my blue line and how we got a lower low, lower close here? This is telling me bearish rotation, bearish rotation. I don't have confirmation yet, but this is telling me think bearish, if anything. So I'd watch market closely. I can do something like this for you guys that have the DSR levels. I can bring in my DSRs. What are we going, 5 minutes? So my major DSR is going to be a 20. My minor is going to be a 10. And I would say, give it a while. Give it a while to load up. Come on. This is why I don't keep the DSR levels up. I would say if price action comes into my DSR level, so this red box, then I will look for whatever entry reason I need to take a short. So again, identify what happens. We identify. What do we get? Lower low, lower close. What does that tell me? Potential bearish rotation, right? Predict. Well, my prediction is that the market's going to continue down, but first we'll probably get an outside return. So either we'll go straight down to this previous structure level, or we'll get an outside return that comes somewhere in this level. We don't have a bump in here, so I don't have a true level to tell, but we should get an outside return. and we know that our outside return should not penetrate our previous structure high, decide how am I going to enter. I can say, well, if price action touches 83.75, I sell aggressively. So now I've decided what I'm going to do, and then I just have to execute my order. You guys follow me with that? On that process? Yep. Yep, yep, yep. Cool. Those are good questions. I like when you guys do stuff like that. It makes my mind work. Yeah, don't be afraid to ask random questions. I like that type of stuff. Yep. And let me take another sneak. All right. Let's see. Minor structure, finish prediction and trade. Akil, with the three drives pattern, if there is a short period of consolidation between the drives, does that still count as a harmonic move? Yes. Mm-hmm. Yeah. Would you use an extension of the fib for I'm late on some of these questions, so I apologize. I'm not sure if you're talking about this I'll use an extension here to predict where this market may come to. So if I'm saying, say I get short and I'm trying to predict a target level, I would use a Fibonacci extension from this swing high, this is right here, this swing high to this swing low, and back up and predict, well, the next stopping point may be a 127 or a 1618. That's how I would use the Fibonacci extension tool. I'm not sure if that was referring to this question, John. That's how I would use it on here. And this is a great opportunity for you guys to have range bar charts. We look at these in the room a lot. Go down to the range bar charts, maybe get a clearer view. All right, if it wasn't yet, just type it again, John, and just if you can be specific on what it was pertaining to. Again, you guys can see the chat. A lot's coming in, so it's hard to tell what comes to what. All right, not going to get anything on here, so we'll keep it on the 5-minute chart. It was about the highest high. No, I wouldn't look to trade just a Fibonacci extension. You can use that to predict where the market's going to go to, but me personally, structure trading, structure is one of the key points in my trading philosophy, meaning I would say this, to me, structure is the most important thing in the market, to me. That's just my philosophy. That's how I look at the markets. So that means every single trade I take, if it doesn't meet a structure rule, I don't trade it. I need structure in every trade. If I don't have it, you won't see me take it. That's why I don't trade butterflies too much, because they complete above structure, and it weirds me out. That's why I was so timid about trading the cipher pattern when Darren first brought it to us, and he gave it to us to start testing whatever. I'm looking at it, I'm like, this trade doesn't make sense. The cipher here's the cipher formation, guys. For you guys who haven't seen, the cipher looks like this. And we sell right here. So when I first saw this, I'm like, well, no, we just broke structure. Why would I sell? This is stupid. Not that this is stupid, but it doesn't match my philosophy. Now we do have structure here at X, which is key, unlike the butterfly. But structure is big in my philosophy, really big, the biggest thing. Do you use the 1618 fib of the retracement to predict the next higher high? I don't necessarily use the 1618. I have the 1618 and the 127. I'll use both of those to see which one lines up with structure. But I'll use a combination. And you guys, I don't use any one thing. I use a combination of everything. So I like to look for harmonics, fibs, and structure. So in this case right here, if this were going to be a harmonic move, this swing high to this swing low, I would take that, I would drag it on there, predicting that, hey, if we extend an equal way, we'll come down to 83.46, whatever that is. Then I'll take my Fibonacci extension, swing high to swing low, and back up, and I'll say, what do you know? Look at that. Our harmonic move lines up right at our 127, and I put it all together. And I'll look left and say, hey, structure's there too, whatever. But I use everything together. How do you define an impulse leg? Impulse leg, this would be a great example of an impulse leg right here. When the market creates a move that breaks previous structure. So you see our previous structure right here, looking left. Market breaks right past it. New impulse. Jason and I used to say sore thumb high or a sore thumb move, but knowing that that term is not universally used, we're kind of backing off of that. But when you see a move that breaks previous structure, then that can be considered an impulse leg. So this right here wouldn't. Even though it's a move up, we didn't break previous structure, so it's not going to be an impulse leg. This move down, this technically would, because what did we do? We broke previous structure looking left. So that's going to be an example of an impulse leg. Can you show us how to calculate your target 1 and target 2 when trading short in this example? I would use the Fibonacci extensions, Ronald. I would use either structure or fibs. So I would either, if you're a structure-based trader and you're going short, I would look at, where the next structure is at, structure zone's at. We have structure right here. That could be a target level. We have structure over here. That can be a target level. If we keep going down, we have structure way down here. That can be a target level. Or if you're using Fibonacci's, you could use a Fibonacci extension, swing high to swing low, and back up and say, a 127 extension could be target 1. A 1618 could be target 2. We can even bring in a Fibonacci retracement from our previous move, our swing low down here, to our swing high, and say, look at that, we have a 382 from our swing low to swing high. That lines up right with our 127. 2 Fibonacci's in the same point. We have a Fibonacci extension and a Fibonacci retracement and a potential harmonic move all in the same area with structure looking left. Is this the best area to take targets? Basically, guys, target taking is no different from predicting a next trade. If you were gonna predict where the market's gonna go next, would you guys say this is a good turnaround point? This is where the market's gonna run into trouble, I guess you can say, for lack of a better term. Is this the next potential reversal zone right here? Yes or no? What would you guys say? Yes, right? So if you're in a short opportunity, do you want targets beneath that area? Maybe not, right? You don't want, if you're predicting that the market's most likely going to reverse here, you don't want targets below that area because then the market's going to reverse without you taking profit. So the same way you would make predictions for a trade is the same way you make predictions for targets. This is the next reversal zone. Let me get targets here. I want to get some money in my pocket just in case the market decides to reverse. So picking targets is no different than picking basically another trade. If you're a counter trend trader, this would be your zone to look long, right here. We may get a 618 there as well. 786. See if I can catch up. RSI deviation. You mean RSI divergence, Peter? When do we go over RSI divergence? I think that's in. I think we go over RSI divergence when we talk about double tops and double bottoms, but RSI divergence is when you see something like this. You'll see the RSI putting in a different movement than price action. So example up here, and let's take this off again. Let's take the DSR levels off here. Example right here, price action puts in a double top up here, equal highs, right? See that straight line, equal high? RSI on this our initial high is higher than our retest. So we're showing bearish divergence right here because we have a lower high on our RSI, but an equal high on our price action. So don't worry about that too much right now, guys. That's more when you get into double tops and stuff. But that's RSI divergence. All right. Do you see many bear traps where? All right, let me turn this phone off. Gosh, I'll tell you what. You have a birthday and everyone wants to text you late. My sister missed my birthday, so she's been very apologetic. So she's texting me like 20 times. Sorry. Anyway, do you see many bear traps when? Do you see many bear traps where stops are ran then continue higher? I don't really like to use the word bear traps, John. But if you need to put your stops. You can't put your stops one tick above these highs. You'll get stopped out. You got to be smart with them. You can't put them one size. That's why I use ATR based stops, or I make sure to get below structure. I don't get at even handles, but you will see the market push up, often and come to the rookie trader stop levels and stop them out and then run over or roll over for profits. Gosh. When a retracement made new lows on the retracement, do you see it turn around and continue higher? Oh, going back to the bear trap. I'm sorry. Yeah. I mean, you'll see that when the market's in consolidation. If the market's trending, then it'll continue on with its trend. If we're in a consolidation or a channel where market's just not putting in any pattern movement, then you'll see stuff like that. You can't predict that stuff though, so you never know. Kevin said, would that be target 2 at the 127? That would be my target 1, the 127 extension. Depends on your rules on how aggressive you are as a trader though. That would be my target 1 though on this particular trade. I'm not, hey, you better not be trading this, guys. If you don't have a plan, you don't trade this. Let me put that out there first and foremost. Unless you have a secure plan that says, hey, I take this, or if you're taking on a demo account, that's fine. Just to play around and experiment with stuff, that's fine. But please don't trade this with live money, guys. This is just an example. And like we said, we can, I can find any chart, any time frame, and give you a reason to go long and short. We only want to trade the best opportunities. RSI on the 5-minute chart, is that really any good? Yes. If it wasn't good, I wouldn't be using it. Maybe target 2 to shoot for a big win if target 1 is already hit. Yeah, target 1 is your freebie. It depends. We mentioned this in the live room. It's targets are going to be ultimately up to you guys. Target 2 is that freebie, meaning we've already banked some money. We have stops removed the break even, so we can't lose money. If you want to shoot for the moon, based on your analysis, that's 100% fine. You just got to weigh the risk and rewards. If you're shooting for, let me say this, your targets should make sense. They shouldn't just be in random areas. You shouldn't be shooting for, I want to get 100 pips on target 2, so I'll move it all the way down here. They should be at levels where you predict the market to go to. And the further prediction you have, meaning if you're looking for target 2s down here, say this is really far away, the less likelihood you have of getting those hit. And then you got to weigh it up, and this is going to come from your back testing. What's going to be better for me, getting target 2 hit on 10% of each trade, but having it be a really big winner that makes a lot of pips, or having target 2s closer, making less pips on it, but having it hit maybe 50% instead? What's going to bring me more money? That should be the ultimate question. What's going to make me more money? I wouldn't shoot for the moon every time unless, especially in the beginning, unless you do really good analysis and there's something that says that's telling you higher time frame wise that this market's going to continue down. Say this trade was a Gartley pattern on a 60-minute chart. That would be good enough analysis to say, hey, I'm going to shoot for target 2 at my Gartley pattern target 1s. But I wouldn't just pick home run predictions or really big predictions for the heck of it. Because you're going to find that you're not going to be hitting target 2 that much, and that's going to really mess up your risk reward. And on a reversal zone, would you look for the candle formation to continue your trade? If I'm already in it, Peter, no. If I'm already, and Peter's asking, we had this reversal zone down here at the 127 near our target ones, saying would I look for a candlestick formation here to continue my trade? And no, I would once I'm in a trade, I stay in it until I'm stopped out, or I hit targets. So if the market came down here and consolidated, I would just I'd just wait to see what happens. I'd wait to see what happens. The only way I would change that is if I saw an advanced pattern. If the market came down here and for some reason it ended up making a Gartley or something. But I just stick with the trade. I don't. Once I'm in a trade, I'm in it till it's either stopped out or targets are hit. Thank you. ATR is average true range. So the average, make it simple, the average motion of the market over a set period of time. ATR stops, we'll go over this more when we get to double tops and double bottoms, but real quick, I take the ATR of a candle, so the average true range, say of this candle right here. I'm not gonna, again, we're not gonna get too deep into this because that's not this week's topic. I take the average true range, which in this case would be 3, and I would get that many ticks above the high. So I would get 3 ticks above this level right here. But again, that's a topic for a different time. Andreas says, I think it will go for the next even handle because of higher time frame. All right. Yeah, I love using higher time frames in my prediction. I love scrolling down through. I'll scroll. I swing trade as well, so I'll scroll down all the way through from the 4-hour down to down to the 5-minute. Now I don't base any 5-minute trades off of my 4-hour charts, but again, I like to have I really like to get inside the market's OODA loop. I like to know what it's doing, or at least to think I know what it's doing. I was thinking target 1 would be at your next structure level. That's fine as well, Kev. Yeah, guys, and it's going to depend. It's going to depend on you as a trader. One thing you'll learn throughout this course, and it stinks, but I'm really big on it. There is a lot of I don't even know the word for it. You're going to make trading your own. What I'm going to give you, what Jason and I are going to give you, we're going to give you lots of options. We're going to give you so many options, you're not going to know what to do with it. The key is once you understand it, especially when it comes to targets, once you have a good idea of how to trade, it's your back testing and your philosophy, your personality really, which is going to dictate which options do you take. I've had traders that come through the course that are really conservative. They take structure-based stops and targets all the time. They never shoot for extended targets. They never let it run. They want to get off at, say, 382 and get off at 618 and be done. I've had other traders that are really big on extended targets. I have one guy that he always shoots for really big targets on target 2, and he made that his style, and it worked. He's been a very good trader. He's been a very good trader doing that. Do I personally do that? No. But he's made it his own. He's done enough testing to tell him that not only does this work, it is profitable, but it meets his personality. He has a personality. Hey, I'm gonna shoot for this big win. I'm gonna be a little more aggressive. He understands the risk, but he's gonna shoot for that. Andre says, in the end, which ones are more profitable? That's what your back testing will tell you, Andre. I can't answer that for you. When you do your back testing and you crunch the numbers, that will tell you everything you need to know. You'll know exactly what percentage of the time it's hit. You'll know exactly how many pips does it bring in. You'll know what your average loss is. How much am I taking on each loss compared to each win? You'll know you'll know everything you need to know about trading, or about the profitability of your system by the time you've done your back testing. And that's why back testing stinks for a lot of people if you're not a number cruncher. I personally like it. I love back testing until about the halfway point. Then I get bored, but then I know I got to finish. But if you do it right, it'll give you all the data you need. What data provider do you use, Akil? I use Gain Capital. Do you use ATR in 7 periods? Yeah, I use a 7-period ATR. I also use a 7-period RSI. What else do you guys have? Good question today. We're about an hour in already. So again, this thing is as long as you guys make it. As long as you guys have questions, I'll answer it. If not, we can head out whenever you're ready. But ask away. Again, we're 1 week into the trading. I'm excited. I'm excited about this group. We had such a good group at the Technical Trader Workshop. Usually you don't see people hanging on to this stuff. Usually we get a bunch of people that are just like, well, just tell me how to trade. Tell me how I can make money right now. And you guys, or the whole Technical Trader Workshop group, just seemed ready for, they seem more concerned with education and less with money, if that made sense, which is good. When ATR shows 0.1090, how many pips is that? It depends on what time frame you're on. 0.1090. It should be. It depends on what. Not time. It depends on what pair you're at. It should be the last, the fourth and fifth, or the third and fourth number. Unless if you're on the yen pairs, it's going to be a little different. It's going to be the 2 numbers after the decimal, but it should be the third and fourth number. So in your case, it would be. That's going to be weird. In your case, depends on what pairs you're using. Yeah, if that's yen, it's going to be 10 or 11. Akil, can you tell if your trade with one target? Can you tell if you? Okay, yeah, I get you. Can you tell if you trade with one target instead of 2 targets? I trade with 2. Now, just like I mentioned before, when you backtest, you may find out that it also depends on your personality. Again, you may find out that maybe taking 1 target is more profitable than taking 2 targets. There's nothing wrong with that. You don't have to take 2 targets. You may find out that maybe do your backtesting. You're like, this target 2 is just not getting hit enough. I'm just going to take everything off at first targets. There's nothing wrong with that, guys. Nothing wrong. I use 2 targets though, Ronald. I take half off at target 1, half off on target 2. Do you recommend 4-minute, 16-minute, or 256-minute charts? I've never used any of those, so I wouldn't recommend them. I can't personally recommend them. I would stick to the normal time frames though. I would stick to daily, 4-hour, 2-hour, 1 hour, 30-minute, 15, 5. I want to stick to the time frame that most traders are looking at. I don't want to go to 36-minute chart and weird stuff like that. Stick to the one that that most traders are looking on. That way we're seeing the same thing. Do you use the same period on all time frames for the ATR? Yes. Yeah, 7 period on all time frames. RSI, I use 7-period on all time frames except for the range bar charts. On the range bar charts, I use a 5-period RSI. I want a little more aggressive action on that. Yeah. Bob says, can we set up a DSR level on that chart? Yeah. What I'm going to do here is just go to a different one. I'm bored with that. We're on a 15-minute chart right here. So I first, to set up a DSR level, I first go to my my indicator box. I'm going to find my T2U DSR, Dynamic Support Resistance. I'm going to double click that once. I'm going to double click it twice because I use 2. For my first one, this is going to be my major DSR level. And this is recorded, guys, so you can go back and watch this. My major DSR level, I'm going to make sure I set my strength to 8. You can play around with the strength. The strength is going to determine how close the swings are that are measured. So if I go 3, it's going to give me a lot more DSR levels. If I go 13, it's going to give me less. So this is something you can play around with. I stick with 8. That gives me, that's just enough room I need. But if you want more, it'll give you, go lower. If you want less, put in a higher number. So my strength is 8. Colors, you can make it whatever you want. For my time period, for my major, I go 4 times the trading time frame. So right now I'm on a 15-minute chart. I'm going to go 15 minutes times 4. It's going to be a 60-minute chart. I know that because I'm good at math. And that's going to be my period for my major DSR level. My minor, I'm going to change the color so I can actually tell that there's a difference. I'll go blue and black. You guys got to use blue and black or it doesn't work. No, I'm just kidding. Just kidding. Use any colors you want. But for the major time frame, I'll go 2 times, or for the minor, I'm sorry, I'll go 2 times the time frame. So 15-minute chart again, 2 times that time frame is going to be 30. And then I'll click OK. And they shall come on my chart. And you can see if I go back and show you guys the swing, let's say I were to change my swing to 3. Or let's change it to 3. You'll see that I just get a lot more DSR levels on my chart. Simon said, my ATR is 0.0023 on New Zealand dollar. How many pips would that be? It's going to be the 3rd and 4th number, Simon. So 2 and 3 would be 23. The 3rd and 4th number. Yep, so 23. Yep, still 23. Doesn't matter what time frame. It's going to be the last 2 numbers, guys, over here. Unless you're with a yen pair, then it's going to be different. It's going to be the 2nd, or 3rd. It's going to be the first 2 after the dot on the yen pair. Here, I'll go to a yen pair. It's the same thing. It's just the decimals just there, because you won't get, if I go to dollar yen, you won't get 4 digits after the decimal. You see how it's only 2 here? 14, 98, 14 there. If I bring up my ATR, it'll only give me 2 after the decimal. So it would be 0.5 on this. If you look at if I spread this chart out, it'll be the first 2 numbers after the decimal on the yen pairs. Jim says, how are dynamic support and resistance defined? The major is based, when you set those time frames, you're taking the support, the structure levels off of that time frame, essentially. So if I'm setting my major to the 60-minute chart, that's going to represent structure levels, or a structure zone, I guess you could say, because it's between the wick and the close. It's going to represent that structure level from that 60-minute time frame. Then the minor one is going to represent that structure level from that 30-minute time frame. Structure defined from our swings, just like when we're measuring harmonics. Swing high to swing low. or I'm sorry, swing low to swing high. These are both structure levels. Boom, boom. New structure high, initial structure low. Just like running through the charts. New structure high, new structure high. Those swings are all structures. Swing lows and swing highs are structures. Structure level structures. If anyone has FXMC, they have an ATR indicator that tells you the ATR on top of the screen. Feel free. Free tool too. How are we supposed to use the 12-week course? Do we go over the course material before Monday and then ask questions? Yes. Yeah, Jim. Yeah. The course is all laid out. The whole entire course is on there. But the best way to do it is to watch watch the video leading up to that week. So this week would have been week 1, and then question and answers on Monday. So for the rest of this week, now you should be on module 2, not module 2, week number 2, which is fibs and ABCDs, I think. I'm not sure what it is. But you should be watching the second week's video this week. You know, working on getting that RES built in the live room, working on scrolling through charts on your own, and then next Monday we'll come around and answer those questions. And it's really up to you. You can do this as well. You can stick to structure and harmonics this week all to the live room, and then over the weekend, say Saturday, Sunday, then you watch the fib video, and then come back on Monday and ask questions. But Monday is going to be a recap, a Q&A from the previous week. So it's going to be a little different. Last year, we actually did all the training on Monday, but because the training is pre-recorded for you guys, we think it's going to be a little better this way because you have a chance to review it over and over again and then come back and clear up any questions you have. Do you leave the strength at 8 for minor as well? Yes, I keep the strength at 8. And again, you can play around with that depending on, you know, how many, I don't want to say false signals, how many or little levels you want to have. But 8's a good point. That's right in the middle. Do you use 2 times ATR above the high candle for stops? Yes, for certain trades, yes. ATR setting is 7, correct? Yes, it is. Would you comment on major and minor structure? How do we use it? Well, if you're a structure-based trader, you can use it to trade. We use it to predict where the market is most likely going to go. So just like our New Zealand deal here, you can see we came right back into, if I bring my DSRs back on, we came right back into our structure level. If you, where is this? 5-minute charts. I need that to be 10. If you're a counter trend trader, you're looking to sell or buy at structure levels, predicting a potential reversal. If you're a trend continuation trader, you're waiting for structure to be broken to give you confirmation of the trend, and you're looking for a retest of that structure level for a chance to hop on the trend. So just like this right here. Came right back in the previous structure. But structure acts like a magnet, guys. Price action wants to go towards it. It wants to. Andre says that is what's missing. Training layout plan. Well, we told you guys in the beginning. We can add that on, but it's one week at a time. Akil, you mentioned earlier patterns work great during periods of consolidation, but aren't XA legs meant to be impulse legs? Yeah, they are, but they can happen inside of consolidation. What did I put on my chart here? Sorry. You could have impulse legs inside bigger periods of consolidation. Yeah. Yes, Mondays are recorded. So again, I mean, examples right here. Look at this. This is an impulse leg right here, but we don't have a clear definition of the trend because we're basically in the consolidation period right here. on New Zealand dollar. Watching the live room makes you want to go faster, but trying not to. Yeah, that's the one. If there was an Achilles heel of the program, that's it. But I think the value of the live room is I think it's greater than the temptation to want to go faster and do more. And like I said, as you get deeper in the course, as you start getting to week, especially week 6, 7, 8, 9, those weeks, that live room is going to be so much more helpful. So you would just identify a minor impulse leg as such. Yeah, well, I don't. It's not a. I wouldn't say. I wouldn't define a impulse leg as being major as minor. It's either an impulse leg or it's not. So this is still a valid impulse leg right here. We broke this structure level. This is a valid impulse leg. Yeah, it's a small one, but it's no major or minor. It's an impulse leg. But you can see they occur. Do I have an example? I'm gonna go 60-minute New Zealand. I'm trying to remember if I had any markets that were in consolidation that had patterns in them lately. Let's see if New Zealand 60-minute has anything. Raphael said, "Will we take a 10-minute break?" Probably not. I think we're almost done with the training. Questions are starting to dry up a little bit, so we'll just finish up. See if I can find anything in here. There's no patterns in here. But a good example would be this. I mean, you see, we have an impulse leg right here, but we're within, just the market's within. Overall, just a period of consolidation. It's a horrible line, but you guys get what I'm talking about. The market's in consolidation, but there are impulse legs in here. Boom. Looks like that maybe that might be anchor leg. Boom. One right here. But overall, there's no clear direction of the market. We're just consolidating. And like you can see there's patterns all up in here if you look closely. But we're not worried about patterns yet. But yeah, we'll finish out before taking our break. I think we'll probably go about 10 more minutes. Extensions are taken off what leg? Extensions are taken from impulse legs, impulse or anchor legs. So I would take an extension from if I were predicting where the market after this leg was going to go to next, I would take a Fibonacci extension from this swing low to this swing high and right back down to predict where the market's going to come to next. What a coincidence, it comes right to 127 and reverses. Yep, but the swing low to swing high, the impulse leg, or obviously if we're going the opposite direction, the swing high to swing low. Do you take trend continuation pattern trades? Yes, I trade all patterns, meaning I trade patterns whether they're with the overall market or against it. An anchor leg, here we go. Yeah, that's a good question. An impulse leg is going to break previous structure. So it's going to be something like this. Creating a new structure high, breaking previous structure looking left. That's an impulse leg. An anchor leg is not. It's going to be a sore thumb move, but it's not going to break previous structure. So something like this. This is a clear downward move, right? Would you guys agree? Give me a yes, no. This is a clear downward move. It stands out. It's a sore thumb move for you guys to understand that term. But if we look left, I don't think we break and close below structure. All right, we actually do, but let's pretend we didn't. Sometimes you'll see this hold at structure level. So this would be, and again, we're assuming this doesn't break and close below the structure level. This would be an example of an anchor leg and not an impulse leg. and they can both be used for pattern recognition. Now, it's not going to give us a clear direction of, it's not going to give us a new structural low, so we can't say that the trade's in either bearish or bullish rotation, but we can still use it as an anchor leg for a pattern. Same thing with this right here. This looks like a cipher pattern right here. You can see, if I zoom in, this leg never breaks the structure level. Yet it's still a valid X to A for a pattern. And that does look like a nice cipher pattern. That's when we got in the live room. We made money off this. Yes, I remember. So the easiest way to do it, guys, is scrunch up your chart and just look for those moves that stand out. Look for those sore thumb moves. Scrunch up your chart like this and say, look at this, boom, or boom, stuff like that, and just keep practicing it, and your RAS will start to, as you get better, your RAS will start to pick up, the reticular activating system will start to pick up moves that aren't as clear. But I would just worry about the clear moves right now, guys. You're just going to confuse yourself. Worry about the clear moves. Okay, just understand how just to confirm, I understood how your Monday sessions will work. Maybe some doubt from Andre P. We have, excuse me. Yes. Today's questions should be related to the week one's topics. Yes. Yeah, you're right. Opposite, Ian. You could use anchor legs or impulse legs for patterns. For trend continuation, you need an impulse leg because you need to get that break of structure. For a pattern, you don't necessarily need the break of structure. To identify a trend, you need that break of structure because this is going to be our new structure high. I would say euro dollar finally hit target 2, did it? What am I doing here? Oh, heck yeah. Here we go. I don't have my fire up song here, do I? I don't. I got this though. Nice. All right. Anything else, guys? Yes, they could be. Yeah, outside returns are anchor legs, and yes, they could be anchor legs. Yep. Because they don't break previous structure. Yep. Look at that, made some money. Back to backs on euro dollars. Look at that bat pattern too. I'll enter that after this thing's closed. All right, looks like we're done on questions. I will see many of you in the live room tomorrow then. I would get started on week 2 video if you feel comfortable with this stuff. And just continue the learning process. With range bar charts, how far back in history do you go? I load up about 3 days, 5 days maybe max. I may have 10 on this chart. Yeah, I have about 10 days on this chart. I really don't need that many actually, but 5-10 days. If you try to load up too much, you'll run the issues. Next Monday we have to review and practice. Yep. For next Monday we're going to be taking questions from week 1 and week 2. Week 1 and week 2. So if you still have issues with harmonics and how price action moves and structure, that's fine to keep asking. Each week builds on the last one. But Fibonacci's, ABCD patterns, that will be week 2. And again, it's slow at first, guys, but once once we get past really once we get past this next lesson, it starts to speed up some when we get into double tops and it starts to get a little hectic. Double tops and then CTSs and then 2618. Oh gosh. Anchor legs happen within consolidation but aren't new highs. Anchor legs don't create new structure highs or new structure lows. Where do we log in tomorrow? The live room. The live room link. That same link. Or that same room. The room that we used last Tuesday through Friday. If you log into this room, you'll be in the wrong place. No one will be here. Yeah. I think half the people didn't watch that, Darren. I was getting questions all week. How do you do this? I'm like, did you watch the new orientation video? Did you? So Darren spent an hour going over everything you need to know. It's up there. Just keep watching it. I don't know how to access this. Did you watch the video? No. Well, that's why. Was the Kiwi 5-minute a 2618? Probably shouldn't even look at this. Yeah. Yep. All right, gang. I will see you guys tomorrow in the live room. Take care. Train those eyes. Get used to this stuff, and I'll yeah, see if we can make some more profit tomorrow in the room. All right. Take care, guys.
All right, gang, good morning. Can you guys hear me loud and clear? Small group. Thank you. Thank you. Well, welcome. Today we are going to talk about back testing. I was contemplating actually. I was thinking about doing a trade plan development first. 'Cause I always it's the chicken or the egg type deal about which is more important. Do we know how to back test first because we can't back test without rules, but then should we do trade plan development first because that's when we write down our rules, and decided to do back testing just because, well, it was first on the list, and I know a few of you probably already watched the video. So we're going to stick with that, and we'll go to trade plan development next week. But they kind of work hand in hand, especially with trade plan development, because that's something that kind of like your trading journey is never completed. You kind of just you go back every once in a while and edit and adjust and change. So we're going to do back testing today. Should be a fairly simple lesson, yet a very important one. But before we get started, I want to know are there any questions you guys have with anything up to this point in the course? We've essentially covered all of the technical side of things. We went over Fibonacci's, we went over price action, structure, simple patterns, advanced patterns, and now the rest of it is just the behind the scenes work. Again, back testing, the trade plan development, the money management will be a big one. That's going to be one I got to talk to Jason about. He usually does that one because he's a lot better than I am with money management. But again, most of it's the behind the scenes stuff. But as you guys probably know by now, it's the behind the scenes stuff that really makes the difference between the successful traders and the floppers, the ones that fail. Real quick, pound dollar. What are we doing here? That was already completed. That's hopping down here. You guys may want to check out pound dollar. This is kind of off subject, but pound dollar. I think we talked about this in the live room on Friday. The butterfly pattern that completes out of nowhere. So never mind. I'll come back and look at that a little bit later. But yeah, any questions up to this point on anything technical or anything we went up anything we went over thus far in the transformation. I was doing a little eavesdropping through the chat form this morning. I see some of you are having a good week already. So that's always a good start. Last week I had the opposite. I had a pretty, I don't want to say bad week. Went into some drawdown to start the week and then made up for it and much more. So hopefully I'd love to get another consistent week. That'd be setting up for a potentially very, very good month. But I know some losses are bound to come. I'm at about the top level again. I usually don't get more than 60% as a trader, and I've been about I think I've been about 62 over this month so far. So I'm expecting. It sounds negative, sounds pessimistic, but it's just the way I am. Prepare for the worst. I'm expecting a rough week to come at some point to bring me back down to that 60 or high 50s level. Mark says, I've got a question. My bro mentioned to me yesterday that Jason has slightly different rules on guard patterns. He said the C leg couldn't hit the 886. Are these just his rules? I did get that question from a trader emailed me that question too. It was if you guys watched the constellation video Jason just put out, he mentioned for the Gartley pattern that that it couldn't hit the 886. I don't know. That's a question you're gonna have to ask Jason. So I'm not sure. Again, I don't know. If I had to say a guess, it could be that because it was a real quick video and he didn't want to get too detailed in it, maybe he just shot that out. But I'm not sure. Maybe his rules has changed with some back testing he's done. But that's something to ask him in Wednesday's private client group meeting. Yeah. Again, my guess would be either one of two things: either that he's done recent back testing and saw that doing that gave him slightly better results, or because it was a quick video, and I hate to say this, but it's a quick video to you guys aren't the general public anymore. You guys are on the inside. Maybe because it's a quick video to the general public, it's we don't take as much time when we do our free stuff to go into exact details about it. So it's a lot quicker that way. I'm not sure. Yeah, so it's gonna be over the private client group discussion, Darren says. Good. But you know what? That's a perfect question leading into our back testing discussion today. So we'll think about that. Denny says, can I ask about a pair? Sure, we can do that real quick and then we'll get into it. He also said patterns. Matt says he also said patterns from off anchor legs. He didn't mention impulse legs. Anchor or impulse legs, either one, are valid for patterns. Yeah, it doesn't matter. We usually teach impulse legs at first because they're easier when a trader is just learning, like you guys in the beginning. But anchor legs are fine as well. Target setting for CAD yen. I saw a butterfly 1 hour X at 94.77. If we enter this butterfly target, it's supposed to be the 3D2 retracement. However, the X leg, there's a strong resistance level. Should I go with the 3D2 or should I adjust to the strong resistance level? You're going to hate this answer, Denny, but that's up to you. That's got to be a personal decision. I would say this, and I'll try to bring up. Oh no. I really can't answer that question for you. Initially, I would say this: what do your rules say about placing targets? I'm assuming your rules say what, 3D2? If your rules say 3D2, I would go with 3D2. Now I'm going to bring it up, and this is as you evolve as a trader here. As you evolve as a trader, it's going to depend on a lot with your philosophy. If structure is important to you, you may want to think about adding a rule that says if there's a major structure level, I default towards structure. Give me a second to load it up. All right, so butterfly pattern 1 hour. CAD yen. So you're looking at basically X to A to B, B to C, C to D down here. Is this the one you're looking at? Yep. And you're saying that initial targets, we're looking at Fibonacci retracement from swing high to swing low. You're looking at 3D2 right here, right? And you're asking what? If you should take targets off at structure right here, this blue line? Yeah. I would say no. I would say no, because technically, and again, depends on your, if your rules say that you were to take targets off at the 3D2, then I would stick with that. Now here's the thing with the butterfly pattern. We talked about this last week because our butterflies form like this, right? Or let's back it up some. When we get a pattern, we know what? We start off with an X to A, right guys? X to A could be what? It could be an anchor leg or an impulse leg, right? Because it's an impulse leg, we know it's a sore thumb swing high to swing low in this case, which means X acts as our structure point. With all our patterns, X is our structure level. X is usually, in most cases, always a significant level of structure. That's why it's our X leg. With most patterns, we use X as our safety net for stops, meaning that we put X above stop, or we put stops above X because X is our structure level. We also know with the butterfly pattern, crab patterns too, or shark patterns, let's say, we're going to get a completion of D above the X leg, which means that every time you take a butterfly pattern, guess what? You're going to have to fight off structure right here, every time. Now, sometimes it may be minor structure. Sometimes it may be a big consolidation area like this. But no matter what, when taking a butterfly pattern, your targets are always going to be, if you're taking 3D2 targets, your targets are always going to be below this structure level. So essentially, every time you take a trade, you're going to have that same dilemma, Denny. Now, I would say this. I would say that the chances of price action hitting our X leg, of hitting our X leg and bouncing up, they're going to be higher than the chances of price action coming down to our 382, getting you targets and bouncing up. So there's a higher percentage chance of price action coming into the X leg and reversing at that structure level, just like we see with many trend continuation trades, than there is of price action going past that structure and going to the 382. Now the problem is this. What's your where's your stop loss at for this pair? $94.01. So we're looking at $94.01 right here. And you entered at, what was your entry at? $94.40. All right. So we're looking at a stop of about this. And we'd be looking at, if we're taking structure here, we're looking at a target of about this. So you can see the issue with taking that X leg, even though it's a safer place to take, to take targets at, you're going to get an inverse risk reward. So what you're going to do is you're going to have to make a decision about your rule. Because again, it's not going to be, sometimes it's a judgment call whether you take profit that structure or a Fibonacci level. It's going to lay mostly on what's on your psychology. For me, structure has more power over fib. So if there's a area where, there's structure and a fib, I'll take the structure level over that. But in this case, we're going to, in a butterfly pattern, you're going to consistently get this dilemma. So every time you trade a butterfly pattern, you're going to have this same question. So you're going to need to have a definitive rule, whether it's taking it at the X leg or waiting for the 382, or there's a hybrid version. You can say, hey, if it hits the X leg, I've moved stops to break even, then I wait for the 382. And what's going to determine which one to take is going to be your back testing. Now, we always talk about having a one-to-one risk reward, right? Because that's, we want to have an average that on every trade. But as you know, it has a lot to do with the expectancy of your pattern, your setup, and the pattern itself. The cipher pattern, when I trade the cipher pattern on most time frames, I usually get, let's say if I'm trading a cipher pattern on the 15-minute chart and below, I'm rarely getting a one-to-one risk reward. I'm probably on average getting something like this we see at the butterfly pattern. However, I know that the cipher completes at such a high percentage that it's still profitable even though my average risk is more than my average reward. What you would need to do with the butterfly pattern is if you're thinking about taking targets at X, the structure that lays at X, and you're thinking about having an inverse risk reward, you need to go through your back testing and see what the expectancy is. Because who knows, the butterfly pattern may come back and hit X at such a high percentage that it makes it worth it. You follow me, Denny? You may do your back testing on your butterfly pattern, and it may show up that the pattern only wins 50% of the time. It only comes to the 382 50% of the time. So if it comes to the 382 50% of the time, it's not going to be profitable. Well, it's, if the risk reward is good like this, it'll be profitable. But you may find out that it comes back to test the X leg 70% of the time. And let's do some math. Let's say that your average risk reward is reversed. So we got 10 trades. We got 10 trades. We're going to have 7 winners, 3 losers, right? Let's say our average winner is 10 pips, just to make it a simple number. Let's say our average loser is double, let's say 20 pips. So we have an inverse 1-to-2 risk reward, right? 7 winners, 10 pips. What's that going to be? 70 pips. 3 losers, 20 pips. What's that going to be? Minus 60 pips. You can see still profitable taking it at that X leg. You guys see that? Still profitable taking it at that X leg. And your back testing is what's going to give you these numbers. Now, if you do your back testing and it's slightly off, let's say your average risk reward is the same, but we now go from 70% to 60%. Sorry about that. That may be the difference in a profitable pattern versus a not profitable pattern. Now you're only banking 60 pips on every 10 trades. You're losing 80. A 10% difference in win percentage just turns your pattern from a profitable pattern to a non-profitable pattern. So I would do this, Denny. I would back test both scenarios, crunch the numbers, see what consistently works better. But it's not going to be for this particular setup for a butterfly. It's going to be hard to get. It's going to be hard to make a judgment call just because every time you're going to run into this dilemma, every single time with the butterfly pattern. So this one you want to have a set in stone type rule, and you may just have to deal with some pain. If you're going to take the 3-2, you may just have to deal with some pain. Akil, have you ever tested the crab or shark pattern? Are they any good? I have not. No, I have not. I can tell you. I can tell you I don't like the shark pattern. Same reason I don't like butterfly patterns. I don't like patterns that complete above the X leg. Or is that I get those two confused. With the crab pattern, if I remember correctly, the area of the area of completion is just it's so vague. It's a very, very big range, which, I don't like very, very big ranges. So I've never looked into them. I don't know if I would assume they're profitable because they're widely known patterns. I would assume if you trade them the right way. So I'm not bad mouthing them. I don't think they're bad patterns. I just never personally tested them, and I probably never will. I think three patterns and all the structure stuff I do is enough. I don't need to add 5, just blow my mind up. Any questions about what we just went over here about the butterfly and the 2 different levels? That was a very good question, because it's do I take structure? Do I take fibs? Edgar says, can Denny trade it as a double bottom but use butterfly targets? Would that be a good idea? Yeah. You can enter it as a double bottom. Yeah. You could say that, hey, my butterfly completes around this area, but I'm not a butterfly pattern trader because there's really no place to put stops at. So I'm going to take it as a CTS score. I'm going to go through my CTS system. CTS system is going to give me, I'm not going to get structure, but I'm going to get ratio because we know it's a butterfly pattern completion. I'm going to get RSI oversold. I'm going to get double bottom. I'm going to get RSI divergence. I'm going to get a advanced pattern. I'm not sure if we have an ABCD pattern here or not. We may not. I'm going to use ABCD pattern as well. And I'm going to trade this as a CTS type score. Structure-based trade, looking at a CTS score of 1, 2, 3, 4, 5, 6, 7, 8, 9. Now I have a CTS 9. I can trade it. So you don't have to trade it necessarily as a butterfly pattern, but you can trade it as a CTS score. Again, a counter trend type opportunity. You can get a very high score here. Now that involves a little bit more patience because you got to wait for, depending on your entry technique, you may have to wait for double bottom, wherever like that. But now it's a CTS trade. Now you have a place to put stops. Again, usually stops on this would be, there's no man's land to put stops. Now because you have a double bottom, we know we have rules for how we put stops on double bottoms. ATR, stops go right here, boom. And if he wants to trade it, if he wants to trade the targets based on a butterfly pattern, then that's up to him. Generally, for a double bottom, you would take this last leg, swing low to swing high. You look for a 3D2 here, which happens to be right at the structure level. Coincidence? Look at that. But he can say, I'm going to take extended targets based on, the bigger picture. Yep, no problem. Anything else? What's buzzing on the trade floor? Jason says, I'm long that pound yen cipher. Akil posted. Oops, did I get long that? Uh-oh. Hold on. What pound yen cipher? Oh man, did I miss that? 1 second, guys. I think I forgot to put orders on here. Darn. Yep. Too much time posting to the syndicate. Forgot to put orders on for this one. I think. Unless I did it in a different account. Nope. That sucks. Oh well. It happened. Let's talk about some back testing. Matt says, do you ever mark out session times on your charts, Akil? If so, how? What do you mean by out? What do you mean by out session? I'm not sure I follow you on that. Oh, do I mark off the list the different sessions? No, I don't. If you do, if you're on NinjaShare, just take F7 and do something like this. Just draw a dotted line in. Just draw a dotted, just F7 will draw a dotted line like that, and you just measure it out like that. I did some testing on that once, trying to look into highs and lows of different sessions, and I never got too far in it. But I would just do it manually like that. Yep. I'm sure if you're a developer, you can make some type of coding system to color it different sessions for you, or different colors for you. All right, so back testing is probably the most important part of our trading journey. It's what's going to give us, it's not even about the statistics. Statistics that's very good for tweaking a system and finding out what's the most profitable way to trade it, what's the most effective way to trade a certain strategy. But the key to backtesting is really training that RAS, reticular activating system. We talk about, you guys had the issues in the beginning of our training about not really being able to find stuff. Hey, I'm having trouble finding bat patterns. I'm having trouble finding impulse legs. Well, backtesting will solve that, because with the amount of testing that is required to do before you trade, you're going to see a bat pattern, Gartley pattern, double bottom, whatever you're trading. You're going to see it so many times that you're going to be absolutely sick of it. Trust me. If you're not sick of seeing it, it means you didn't backtest good enough. And I'm talking not hours, but you should be spending days and weeks backtesting. I think I used to go hardcore with my backtesting. It used to take me about 2 weeks minimum to get backtesting out of the way, and that's me staring in front of my computer 8 hours a day. Matt said, I'm finding that I can see more patterns emerging far more. Yeah, because again, it's trained to reticular activating system. It starts to pop out for you. You see something enough times, your mind just catches it. It pops out. It's like Where's Waldo books. The first time if you guys aren't familiar, it's a book with a lot of things on it. You're supposed to pick out this one person, this one thing. And at first you're looking at it, you're staring at it for hours, like, I can't find it. And then once you find a little guy, the next time it's so much easier. Same thing here. Here's my thing. There are cops that have these little hidden hideouts on the highway I drive. Right? Whenever I go home to Philadelphia, they're in the same spot every time. Automatically pick them out like that, because I drive that way so often. So the more you see it, and I'm talking hundreds of trades. And I always tell people at minimum, and I know Darren says you should do it. Darren says you should backtest until you're dreaming about it, and you're talking about it in your sleep, and your wife or your significant other gets mad at you. That's how much Darren says you should backtest. I think that's a good plan. But I would say at minimum, that's why we don't name any. That's why we don't name these patterns after we don't give them female names. We'll get in trouble. We'll get in big trouble doing that. But I would say at minimum 100 trades per pair per time frame you're looking at. So if you're testing the cipher pattern on the 60-minute chart, the hourly chart, I would start with euro dollar. I would find 100 trades on euro dollar at minimum. 100 trades. Don't stop until you find 100 trades. Now, if you're trading higher time frames, 4 hour, it may be hard to get that many trades depending on your data. So what you want to do is you can make like a yearly, I guess, zone. You can say I'm going to start 5 years back. That's what I usually do for the 4 hour charts. I'll say I'm going to test it within the last 5 years. And the higher time frame is going to be a little harder, because you're not going to get, you may get one pattern a month if you're lucky on a 4 hour chart. So you're not going to get as much data, and you just got to do more and more pairs. But at least, I would say at least 100 opportunities per pair before it really starts kicking into your mind. Do you have an example? Do you have an Excel example for backtesting? Yeah, we're gonna make one today. Danny says, I'm confused. I'm more confused on which pattern I should take. Too many good ones. Matt says, I'm putting 2,000 days in each Ninja Trader. It goes back about 5 years. Work forward from there. That's what I do. Depending on the time frame. If you're on a 5-minute chart, guys, you don't need 5 years. If you're on a 5-minute time frame, you can probably do about 2 years and you'll get enough. You know, there's lots of opportunities on there. But probably want to go back about 5 years on the higher time frame stuff. At least 3 years minimum. But you can see on my screen right here, I have a lot of different spreadsheets up. Now, I'm not even sure which one, if it's up there already, Darren, or which one we're going to give them. I know we have new money management and backtesting spreadsheets coming out, but there's a few of them here. I've got this one is more money management. We don't need to worry about that now. We'll worry about that at a later date, but just showing you some of the stuff that we do have. We have a money manager spreadsheet here. Where you can enter stuff, track stuff, really put it into an equity curve, kind of like what we talked about on Friday's session about making your account grow. You've got, this is an older one from our mastermind group. Backtesting review, stats, all the fun stuff. I think you guys have this one. I personally don't use this stuff for backtesting because I test a lot of things when I backtest. I personally don't use these, and I'm not good with editing other people's Excel stuff. But we have this right now as well. This may be the one you guys are getting. Yep, Darren said this one right here. But you can see it looks fancy. It looks nice. Feel free to use it once you get, if you're a big Excel person, feel free to use it, edit it, break it down once you get going. I prefer to take a blank Excel spreadsheet like this. And again, this is me. I really, if it didn't take too much time, I'd rather have a pen and a paper. I prefer to take a blank Excel spreadsheet like this and start from scratch and really make it your own. I don't like following what other people have on there because I like to test a lot of things. And some of you that email me, you notice. So right now, let's talk about some stuff. What are some of the things you think we should look at when it comes to backtesting? Type me in a few ideas. If we're creating our own backtesting spreadsheet from scratch, what are some things that are important to look at? First thing, right? Deciding what the pattern. Deciding what is the pattern. And my advice is, again, test one pattern at a time. When you're doing your back testing, don't go into the back test and say, okay, I'm gonna test Cypher, Bats, and Gartley's. This is gonna save you time, but it's really good to isolate one pattern at a time if you want to build and grow that RAS. So I would say one pattern at a time. So say for this back testing, it's going to be Cypher pattern only. Cypher pattern only. Next, you guys say date. That's important. What else? What's more important than date? What are we forgetting here? Unless someone wrote it in. Date's important. Time's important. We'll get to that. Entries are important. Profits, yeah. I think we may throw profits and losses out there. What else? What else are we just talked about? Time frame. That too. Something. There we go. Ray got it. The pair. What pair are we doing our back testing on? Again, we want to do one pattern on one pair on one time frame at a time. Pattern, pair, time frame. And guys, I'm gonna write them out in random order. I don't care what order you have this stuff in. It really doesn't matter, as long as you have it in there. Honestly, when I create my sheets, I don't even put in these two because this is a given. I'll title the entire thing, euro dollar cipher pattern 60 minute, or I'll create a tab down here and that says euro dollar. Got to do it one at a time. So it doesn't matter what order you put it in. But you want to have, again, one pattern, one pair, one time frame. Next, you guys mentioned it. We do want to have the date on there. Very important that we know the date of the trade. And the reason for this is when I did my back testing, I never kept track of the date of the trade, the date and the time of the trade. Yeah, you can put time as well. I never kept track of the date and time of the trade. And why do you, I guess, why do you think this came back to bite me in the butt? And Matt kind of already mentioned it. Yeah, so you can find it. And what I would do is when I first started back testing, I only back tested one thing. I back tested euro dollar cipher pattern 60-minute chart, taking targets at 382, taking targets at 618. This is just an example. And then guess what? I'd get about 100 trades in. I'd get a good portion through my back testing. I'd scratch my head and I'd be like, you know what, Akil? What if I move my stop loss 5 pips back? Because over these 100 trades, I noticed that there's a lot of instances where I would just get stopped out in the market reverse. What if I moved them 5 pips back? And then guess what I'd have to do? I'd have to go back and do the entire back testing over again, because guess what? I didn't keep track of where any of the patterns were. So I'd spend 2 weeks back testing, only to go back, add one little filter, and then do the whole thing again. And then silly me, I would still never do time. And guess what? I'd do it again. And I would back test 4 or 5 times. I mean, it helped with pattern recognition a lot, but I would back test 4 or 5 times the same thing. And if you have that time on there, even if you leave the drawings up on your chart, if you have the time up there, time and date, you can go back. It makes it easier to find particular situations. So we want to have time and date on there as well. Next, we want to put entry price. Where's our entry price at? We can make this, let's make this a different color. We want to put entry price. And we just, let me answer some questions before we go on. Yeah, I do the same thing, Danny. When I do pair, I'll just do a different tab down here, and I'll have every single pair like that. But again, just giving an overall view of what the main thing is. What's needed. This is what's needed. It doesn't have to be this exact way, but what's needed. Also, what if one pattern is playing out and another is forming within it? Do you let the first complete and then continue in the charts, or do you go back and include the second one? For the pattern results too. If it's 2 patterns completing at the same time frame, on the same time frame, I would do this. If you already completed one, if you're already in one trade and another one's forming inside of it, ask yourself this question: if I were trading this live, what would I do? And what Matt's asking is something like this. If I can bring another chart over. Say you're back testing. Say you're back testing and you see something like this. Boom, Gartley pattern completion like that. However, maybe inside the Gartley pattern you see another Gartley like this. What do you do? And again, ask yourself, what would you do if you were trading? If you were trading, you would probably take the first pattern that develops, right? So I would base it off of this pattern. Now, if this one breaks out, you know that you would then be entered this one. So then I would add it. So you got to think about it. If you were trading live and this happened live, how would I handle that? And that's how I would take it. I'm still wondering about that. If I'm inclined to let one pattern play out, then look for new patterns, not try more than one at the same time. Well, if you're in a trade, you shouldn't exit. You should let it. You should be in that trade until it plays out. Now, if that trade is stopped out and then another one forms right after one, and then you're in. But once you're in a trade, you're in that trade. You shouldn't be worried about anything else. Now, you'll rarely see that on the same time frame. Usually, that's if you're doing multiple time frames. But again, whatever trade you're in first, that's the one you should be looking at. So we got entry price. For some of you, you may need entry reason, and we're looking at we're specifically talking about patterns right now. Entry reason is going to be more important if we do CTS stuff. But entry price, where's my entry price at? 1000. Entry reason, limit order, lower low, lower close, double top, pin bar. What was your entry reason? Again, with patterns, most of you are doing aggressive entries. Most of you are just saying a limit order at D. But in some cases, like the example Denny brought up earlier, well, Denny waited for the double bottom to take the butterfly pattern. So if he's testing butterflies and his rules say that I cannot take butterflies, or I don't take every butterfly aggressively, because it does depend on structure, then he's going to want to keep track of why he's entering. So double bottom, higher high, higher close, pin bar, doji, whatever those reasons may be. Again, what I like to say for backtesting is you want to think of every single possible thing that may occur while you're trading, and you want to keep track of it. Again, we don't really need this for cipher patterns, bats or Gartleys, but for butterfly pattern, a question may be structure. Was there structure at the completion? Yes or no? Again, ciphers, we have the X leg. Gartleys, we have the X leg. Bats, we have the X leg, so we don't need this. But was there major structure? Something else you may want to keep track of. And I'm bouncing all over the place with this stuff, but something else is higher time frame confirmation. Some of you have been thinking about only taking patterns if they complete with the underlying trend. Well, something to test out. Something to put there and something to put, and we'll add this at the end. Was it with the overall trend? So when you crunch your numbers at the end of the back testing, well, maybe you'll be able to understand if I take patterns with the trend, there's a better win percentage as if I take patterns that are counter trend. So that's something you want to add in there too. And this stuff should probably be at the end, but again, I'm all over the place with this stuff. CTS score later. We'll do that for CTS-based trades because it's going to be a little different. But let's get through this on patterns. We got pattern, pair, time frame, date, the actual time of the trade. We have our entry price. We have our entry reason. Stop price. Stop reason. All right. Where's our stop at? What is our reason for stop? 10 pips above X. 113. Previous structure. ATR. Why is our stop loss there? Next, same thing. Target. Target one price. Target one reason, meaning where's my target one at? Is it the 382? And we can do the same thing for target two price, target two reason. Matt says, something I'm doing for backtesting is getting each pattern I find unique number like 0001. Then I do a screen grab of completed pattern from entry to exit, save the picture with the same number. Good for looking over it in the future. NinjaTrader has a save image or right click. Very quick. Yeah, good idea. Good idea. All right, so we got pattern, we got pair, time frame, date, time, entry price, entry reason, stop price, stop reason, target one reason. Next, we want win, loss, we want to have profit, drawdown, target one profit, and target two profit. These are the stats we're going to pay attention to. Win, yes or no. Loss, yes or no. Profit, how much did the trade bring in? Drawdown, how much did the trade lose? What was the profit target? How much profit did target one bring in? How much profit did target two bring in? And what's important, guys, when you're originally doing your back testing, you want to start with an initial idea of how you're trading. So we're going to test a lot. We're going to get into that in the next little section here. You want to test a lot, but you want to go in with an initial plan. So if you're a cipher pattern trader, your initial plan is, I trade cipher patterns. I do aggressive order at the 786. My target one is 382. My target two is 618. My stop loss is 10 pips above X. You go in with your initial plan of what you want to test, and that's how you keep your main statistics on here. Now, after you get this stuff done, then you can add a section where you can test other stuff. You can have a section specifically for targets where you say, okay, well, 382, 50%, 618, 786, and whatever other potential targets you want to test. In this area, this is where you want to keep track of the other possibilities. Would the trade have been a winner if it hit the 382? Did price action roll over and hit the 50%? Did price action roll over and hit the 618? Did it hit the 786? Now I should have added this in here, but not only did it hit it, but then what profits would have been gained off of this? So this really should be 382 profits. This should be 61.8. This should be 61.8 profits. And so on. Do you guys follow me on this point, on this part right here? This extra section. This is the main section right here. The extra section right here is where you do your extended test. And this is where someone like Ray is doing this right now. Ray's testing 50% profits. And I'm not typing all of them in because you guys are smart enough to get the point. But in this area, I would advise testing every single profit area. Testing every single profit area. Geronimo, I would put in trades not filled in the sheet. I don't think you need to do that. Why would you? If it's not filled, it's never a trade. So I wouldn't. Oh, are you talking about Are you talking about like trades that spike down like with like 1 pip before? Because if it's not filled, it's not a trade, so we don't need to track it. So I don't think you need to track that stuff. You can make a mental note. 127 not. I'm not sure what you mean by 127 not filled. Because if the trade wasn't filled, then it wasn't a valid trade. So there's no reason, it just wasn't a completed pattern. I'm probably misunderstanding you a little bit though, but if you can type it in, I'd love to hear it. $786 isn't a possible entry. It's not. The entry is the 127. Now, if you have two different entry reasons, well, you need to decide where you take it at. I would say that you just need to decide where you're taking it at. Are you going to trade at the 127 or are you going to trade at the 786? And what you can do with that is you can just test. You can just add an extra spreadsheet for one that would have been. He's talking about the Gartley pattern where he's saying maybe the 786 is an entry, maybe the 127 is an entry. Now my view on that is there should only be one entry. I personally trade the 127. Some people personally trade the 786. I don't really care which one you trade. No, the 127 is the entry. The 127 is the entry. But if you have that dilemma, if you're torn between, well, do I take it at the 127 or do I take it at the 786? I would just backtest those two occurrences separately and compare them. Have one set of backtesting based off the 127. Have another set of backtesting based off the 786. Yeah, but I would test those separately. I would test those separately and then compare the results. But this section right here again, all possible profits. All possible profits. Again, 3D2, 50%, 707, 618, 786, 127 inversion, whatever you want to test for profits. B leg, retest the B leg, retest of the X leg, like Denny mentioned earlier. I will put this in this section over here. You can do the same thing for potential stops as well. You can say, well, if I used a 113 stop, would that have been hit? And if so, what would be the results from that? If I used a 1 ATR stop, would that have been hit? What would have been the results of that? And you can do the whole thing for a 10 pip stop. Same thing as targets. Whatever ideas in your mind you're thinking about for what you could potentially use as stops, throw them in this section, test them out. When you're done, compare these to your initial rules. So again, you have your initial rules for what you want to test on the trade. Then you have this extra session for stuff you're kind of testing out, ideas that you may have. I wonder if this may work. Throw it back here, keep track of it at the same time. This is the part I didn't do. Again, when I backtested, I just tested my specific rules. Then when I had other ideas, I had to go back and do it all over again. So it's easier just to do it all at once. Easier to do it all at once. Lastly, and I hope I'm not missing anything. Well, you guys can tell me. Lastly, you want to have notes. This is where you write whatever personal notes ideas you had. So you can say, got stopped out by 1 pip, then reversed. If you want to write with the 786, you can write in here, if entry were at 786, would have been filled. If you're doing forward testing, I know a few of you are doing forward testing, got filled event, non-farm payroll announcement, ECB press conference. Trade was stopped out due to interest rate decision. Any takeaways you have from the trade. This is one of the reasons that I decided to start front running orders, because in my notes, I would write a lot of notes that said, man, just missed entry by a single pip. That stinks. And when I reviewed my back testing, guess what? I noticed that I wrote that same thing a handful of times. And when I went back, again, I saw that, well, I keep missing by, 2 pips. Light bulb goes off. How about you front run your orders by extra 2 pips? And that automatically fills me in about, 20 more trades that I would have missed otherwise. So notes is very important. Notes is very important. Questions? And more I think about, Jerron, instead of having two separate sheets, you can add just how we have an extra section for targets and stops. Just add an extra section for if used 786 entry or something like that. So at least you can all do it at once. Any questions on this, guys, or anything else that we need to add? All right, looks simple enough. Now, after you have all these results in, it's simple. You just crunch the numbers. And again, I'm not a big Excel. I'm not a big Excel person. And if you're using the one that Darren said you guys uploaded, I think it'll do this automatically for you. But after this, I just crunch the numbers. So let's say I'm going win, put a 0 for loss, 0 for loss. Same thing here, 0, 0, 1, 1. I'm real remedial with Excel, you'll see. Profit, 20, got a big one, 50, 0, 0. Drawdown, 0, 0, minus 10, minus 20. And then you can do target one profit. Let's just say target one was 5, 20, 0, 0, and we'll do 15, 30, 0, 0. What I'll do is, I'll usually above this, I'll create a section that just crunches all the numbers. So I'll do something up here that says totals. And again, if you know fancy Excel stuff, then you can make it work for you. But I'll do a simple code here, and I'll do equals sum, parentheses. Now look at the section where it's at. So I'm in column L. So I'll do L. I'll look at the row 3, L3, colon, wherever your ending is at. In this case, it's L6. L6. What that's going to do is give me a total of everything in this column. and I can see the overall results. And again, for you guys that know Excel, you guys know much better and more spectacular ways of doing this. I'm very simple. This works for me. Copy and paste that, and I can do it all the way across here. Paste. And I just got to adjust it for the actual, yeah, there it goes. Boom. And you can see the totals. Well, how many times did I win? 2. How many times did I lose? 2. What was my total profit? 30 or 70. What was my total drawdown? Minus 30. How much did target 1 give me? 25 pips. How much did target 2 give me? 45 pips. Simple? Yes? No? Yes, yes, yes. Now again, if you wanna know how to do this on the fancier money managed spreadsheets, that's gonna be a question for Jason when he does money management. Because again, I just personally don't use them. I just don't use them. I like it simple. I like creating my own because I like to test different things. Now I can show you how to make charts and all that stuff, but that's just for show. You don't really need bar charts and stuff like that. That's just to give a visual representation of it. You don't really, it's not necessary. Doing a simple total up here is. And if you want, after you have all the numbers, you can do win percentage, you can do times that target 1 was hit, times that target 2 was hit, stuff like that. When you copy and paste, does Excel change the letters? Yeah, it will change the letters. Then when you do your analysis at the end, basically you want to see what works best. You want to there is a certain extent where you can go to. You don't want to say you want to always do what's most profitable, because sometimes you may choose a system that has a 10% win percentage, but it's the most profitable, and just realistically it's going to be hard for you to deal with that. But you'll have all the numbers with you. So if you're doing the totals over here, and guess what? Here's something that I found out. When I decided to not take target 2s, I looked at my results for this year so far, and guess what? My target 1 profit was more like this. My target 1 profit was more than my target 2 profit. So if my target 1 is making more than target 2, when I did my analysis, I said this: well, Akil, you're losing money by shooting for target 2s. Why not just take the full position off at target 1, right? Because if I have a 2-position trade, where's the calculator when you need it? Nowhere. If I have a 2-position trade, right, and I'm taking target 1 for 20 pips, or if I do this, if target 1 has given me 60 pips, target 2 has given me 45 pips, I have a total of 105 pips. If I just took the full thing off at target 1, so I double this number, I have a total of 120 pips. What's higher, 120 or 105? That's what you want to do with this data. Maybe you see that 50%, the 50% retracement, although it may give you a lower win percentage, gives you higher profits than taking the 382. Something I did in the live room. You guys always ask, Akil, why do you take target 1s at the 618 in the live room for your advanced patterns? Well, I did testing on it, and guess what? I had a much lower win percentage. I dropped about 10% probably per pattern completion percentage. But I actually made more money taking profits at the 618 than I did from taking profits at the 382 when I did my testing on those lower time frames for that portfolio. All because when I did my back testing, I looked for that, and I crunched a number. This number, 618 profits, was higher than this number. Have you tested whether it's better to be in one trade for a longer time, more pips, or several trades over a shorter time, less pips? No. That's all that has to do with you deciding, what type of trader do you want to be. If you're going to be in a swing trade, if you're going to be a swing trader, then you're going to take less trades. They're going to last longer. If you're going to be a day trader, you're going to take more trades. They're going to last shorter. What I found is that my swing trading and my day trading are usually opposites of each other. When my swing trading is hot, my day trading is usually not, and vice versa. So it creates a nice little hedge for myself personally, but I would say that one's not better than the other. It all depends on the freedom you have as a trader. If you have 3 hours to spend with me in the live room, and if you have 3 hours to day trade, there's nothing wrong with day trading. If you're a trader that has a job that is during your trading hours, you probably don't have the free time to day trade, so swing trading is going to work best for you. Many people are entrepreneurs. They have time, throughout the day to trade. Maybe they do a combination of both. I do a combination of both. So one's not better than the other. It's more so what's going to fit your routine, what's going to fit your personality. And that's going to be, we're going to talk about that next week in trade plan development. Patricia says, but isn't target 2 at break even? Target 2? No, target 2 is at target 2 is usually at the 618, Patricia. Target 1, the traditional targets are 382 for target 1, 618 for target 2. Yeah, your stop loss will move to break even after you hit target 1. Yeah, after target 1s are hit, your stop losses move to target to break even. Yeah. Are you saying that how would you keep track of that? I think maybe. If you have a trade that comes down to hit target 1, say you have a winner right here, you have a trade that comes down to hit target 1, gets you 15 pips of profit at target 1, and then 15 pips of profit at target 1, and then for target 2, it comes back and gets you stopped out for break even. You just put a 0 in there. And again, even for profit, guys, again, I don't want to get too much into the Excel stuff, but if you want to add it up easily, you could just do equals, let's do this one up here. You could do equals target 1, so that's going to be P, column P, row 7. So P7 plus column 2, which is going to be Q7. And it'll do the math for you. Now there's a lot more that can go into the spreadsheet, but this is, or into backtesting. This is the essential stuff that you need. You can get as detailed or as non-detailed as you want. You can have an area for win percentage. You can have target 1 win percentage, target 2 win percentage. So you can see the win percentages of each target. Target 1 wins 40% of the time. Target 2 only hits 30% of the time. You would do that the same way as your win-loss. Just have a section that says target 1 hit. A 1 equals yes, a 0 hit equals no. Well, I guess you don't really need it for target 1 because a win would mean target 1. You can have a section that says target 2 hit. You put a 1 in there for yes, a 0 for no. And you can actually see how many times target 2 is hit compared to target 1. Again, as detailed or as easy as you want to make it. I'm not an Excel guru, so you guys that are, you can do some super things with this. Patricia Keel was taking a 2 contract position at target 1 compared to target 1 was that the question with the adjustments I made to my trading, Patricia? Okay, you're thinking about okay, yeah, I get what you're saying. You're thinking about the total the contract, not the actual target. All right. So why not let it run to why not let run the target 2 run? There's nothing wrong with taking target 2s. If you do the testing and that proves to be the most profitable way, trade target 2s. I made the change because when I did it's been not a good year for target 2s with my trading. And when I ran the numbers, guess what? I ran the numbers in my trading, and my target 2 was not getting my target 2 was not getting hit. My target 2 was not getting hit enough to be more profitable than target 1. So for me, I was wasting money. It was more efficient for me just to take a single profit target. Because again, if we look at the scenario, and assume this is over a bunch of trades, if target 1 gave me 60 pips and target 2 gave me 45 pips, why would I split it up in half? I'm going to take whatever gives me the most money. So if I have a 2 contract position, again, if I'm taking off 1 contract at target 1, 1 contract at target 2, I made a total of 105 pips. If I take that 2 contract position, but only take everything off at target 2, or at target 1, excuse me, I'm looking at that as 60 times 2, 120. 120 is more than 105. So this way ended up being more profitable. Yeah. Anything else? Hope I didn't confuse anyone. Anything else on the spreadsheet? Again, play around with the fancy ones. Wish I could help you more in these, but I can't. But it's pretty self-explanatory. Entry price, initial stop loss, target 1 price, target 2 if you have a target 3, close date, close time. Pick and choose which ones you want to keep track of. But you can keep track if you have set rules. If you have set rules already, this is going to be a very easy one to use. Because you can just plug it in and then it'll create the graphs and the stuff for you. Do we get the sheets mailed? It should be downloadable on the site. On the money management section of the trading module. Can you explain the pip value tab? Where's that at? Somewhere. Pip value tab. This is just going to be because, even though pips are going to be worth different amounts depending on what currency you're trading. So it kind of, if you're looking to calculate a dollar amount, you don't need. I wouldn't think about calculating a dollar amount or whatever your currency pair's amount off of this. But this is just saying that, obviously if you're trading a dollar, a dollar pair, 1 pip may equal $1. However, if you're trading a certain pair like a CAD yen, 1 pip may be less than $1. 1 pip may be more than $1. What happens if in your trading, once you place a trade, it always converts it back to your home currency. But if you're trading two currencies that aren't your own, again, if you're trading one mini lot, you may have a 20 pip winner on pound Swiss, but it only converts back to $19.10 of your home currency. So it's just I wouldn't worry about this for back testing at all. You're worried about the actual pip that you bring back. I wouldn't worry about the dollar amount. Yeah. Take care, Matt. There's only risk management document in the money management section. I'm sure if it's not up there, I'm sure Darren will get it up there when we're done. If it's not up there right now, so just you guys will have it. It'll be there. It'll be there. Maybe it was taken down to do an updated version. Aside from that, that's back testing for you. Now the way I do it, we talked about earlier, is simple. I do it manually. I scroll back like this on my charts. I look at my right arrow button, and I just click one bar at a time. Depending on what charting platform you're using, you may have a replay feature. If you have a replay feature, that's very good to use because guess what? It's really hard looking at charts when there's no white space over here. If you have the replay feature, you can actually, it's called bar tick replay, I think. No, Ninja, what's it called on Ninja? It's called, I forgot what it's called on Ninja. It's bar tick replay on eSignal. Ninja, it's called, it may just be called market replay. Yeah, market replay on Ninja. So if you have Ninja, just go to market replay. Now you got to have it up so it records it through in the day, and it won't be able to get you the historical replay. Yeah, but if you start it right now, for example, it'll record everything from when you started. So you won't be able to go 5 years back and do it. But if you're a trader that says, hey, Akil, I'd rather forward test the 5-minute charts, but I'm not home to do it, you could record the day and then go back later and then go through the entire day like that. So unfortunately, this way you just got to click through. It stinks to draw fibs on because you don't have that real estate over here, but you can just do your best. Draw it in like that and put a line. Say, you know what, the 886 would be here. And the good thing about backtesting is if you miss it, you can be like, oh, wait, that was a Gartley, and you can always go back and adjust it later. Now, the last thing I would add, if there's no more questions, is I think it's very important to do both back testing and forward testing. Back testing is a little easier because you can see stuff like this. You can be scrolling through. You can be like, blah, da, 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 clicking through the markets, da, 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 ha, ha, ha. Oh, wait, this was a pattern. Oh, look at that. This was a pattern. Boom, 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 boom. And you can scroll back. Oh, yeah, I would have got that. However, in real life, you know how if you miss it, you miss it. If you miss it, you miss it in real life. So backtesting is cool to get those numbers for pattern recognition, but it's very important after you're done backtesting to spend some time forward testing as well. And forward testing means that you need to watch the markets live and try to catch these things live, sort of like what a lot of you guys are doing in the live room. Basically, essentially demo trading. Essentially demo trading. And the last thing I would add is this. Naturally, our eyes, I don't know why this is as humans, our eyes are naturally better at picking out bullish patterns than bearish patterns, or bearish patterns than bullish patterns, I should say. It's easier for our eyes to pick out stuff that goes from up to down. So you want to keep that in mind. You also want to keep in mind that it's very easy to pick out the winners and ignore the losers. So I would say this: when you do your back testing, look for the losing trades. Look for trades that are losers. Again, when you have your results, you want to have the most realistic results as you can think of. If you have a pattern that's close, it came one pip below your profit level, and then spiked back to break even. Don't sit there and be like, well, I would have took it out. That would have been a winner. It's close enough. No, count it as a loss. When in doubt, count it all as a loss, because you would much rather have worse numbers in your back testing and have better results in your live testing than have these super great results in your back testing and then bad results in your live testing. And a lot of traders do that. A lot of traders only tend to pick out the winners in their back testing, and they get excited. Oh, kill 75%, completion rate on this pattern, and then they trade live, and then I get an email. I don't get it. My back testing said it was 80% correct, and now I'm in drawdown. And a lot of times they only pick out the winners. Why? Because that's what we want to see. We want to see the winners. We want to justify what we're trading so we can make it work, so we can get the trading that much quicker. We want to say, okay, man, look at this. All these winners, I want a Gartley pattern to win. And our mind is subconsciously going to look for those winners so we can get the testing over easy or quicker so that we can get the trading in quicker. Look for losers. Darren says, it's difficult to do that because of our ego, but Akil, you speak with truth. I remember struggling with that when testing the cipher, but you have to be extremely specific and consistent. Yep. So you want to find the losers. And guess what? If you have something that works after finding all the losers, it just makes you feel that much better. Because you're like, man, I made sure to look for these losers, and it still came out this good. Oh, yeah. There you go. Yeah. Sometimes it provides you with valid. Yeah, that is true. You don't learn much for the winners. You learn from the losers. That is true. Yeah. Sometimes it provides you with valid information on how to improve your strategy. Darren said, and this is from someone that invented a pattern, guys. And I remember hearing a story that after Darren found this pattern, he brought Jason results and was like, look, man, this thing is killer. Jason went back to him like, gave him the squinty eye face, said, looks too good to be true. How about you go back and just find losers? And Darren just wrote in, Jason made him spend weeks back testing just looking for losers. But guess what? He did it. The pattern still paid off, and now there's absolutely no doubt that it's a profitable pattern because he made sure to find all the negatives, all the losers. So yeah, very, very, very wise words there. Other than that, real quick, I forgot about this. Just psychological wise, some other things you want to keep track of on your spreadsheet is winning streaks, losing streaks. You can do that. That's going to be more so after you tally up the numbers, but how many trades did you lose in a row? How many trades did you win in a row? What was your how much money did you lose at any given time in a row? So on those, if you had a 5-trade losing streak, how much pips did you lose? That's going to help a lot with that's going to help a lot when you get to money management. And then after you do your 100 million trades on all the pairs, you have all the tabs down here, you back tested 12 pairs, 500 trades on each pair, you're sick of it, you got all the data. That's when you start to build your portfolio. That's when you look through all of them and you say, Dennis shot me an email the other day saying, hey, I just tested, whatever pairs and noticed that, well, the euro dollar stunk when it comes to cipher pattern. Just making it as an example, but you look at it and say, okay, well, cipher patterns, pound yen did good, dollar yen not so good, Aussie dollar did okay, but New Zealand dollar did a lot better. And when you start to have an idea of what type of portfolio you're looking for, how many trades you want to manage, this is where you pick them out. If your euro dollar did bad with cipher patterns, do you guys want to put that in your portfolio if you're a cipher pattern trader? Yes or no? No, right? You don't want to put it in just because it's the euro dollar. If it performed well, I mean, if it performed bad, why put it in? And you guys are going to see that when Constellation comes out. I don't know how many pairs Jason and Darren tested, but I'm sure there were some that did very, very well. I'm sure there were some that did poorly. I'm sure there were some that were just mediocre. With so many opportunities out there, we don't need to trade 20 pairs. So why waste your time with the ones that are just mediocre? Why even include the ones that have bad results? It's just going to lose you money, right? Put them to the side. Create a four-pair portfolio, 8-pair portfolio of just the ones that have given you the best results. And trade those to be the most profitable as you can. A lot of traders think they need to trade every pair in the world. No, it's not true. Trade the ones that make you money. So, all right, that's it for today. That's a good rant to end on. I will see you guys tomorrow in the live room. Again, Darren has put the thing up on the spreadsheet deal online. You guys can play around with that. And good luck with the rest of your trading day tomorrow. And if anything comes my way, if I'm looking at the markets, I will shoot it through the syndicate feed as always. But take care, plan your trade your plan, and have a great day. All right, gang. Now the mic should be working. Sorry about that. It was a little late shooting emails off. We got I own a real estate business on the side, and we're trying to. The closer you get to a deal, the more and more paperwork you got to sign, and it's very, very tedious. So been shooting emails back and forth with the bank. But welcome to the live room. It is Monday, as usual. Really a non-trading day for me. I did post a few opportunities over to the syndicate this morning. There were a few advanced patterns on the swing trading time frames that I did put orders from. I know. I think what were they? I don't even know what they are. Dollar CAD was one. There's another one I was looking at as well. But aside from that, I typically don't do any trading on Mondays. I know Jason mentioned this in his FMP this weekend. Mondays are typically the day where you kind of just get a feel for the market. You know, we're coming off a weekend. London had its open. Nice. London had its open. No one's really coming to the U.S. Markets yet, so you kind of just want to wait and see, you know, what the market's going to do, if the reactions we've seen over the weekend are true, or are they, you know, we're going to see some relief, some retracement, something like that. So really a wait and see type of day. And that's why we do the training on Monday. But welcome. I know we had some questions on Friday that I said I would address if you guys remembered them. So certainly bring them to the table. I know it was something about money management or making a certain amount per month. So if you remember that question, Daniel, yep, go ahead and type it in. We can discuss that for today. And of course, if you guys have any other questions that came up or any topics that are confusing you, giving you a little trouble as you're going through the training course, this is certainly the time that we want to address it. Yeah, go ahead. And real quick, what you're seeing in front of you, I did load up a money management sheet that I can use. I personally don't use this sheet. All of you guys have access to it. I don't use it because I'm not very smart, and I kind of like keeping things as simple as possible. And I have been keeping track of our syndicate trades, so just to show examples of equity curves and how they look. And right down here, here's the equity curve from our the big week Jason and I had last week. I think I'm missing something on here. We were about 598, but you can see even with a big week like that, it's not a straight shoot up. It's kind of a move up and consolidation, and a move up and give some back, and it's a wiggle, and that's how it's always going to be. Yes, we do miss you, Cody. Of course. Wait, you weren't even there? What? You were gone? Didn't even notice it, man. Yeah, we lost a lot of well, a lot always stay on, but we lost a lot of. We had the turnover for our a big group of our 12E transformation members over the past 2 weeks. So we're seeing we're losing a lot of friends, but hopefully you guys stay in contact with me and with each other. But yeah, go ahead. Shoot your question in, Dan. We can get to it. Look at this, 56. Do we really have 56 losses versus 48 wins? That graph makes it look so bad. 48 wins, 56 losses. Looks horrible, doesn't it? Looks like we have half the amount of wins to losses. That's weird. All right, we're gonna give Dan a few more minutes. Looks like a pretty big question. Charles is back. Darren's back too, right, Charles? Yep. Does that mean you're back in the broom closet? No more using the big boy desk? Back in the broom closet with back in the broom closet with I was gonna say the tablet with the flip phone, with the Trade Interceptor app on there. The non-colored flip phone, the green screen. Your red stapler, no windows. Yeah, Charles. We're gonna. I can see it now. Jason comes in. Charles. Yeah, we're gonna need you to move your office back to the broom closet. Don't move the broom though. Yeah, for you guys that are Office Space fans, great movie. Great great movie. He lives out the dream. All right, get back to trading. Try to kill some time there. That is a great movie, by the way. If you haven't seen it, it's called Office Space. Basically, the guy just he's like, I don't care. He just doesn't care anymore. Just wants to be happy, and it's great. I know we already went over this, but I'm a bit confused in regards to how you combine how many pairs and pips values with the amount on the account. I would say this, Dan, I wouldn't even worry about it. Wouldn't even worry about it. The only thing you want to keep track of is pips. Now, pip value is going to be different depending on what pairs you're trading. If you're trading dollar-based pairs, are going to be one thing. If you're trading, stuff like Canada yen, they're going to be different amounts. But here's what you don't want to do. You don't want to track your success as far as your personal trade journal. I mean, and you can. I think in the money management sheet. Again, I'm not familiar with this. I think there's actually a converter that will tell you. Might not be on this one. Maybe on a different one. We used to have a converter that told you how many pips each pair is worth. I don't think it's on this one. Maybe that was a earlier version. But that stuff doesn't matter. It doesn't matter. When you get your statement from your account, your brokerage account, it'll tell you exactly how much you made or lost. So you'll see the conversions on there. Also, if you have are you using NinjaTrader, Dan? What trading platform are you using? Yeah, NinjaTrader. If you go to NinjaTrader, if you go to let me see if I can find mine. When you go over to account performance, if you go to executions, you go to mode, if you change it to currency, it'll actually tell you the dollar amount that you made. Let's see if I have any examples here. I don't know if I did any. Let's see, Friday. Maybe dollars on Friday. Let's try Thursday. I execute some trades on Thursday. Trades, there we go. So if you take a look on, make sure I'm on the right account here. Let's go to the, I don't want to show you guys all my goods. Hopefully you can respect that. Let me go to, let's go to the Main Street Alpha account. Cool. Let's go generate. Why is that not working? All right, there you go. If you go to accounts, okay. Go to accounts over here. Again, go to account performance, go to trades. And if you change this, if you change it by, you can look at it from points, you can look at it from percent, you can look at it from currency, and it'll actually tell you the dollar amount that was made off the trade. Now, again, you don't need to, I wouldn't worry about the dollar amount as far as your journal keeping. Just count pips. Count pips. Your broker will, again, it'll tell you the dollar amount for you. But as far as what you actually write down your journaling, just worry about pips. There's no reason to worry about the dollar amount. I mean, I think that's the least of your concerns, in my opinion. If you want to, again, your broker will tell you the actual dollar amount you make. But again, the last thing we want to think about is money. We want to make sure we're generating a positive amount of pips. If we're generating a positive amount of pips, we know it's going to be profitable no matter what the exchange rate is. But if you want to see it, again, it should be on your broker statement. You can always go to your account performance or Ninja and just change the mode to currency. I think, I'm not sure what the default setting is, but change it to currency. You'll actually see that here on Euro Yen, this might have been an 80 pip trade. It ends up being $80.99 or something like that, or minus $80.99, something like that. Now let me ask you this: why are you concerned with the actual pip value? What makes you concerned with that? What's going on, Neil? Welcome to the show. Talking about pips this morning. I didn't get any big questions over the weekend, so it's more of a whatever you guys bring today, I'll answer. And again, remember, that's how these Q&As work, guys. If I get a question over the weekend that says, "Hey, Akil, can you address that?" I'll make a lesson for it. But it's really just a Q&A, kind of like a private discussion away from the live room, where we're not getting distracted by jumping over here for trades and stuff like that. And of course, if you guys are watching the recording, just because you're not able to make it here live doesn't mean you can't ask a question. Again, just shoot me an email and say, hey, Akil, I can't make it Monday, but here's what I'd like for you to discuss, and I'll put something together for you. The answer is not that; it's the percentage that we want to risk. Again, just think about it. Think about it in pips. I would, what's going to happen is you're going to confuse yourself by looking at the individual value of each pair. Because if you're trading, a 10 pair portfolio, then you got to do the math for, hey, well, if I trade my currency on this pair, it's going to translate into this, and basically you're just giving yourself a lot more work. So what I would do is just work under the general assumption that 1 pip equals boom, and make it a flat rate. 1 pip equals $1. 1 pip equals $10. 1 pip equals $100. Make that a flat general rate for your entire portfolio, and it makes it a lot easier to manage. Again, we want to give ourselves as least amount of work as possible. And if we're dialing so into it that we need to adjust this for this pair, but this for that pair, it's in my opinion, it's just a waste of energy. So I would keep it as simple as possible. Assume 1 pip equals a set mark. And in the back of your mind, that, if you make 100 pips
It may be a little more than $100, or maybe a little more than $1,000 in real life, or maybe a little less depending on your portfolio. But again, we shouldn't be thinking about monetary goals anyway. We shouldn't be thinking, hey, I need to make, $1,200 a month, because as soon as we start thinking about that, we're putting ourselves really in the wrong trading scenario. We're thinking about the outcome more than the process. We've got money on the mind, and whenever we have money on the mind, we tend to deter from our trading plan. We tend to rush into trades, or maybe be scared to take a trade, take profits early, move stops, because we're thinking about the money, and money tugs on those emotional cords that we have. So again, I would keep it as simple as possible, not really worry about the money. Worry about pips, because you do want to see a positive pip intake. And just when you record your month-to-month stats, or maybe your week-to-week stats, just go off the statement that your broker sends you, or what's on your account performance if you're using Ninja, and then you can write that down for an actual monetary figure. Yep. Simple is better, guys. At least that's the way I think of stuff. Simple is better. At the end of the day, again, if we're bringing in if we're consistently bringing in a positive amount of pips, then we're in the right boat. Really, you shouldn't even think about a pip count. It should be more of a ROI, return on investment, what percentage you're returning, not necessarily pips. I'm not a big fan of shooting for a pip goal either, saying that, hey, we need 500 pips a month. I'm more concerned with seeing, hey, what's my percentage? What's my return on investment? Are we what did I keep that? Are we 0%? Are we 3%? Are we -2? Are we? I've got to be -0. Are we another 0? Are we 2%? Are we 6%? What is that return? The answer to the spreadsheet is a bit complicated to work. Yeah, but there is a walkthrough of it. If you go to, I'll go and load up. If you go to have you got to the money management section yet, Dan? Yeah, there should be a walkthrough video on how to work it. If you go to this live sessions tab, click on the live sessions tab right here. Go down to live session week 10. I believe Jason walks through how to, walks through the spreadsheet in this live session. Again, click on the live sessions tab, not the little arrow that says Monday Q&A, just live session. And this is where you can download the money management spreadsheet. Charles, we still got to get it. I'm not sure if you're the web guy to do this. There's got to be a way we can make this easier and not have. Can we just make this 2 tabs instead? Not just have the live session and the Monday Q&A. I know there are a lot of 12-week members that never click on actual live sessions. They just hover over it and click that. So I don't know if there's a way that can be done. I'm not an internet person, so I don't know how to do it. But if there's a way we can get that done, that would be a big help. I just noted a lot of people that never even see this live session part. They just see the Q&A. I only saw Jason walk through, but my spreadsheet seems to be missing some stuff. I would do this. Shoot a I'm not sure what it's missing. If what does it seem like it's missing? Cody says you have to input a few things for the sheet to work. Yeah, and I'm sorry, I'm not the money management person here. That's Jason's specialty. I would say this, either Cody, maybe if you can link up with Cody, he can help you out with what you're missing. But also just, you might want to shoot an email to Darren. I know he's familiar with it. Darren at forex.com. Just tell him you're a 12-week transformation member. He can help you out if there's any issues with the spreadsheet. Now you do have to enter these manually if that's the issue, Daniel. And correct me if I'm wrong, guys. You do have to enter these manually. I don't think if you enter your data on here, it's not going to automatically go to this money management sheet. I don't know if that's the concern you had. Okay. I'm not even sure what the live. Someone closed pips. Yeah, again, I can't help you with this. I'm not even sure what the live tune-up is. I don't have anything entered, so I'm not sure if it'll show up here, but see if you can hook up with Cody maybe, or again, just shoot Darren the email. They know the spreadsheet a lot better than I do. But here, I mean, honestly speaking, this is these two tabs. These two tabs are the only tabs you really need to worry about. This is going to chart your orders, and this is going to chart your P&L week to week. This is going to tell you when to change your money management with this key. This is just going to keep a journal of your trades, or the trade log, excuse me. I don't think you need to. I honestly don't think you necessarily need to play around with anything else. Again, I would keep it as simple as possible. Trade log, entry date, entry time, pair. You don't even have to use all of these, but enter your information here. At the end of every week, head over to the money management or the live equity, whichever one you want to use. Head over there and just enter it manually in here. And that's really all you need to do. Your trade to trade will be kept track on your trade log. Your week to week end results will be kept tracked over here. Cody said, I don't mess with the live tune-up. Yeah, I don't. Yeah, I'm not even sure what I'm not even sure what this is. I'm not sure if this is filled in once you enter your stuff. Yeah, but yeah, keep it as simple as possible. Oh, here you go. Look at this pip values. There you go. I knew it was somewhere on here. This is from a while ago. I'm not sure this might have changed, but here, well, this will change. But here are pip values. And you see goforex.com pip calculator if you want to see the update. Yeah, I knew it was somewhere here. Just had I added the little spreadsheet over here, so it took this one away. But yeah, you can go and enter if you go to one of these websites down here, goforex.net pip calculator, or over on Baby Pips, you can find the up to date pip values and just enter them in here, and then it'll make the conversion for, depending on how many units you're trading, what each one is actually worth. So you can see dollar yen, one pip is actually worth 129. Euro dollar, obviously it's a dollar. Pound dollar, dollar Swiss 105. Dollar CAD 98 cent. Again, I don't think you need to necessarily worry about this. It's not really a big deal in the bigger picture. But if you want to get an idea, here's what you're looking at. Do we have any other questions just on money management in general, or any technical questions that we need to go to a chart for? Again, guys, this is your show. You are the directors. Akil, I am following your strategy, keeping track of my weekly mistakes, and it's working so far. That's the best thing I ever did. That's the best. I'll tell you this, and that's one of Jason. Jason loves that story. I first told him that we used to have a mastermind group with it was a program that you had to pay $10,000 to be a part of, and we would meet out in Kansas City and have meetings on just different topics. But one of the topics was we were talking to a trader. She was very successful. I think she had taken her account. I forgot what she started with, but she had made it like a $500,000 account, or maybe she took like a $10,000 account to like a $50,000 account, and then just blew it all. And I told the story about the mistake thing, and everyone's eyes just got wide open. They're like, "That's genius." I'm like, "Really?" I thought it was pretty simple, but it's all about that Kaizen philosophy. The Japanese believe that you couldn't just go from being 1% efficient to 100% efficient overnight. You're not going to make that big change. Rather, the way to do it is just by very, very small steps. Get a little bit better each day, and in the big picture, you'll be where you want to be. And then a little trick to that is worrying about mistakes. It's, again, if you really buy into it and trying to fix your mistakes becomes the biggest goal, you stop thinking about the money. When you stop thinking about the money, all you can think about is the process. And that's when we achieve that process over outcome goal that we want to get. And before you know it, your trading is getting better. It's kind of like that trade that it's kind of like the difference between firing off a trade and watching it all day, or firing off a trade and you kind of forget about it. Kind of like the euro dollar the other day. I took a trade on euro dollar, I think it was on Friday, and it shot right against me, and we're watching euro yen and whatever, if you were with me Friday, the trades went pretty south. They ended up good, but they went pretty south. And I just stopped watching euro dollar, and then like an hour and a half later, we looked at it and we're like, oh man, I forgot I have a position on this, and boom, we're up 50 pips, hitting target one. Life is a lot easier when you don't think about it. Now, what I would do for any of you guys that are doing that strategy, I would set up an Excel spreadsheet like this. Set up an Excel spreadsheet and just grade yourself on your trades. You can have different positions. You can have or different categories. You can have analysis. You can have entry. You can have stops, targets, management. Again, analysis being, and give yourself a point. 1, 2, 3, 4, 5. You have a total. So a trade of 5 would be a perfect trade. So was your analysis okay? Was it actually a Gartley pattern that you found? Yes. Did you enter the right way? Yes, I entered the right way. Were my stops placed correctly? Let's say no. Give yourself a 0 for that. Were my targets placed correctly? Yes. Did I manage it well? No. I moved I moved stops too quickly, and then you give yourself a score. 1, 2, 3. You've got a 3 out of 5. So you give yourself a 3. And then over here you have a notes section. And your notes section, you write down your mistake. Move stops way too early. And it helps you keep track of this stuff. And if you want to take it to the next level, if you know what mistakes you're making, you can actually have a separate category for each mistake you make and then put an X on it every time you make that mistake, and then keep track of how many times you're making that mistake. What I did was something like this. I had a list of mistakes I made, and I kept track of them. And my goal was to not make the same mistake twice. So if I had a note in here that said move stops way too early, on the next trade, I may get a 0 for analysis. I may get a 0 for entry. I may have bad targets. I may have, everything bad, get a score of 2, but I didn't move those stops. And each time I would try to eliminate one of these mistakes. And, and You will eventually make them, twice, maybe 3 times. But if you focus on it, eventually moving stops will never be an issue if you really work on it. And that's just one less mistake you have to worry about. And before you know it, you're getting to the point where you're making very minimal mistakes. And if anything, guys, your mistakes want to come in your analysis. None of your mistakes should come in your trade management. This should be set. Maybe your analysis was a little off, and that's more for structure-based trading. Maybe, it was a double top and you didn't really, you thought it was major structure, but in hindsight, it really wasn't, or you thought you were with the underlying trend, but you really weren't, because you'll get better at that stuff as you increase your skill. But this is the stuff that you can control the most. Entering at the right place, moving stops, setting targets, managing that trade. Cody says, I have a quick question before I have to go to work. Example, if there is a pattern and you are trading 2 lots, if it's a loser, do you count pips as double for a loss? Cody says, or Charles says, you still lost the same amount of pips, but your dollar value would be different depending on your position size. If you lost 50 pips, you lost 50 pips. Whereas 50 depends on your position size. I treat it here. Me and Jason treat it differently. Here's how I treat things, Cody. When I keep track of my trades, I have, let's say I have target 1, target 2, and then stops. And I treat it like this because it's the simplest way for me to do it if you're trading 2 positions. And this is, I don't know who else treats like this. I always break down each position. So if target 1 hit, if we had a winning trade, if target 1 hit 20, and this is as far as looking at not pip value, but if you're looking at a total of your position size, if half of your position hit 20 on target 1, half of your position hit 20 on target 2, boom, you would do it like that. If you got stopped out, what I would do is I would take, let's say you got stopped out for 50 pips, I would times that 50 pips by 2, and I would look at that as a 100 pip stop. And that's if you're calculating it as far as total pips on both your positions. The easier way to do it is just divide everything by 2. You're gonna get the same result no matter what, because this is a 40 pip. This is a 40 pip winner. This is a 100 pip loss. If you did it the other way, you would still be looking at, because you would divide your targets by 2. This would still be a 40 pip winner, or a 20 pip winner, and it'll be a 50 pip loss. For me, it's a personal preference thing. I do it this way. Because I really like to see the difference between my target 1s and target 2s. It's really important to me to see how many pips target 1 is bringing compared to target 2. I'm not really concerned about the dollar figure. Again, it doesn't matter. You can divide them. That'll give you a nice total pip number. My goal is not. I don't really care about the total pip number for you guys, or for me. I would say I don't really care about the total pip number. I want to see the difference between target 1 and target 2, because in a scenario like last year, Charles does it my way too. Then, in a scenario like last year, I don't know if let me see if I can bring something up for you guys, and I'll try to get this in before you have to head off, Cody. I don't know if I have it for last year. I think it's on. I blew a computer up last year. I blew a computer up last year, and I think it was on that computer. I still need a new computer. Let me just see if I can find something from the past. Forex, maybe. Live room. Let's bring up 2012 stats. Okay. All right, but just in general, here's what I want to see. I want to see what's making me more money. Target 1 profit, 290, or target 2. Because if we get what happened last year is when we lost volatility, target 2 was more like this. You see this, guys? How target 2 was 216 and target 1 was 302? Give me a yes if you do, if you see this. Now, month to month is not a big deal. What would this tell you if, let's say you went on a 6-month streak, and this is what you're looking at on a regular basis? What would this tell you? Again, assume you traded this for a significant amount of time. I like basing stuff on quarters every 3 months, but say you did it 6 months and you noticed this. All right, take care, Cody. What would you guys say? Would you say you're wasting money by shooting for target 2s? I would. I mean, look at it this way. If you've got 2 positions, right? If you've got target 1 was bringing in what? Let's say 302. Target 2 brought in 216, right? So your total pips on here between both targets were 518, right? Between assuming you're splitting up into 2 positions, right? Well, what if you just took the full position off at target 1? Now you got 302 times 2. You're bringing in 604. I'm not the best at math, but 604 is greater than 518. So it would make more sense just to trade a target 1, or take your full position, take both your positions off at target 1. So that's why I like keeping track of both targets, not averaging it. Again, you can average it to get the total pip. In the syndicate, I don't count target 2s. I just tell you guys what target 1 is going to be. If I trail for something different, then that's just on me. But at some point in your trading, you're going to have to figure out what you want to do. And there's a lot that goes into it. You know, target 2s doesn't just, I mean, there are pros and cons of both. Obviously, target 2s should bring in more money than target 1s, right? Target 2s should bring in more money than target 1s because they're extended targets. If we're just looking at the old school stats here, you can see most of the time, yep, well, no, maybe not. I don't even remember these. This is a bad example. Target 2 is more, July. Target 2 is less. These are a little, actually, this is a bad example. These are a little different. I shot for, when I used to trade this in the live room, I would actually, my target 1 was actually the target 2 point. So target 2s were like super extended targets. So the target 1 was a 618. So that's the bad example. That's why we're not hitting them as much. But you got to make a decision. Target 2s can potentially give you more pips, but it also sucks up some of your capital. You know, you're holding positions, you're holding money in the market longer. And mentally, you have to put more energy into the trade. What do we do a lot on target 2s, right? We trail and we manage them. One of the big benefits I found last year in only trading target 1s, and this is the first time I've done it. It was kind of based off, Charles brought the idea to us when he was, he had asked questions and about, like managing trades over the London session and stuff like that. There's so much freedom in just taking one target, guys. I mean, you can easily do something like this. If you're taking a single target, let's say I'm buying a dollar yen right here. This is actually not a bad buy. Nice pin bar at these lows. If I'm buying, this is a really good buy. Probably go up here. Let's say I'm buying dollar yen right here. My targets are right here. My stops are right here. I can just do an OCO order. A one cancels the other order. And this will be an OCO lined up with this. And guess what happens? Whichever one is hit eliminates the other order. If I get stopped out, my limit orders are gone. If I hit targets, my stops are gone. I really don't have to manage this trade at all. I can really set it and forget it. I can set it. I can go to sleep peacefully overnight, not worrying about the market doing something like this, rolling up, hitting my targets, and then rolling back down, and me not adjusting my position or taking my stops out. It gives you a lot of peace of mind to take target ones. And psychologically, it's also a good help for you as well, because guess what? One of the things that hurts us a lot as traders is seeing target one hit, shooting for a target two, and having the price come back to stop you out for break even on that second target, right? Dan said you can't do that if you have two targets. You can. You can do an OCO. You'd have to set up more of an ATM strategy, because if you do something like this, let's say you have target one here and target two here, and I'm not the, so no follow-up questions on ATMs because I have no idea how to work them. There's Ninja has a great tutorial on them. But if you're setting up two targets here, here's what you got to do. If price action hits target one, then you've got to set your ATM strategy not only to adjust position size, because remember, we're doing this, right? If we have two positions, we're looking at something like this. Come on, no, I don't want that. We're looking at buying two right here. We have a sell stop for two. We have a sell limit for one, and we have another sell limit for one. So if we're buying two, once price action hits here, not only do we have to move stops to break even, but we've got to adjust this two to a one. And then typically with target twos, because they're extended, as the market ebbs and flows, we're looking to trail this. Position. So as the market does this to make its way up, we're looking at rolling our stops here, conserve some capital, here to conserve some capital, here to conserve some capital. So it's a lot more active management. Now, once you've adjusted your position, you can still do an OCO, I believe. You can still make this one cancel this one. Again, you'd have to check with the ATM strategy on that. But it's a lot more, it takes a lot more work to do, if that makes sense, Daniel. Because you got to make sure you move stops. You got to make sure you adjust that stop position from 2 to 1, because half your position is off the table. And then you've got to set it up where the new position, the new stop position here, is canceled if this is hit. And you won't be able to trail unless you're doing something like trailing at fib dots or something like that, and you can set it up for that. But you won't be able to trail at structure. So it just takes a lot more active management, which isn't a bad thing if you have the time to do it. But what Charles brought up last year was the issue was, well, he would have patterns. He would have patterns that got filled over the London session while he was asleep. He'd wake up to see that price action hit target one and maybe rolled back down to hit his stop loss, and now he's filled short going the opposite direction. Or he'd had trades that roll up to a point where he would roll stops or manage them, and then came back down to stop him out for whatever the original loss was, and he didn't have a chance to conserve some of that capital. And that can be very frustrating. It doesn't happen often, a lot, depending on what time frames you're trading on, but it could be very frustrating because you're making the right calls, but you're not benefiting off of them. You're like, man, I called that pattern, but I woke up and it's break even. I couldn't make any money off of it. And if you're a swing trader, you only get so many trades a week, right? Or a month. Depending on your portfolio, if you're a swing trader, you may get 10 trades a month. Blowing one of those trades is potentially a big deal. So it gives a sort of a peace. What I've found is it gives a peace of mind. Now, yes, you don't get a chance to take part in those target twos. And depending on your strategy and your expectancy, you may need those target twos. But for me, a target one, money in the bank. Money in the bank is hey, I'm fine with that. I have no problem taking a 50 pip move, taking my position out and saying, hey, I made some money no matter what. 100 pips if you times that, by both positions. I have no problem doing that versus making a 50 pip move and then being, well, maybe I can get 100 pips out of it. Maybe not. And of course, it depends on the scenario too. We're not looking for extended targets in every scenario. But you also gotta go with what your trading personality. Everyone's going to be different. Some of you, it won't bother you at all. Some of you won't mind. Others, it may bother you a lot. And why trade somewhere? Why trade some way if it bothers you? Make an adjustment to something that fits your fits your philosophy, fit how you view the market. Be comfortable. The worst thing you want to do is trade going against the grain of what you think, because then you're going to fight yourself every opportunity. This is really not a bad buying situation right here, guys. You should have 127 confluence with a 1618. Watch this. Obviously, we have structure right here. If you don't see this, you need to leave right now. But we should get a 127 Fibonacci extension down there. Bang, right on a nose. And we should get a 1618 Fibonacci inversion there as well. How do I know this? Because I am extremely good with Fibonacci's. Watch me. Right down there. Look at that. Good trading opportunity. Stops below here. The wick put you down a little bit, but if you got involved right at the pin bar, next bar market, stops being right here. Certainly look for a move across to right here. That's a pretty good risk reward. You can't complain with that. Cannot complain about that. And of course, more conservative traders, you still have a double bottom possibility. If you come down here and you double bottom, RSI is oversold. Get some RSI divergence on here. Get the RSI doing something like this on the retest. Boom. Higher lows, equal lows right here. Even more conservative way to enter. All right. Any more questions for this Monday? Different type of session today. We're looking at a lot on the money management side of things. But if you have anything else, let me know. Again, the emails were kind of dry this weekend, so I didn't have a topic that needed to be addressed. But shoot it in if you got something. Akil, was the book that you're recommending Trading in the Zone? Yeah, great book. Mark Douglas, great on trading psychology. I actually have a list on my blog. I haven't updated in a while, but a list on my blog of books I've read. Some of the books I like a lot. You can see Trading in the Zone is my #1 book up there. Trading in the Zone, Trade What You See, Market Wizards. Market Wizards. This is a really good book. The first one, I wasn't really a fan of the rest of them. Market Wizards. Have any of you read Market Wizards? Not yet. On my shelf. Oh man, you guys need to read it. What Jack Schwager, what he does is he interviews the best of the best traders of all time. The best. And what you would expect is these traders to tell you what would you expect from interviews of the best traders? You'd expect them to talk about how profitable they are, how their super secret system was great, right? How they went to school and learned all this stuff and just were trading geniuses. You would expect that. At least that's what I expected. The exact opposite. These guys are, aside from one French guy, I think it was, these guys are just like us. These guys have some war stories. One of the best war stories I heard was, I don't remember who it was, but one guy was trading. He lost everything. He went into the stairwell and cried as he was down to his final pennies, and he had to call his mom and ask for a loan. It doesn't get any lower than that, guys. I guess you can, your bookie can be chasing you down. But it doesn't get any lower than a grown man crying in a stairwell asking his mom for money. I mean, all pride is gone at that point. Yeah. And this guy ended up being one of the best traders ever, right? So what I took from it is, and I read it when I was a consistently unprofitable trader. It opened my eyes. I'm like, wow, these guys, like, again, I expected these guys to just, tell me how good they are and stuff like that and for me to feel bad. I'm like, these guys are just like me. I'm in here losing money every day in the market. These guys are losing worse than me. I actually felt kind of good. But it's all different traders, all different techniques, strategies. Some are fundamental. Some guys are astrology, looking at the stars and the moon. Some guys are, trading like grains and stuff like that, commodities. Some are using Bollinger Bands. Some are all different strategies. And it's funny because not only can you see that you can make money using all different strategies, but none of what they did matter. They all have the same message. Again, aside from the French guy, they all have the same message that it's all about psychology. It's all about discipline. It's all about having a plan and sticking to that plan. So it was an amazing book just to see that all these guys were sharing the same message that at the time Jason was sharing with me, and that these guys went through some pretty big lows before they became successful. And it really gave me the belief that, hey, I can be one of the greatest traders of all time. Or why can't I be one of the greatest traders of all time? I don't need an Oxford education. I don't need to go to Yale or Princeton or Harvard. Study economics. Work for a big bank or a trading firm. So that was big for me. Market Wizards was great. It was great. Yeah, it was a great book. I'm trying to think of another one is Pitbull's good too. Pitbull's good. That's a good one. Buy side is this is more entertainment. You're not going to learn a lot about trading. It's a pretty entertaining book about the trading life and sex, women, drugs, money, drugs, money, more drugs, more women. That's basically the buy side. It's a very entertaining book, and it's a true story, and it's kind of sad, but it's very entertaining about the life. And this another guy that just kind of learned on the road. And the rest of this stuff is Wave the Turtle, Reminiscences of a Stock Operator. That's good. Not one of my top ones. If you're more into the history of how trading used to be, pretty good. But these are good right here. McKeel, did it take you long to trade a standard lot? No. I also started with money management though, so I was fortunate to have a very, very large account to manage. I don't even know if you want to call it fortunate. It didn't end well, so it was unfortunate. Neil says read and saw somewhere he went to interview someone and he had not looked at the terminal. You would not have had any proof the guy was a super loss or super tremendous profit. Yeah, yeah. Again, you see the same characteristics in all of these, in all of the traders. It's really the same. It's really it's amazing how much the same principles are pounded into your brain. And again, what's cool is that it's so many different traders doing it, and they all have different strategies. Yet it's the same principles, and they're all telling you it doesn't matter how you trade. Again, the one guy's trading stars, looking at the almanac and saying, "Oh, the moon should align with the sun today, and that means this is going to go up." Doesn't matter how you trade, but it's the core principles. So it's a very I recommend every trader should read at least these top 3 books. Every trader should read these top 3 books. Some yeah, and you know why they're calm? It's process over outcome. I mean, at the end of the day, I mean, it's we all get excited, but you should you should expect to win. Winning shouldn't be once you get to the point in your trading where you're consistently profitable. Winning shouldn't be a big deal. Obviously they're going to be when you nail a trade that's really good, you're going to get excited over it, but it shouldn't be like, oh man, 2% this month, yeah. It should be an expectation. You should expect to win. I fully expect to make money. We just had a 600 pip month between Jason and I. It's great, fantastic. Not surprising. It's happened before, it'll happen again. It happens a few times a year. Doesn't happen every month. So you get excited when it happens, but it's expected. We should have at least two more months like that this year. We should have some months where it's really bad too. I fully expect a month where I get a 3 to 5% drawdown. Yeah. It's just the system. It happens. I think in my last video, did I hear somewhere that there is slightly different price for the live room and the syndicate? Yeah. Yeah, if you're in the 12-week transformation, I believe everything is discounted in the future. So if you want to join the live room, it's probably half price. I think the syndicate I'm not sure about the syndicate, but a lot of to stay on it, it's significantly discounted. Again, don't quote me on the prices, but it's usually I think you get like a 50% discount, I believe. So you can stay in the syndicate for about $25 a month. You can stay in the live room for $50 a month, something like that. Yep. Just consult your local Charles or Darren. Good traders become like monks. Yep. Trading gets boring, guys. That's one of the top benefits of being in the educational business. You guys keep me excited because we get new traders all the time that get fired up over these months. They're like, "Yeah, great job," but aside from that, we get good conversation. But trading is boring. I'm telling you, trading is when you're doing it the right way and you're following the process, it's very boring. It's like working on an assembly line. Part comes down, grab the part. Part B comes down, plug part A into part B, send it to the next location. You're making some type of amazing product. You're making this new fancy car, a BMW i8. But it's boring now because you've been doing the same thing. So, don't want to be a buzzkill, but it gets boring. But when it does get boring, it usually means you're doing the right thing. You're not in it to gamble. You're in it like it's a business. You're not, getting emotionally involved in each and every trade. Like I said, you can celebrate big trades. Nothing wrong with that. But the process is boring. The process is exactly the same. Just checking out the equity curves on these old. I haven't looked at these spreadsheets in a while. Look at these equity curves all over the place. Look at that. Talk about consolidation. Talk about consolidation there. This is 2012. Ooh, there's a bad month for you. Look at that. Almost down to 700, 650 pip drawdown. Ended up minus 400. Oh, here's a good month. 700 pips. Look at that. I tell you guys, September is historically bad for me. Look at that. 450 pip drawdown. 450 pip drawdown, and we fired that back. Followed that up with 700 pips of winning. So we made up for our 700 pips plus 300. That's how we do a back-to-back. What's this over here? Wow, 55%. That's not right, is it? That's up to June. What were our totals this year? We're looking at 383 pips, 683. 300 pip profit. That's how you come back off a losing month. Not bad. All right. Anything else, guys, before we head out for the day? Oh, there's dollar yen. All right. See you guys tomorrow. Then we can kick off our last week of February. Hopefully, we can end February with a bang. I think we should be up for February. I don't even know month. Yeah. Oh, we've had 3 winning weeks in February, I think. January looks to be a down or break-even month. Hopefully, we can end February with a bang and move on to the next month of trading. So until then, plan your trade your plan. Take care, gang. Give me a yes if you can. Good. Small crowd today. I wonder if people got that. I should have mentioned something about the daylight saving times. I didn't even know before the weekend, but I wonder if we're going to have people coming in a little bit late and a lot of people missing today's session. Yeah, I didn't realize too until I actually got something in the mail from a friend of mine who's a realtor, and I was like, hey, my friend's on this this brochure or whatever, and she was holding. I'm like, why is she holding the clock? And there's a big thing that says, don't forget to turn your clock. I'm like, oh. I slept right through it anyway. It didn't matter for me. I was caught up on some sleep over the weekend, so it did not affect me at all. But that's typically. I remember the last time we had our daylight saving time. I think everyone missed the live room session, so we may see that again today. But we do have a small crowd in here, so we could talk about some things. Originally, I was going to talk about. I told you guys I would talk about the inside bar strategy I was looking at. But is there something specific you guys wanted to discuss today, or did you want to hear about that? Did you not want to hear about it? It's nothing major, but it kind of talks about the process of developing a strategy. But it's your show, so you guys call the shots. If there's something that you want to talk about, let me know. If you guys did want to hear about the inside bar thing that we talked about in the live room last week, let me know as well. If you don't, it's not a big deal. Again, I won't really have time to dig deep into it till the summer. Was Darren pretty upset over Sporting KC yesterday, not pulling off that win? Did he come in a deep dark mood, yelling at everyone? He said we could start. Okay, well that was the original plan. Again, I don't know. We don't have a lot of people in the room today, so who knows if that will continue. But we mentioned the other day in our live trading room about inside bar technique, and we started off. I don't know how we got on the topic. We were talking about. I think we're talking about strategy development. We're talking about non-farm payroll strategy development and how just the different steps you go through. And I talked about an inside bar strategy, and really how developing a strategy is not too hard, especially if you know the if-then thought process. At the end of the day, you want to relate everything to that if-then thought process. If this, then do that. You want to have strict rules. You don't want to, well, sometimes, maybe, kind of, sort of. You want to have strict rules. But it is a process that takes a long time. And, well, in all honesty, most of the time you fail. Most of the time you'll have a brilliant idea. You'll look at it. You'll try to trade it. Hopefully you test it before you try to trade it. It'll work for a little bit, but it'll fail over time. And back in the day, when I was one of those traders that was just trading essentially every type of strategy out there, one of the few that really caught my attention and worked was the inside bar strategy. And again, the inside bar strategy works like this. You have a mother bar like this. So this will be your previous bar. And what happens is you get your next bar. Yeah, they said they call it the mother bar because the second bar is inside it, the mother bar is like protective of it. I never knew that. And the second bar is inside of it, like that. It's fully inside of this mother bar. And traditionally, the inside bar strategies like this, what you would do is you would bracket your orders. Let's say, here's your high, here's your low of the mother bar. Whichever way the market breaks out, you would get long or short that direction. So if you would break out this way, you would get a short opportunity to the downside. You'd have sell stops down here. If you broke out to the upside, you would have buy stops trying to trade it up. So essentially, you're playing the breakout. So if we were to look at that just on a chart here, we can. There's a million of these things. I'm on the daily chart. Here's a good example right here. You have. Let's see if I can zoom this thing up. You have right here. There's a lot of them. Let's just make it easier looking one. There you go, right here. Here's the bracket of this would be your mother bar, right? You have your high of your mother bar right here. You have your close of your mother bar right here. And you can see this bar right here is completely inside of the range of this bar. You guys see that? Give me a yes if you do. These two bars right here. Yep. And what you would do is you would play whichever way it breaks out. You would have a stop order, like I said, stop order right above the highs of this candle, a buy stop. So you'd be looking to get long. If you broke out to this side, you'd be looking to get short if you broke out to this side. Now, what are you guys noticing in this particular scenario with the next bar? What happens? What are you seeing here? What does this bar do? Right? We kind of break out to both sides, right? Yeah, so you kind of get a false breakout. You're most likely stopped out. Now, again, we don't know which way it occurred, but we're most likely stopped out because traditionally, if you get filled long here, this becomes your stop order right below this other bar, and vice versa. If you get short here, this becomes your stop order. So if you got triggered this and we came back up, well, now you're stopped out. If you got triggered this and we came back down, now you're stopped out. So this would be an example of a losing trade, right? We can put a big box around this one. This would be a losing trade. Now you do have another one right after it too, which represents a winning trade. You actually have two inside bars. You have one right here, this being your mother bar. You can see this bar completely inside of it. And then inside of this bar is actually another mother bar. Like that, with this bar being completely inside of it. This one, big breakout to the upside, right? So this would be a pain-free winner, correct? And again, just give me a yes to make sure you guys are sitting with it. Yeah. So the first thing I always do when looking at a strategy, I do the eye test because I've back tested a lot, and I've wasted a lot of time back testing. Meaning, I've thought of brilliant ideas, and I've back tested it, spent hours and hours and weeks doing it, and then realize it doesn't work. Sometimes it doesn't work at all. It's not even close to being profitable. So the first thing I want to do is I want to do the eye test. So I just want to scroll through And I want to see how many times this inside bar deal occurs. And I did this the other day. And I noticed we had a lot of scenarios like this first one, where if you're using an aggressive stop order, sometimes you get a little whipsaw where the wick will get you into the trade and then it'll stop you out. Now, I haven't compared that to how many times it explodes right back up. Like I said, I haven't done any real testing on it, but just doing the eye test. But one filter, this is the part of the back test, you keep adding filters. One filter that I looked to add was to say, hey, instead of just putting a buy stop order there or a sell stop order there, all right, dollar cat, there we go. Instead of just putting a buy stop order or a sell stop order, why don't I wait for the break and close above? You know, we wait for the break and close and everything else we teach, right? We're structured. We always talk about higher high, higher close. What if I were to wait for the break and close above before getting long or short? Would that make a difference? I'm just going to scroll to random points in this chart and see if we can find some examples. Like I said, there are a lot of inside bar examples out there. And hopefully by waiting for those break and closes, we can filter a lot of those opportunities. So let's just do an eye test. Let's go right through. We have an inside bar right here. Bang, this red bar. We're bracking it off. Here goes the highs, here go the lows. We're waiting for the break and close. Here's a break right here. Break and close doesn't come until this bar. Well, do we rally bullish after this bar? Looks like we do, right? Nice little rally up there. Another example. Inside bar, nope, not that one. Right here. If you guys can see it. And if you can't, just let me know. Here's our mother bar. Here's our inside bar. You can see we get that false breakout to the upside. You guys see that false breakout? Give me a yes. With this wick right here. Yep. But again, we're not waiting for just the buy stop. We're waiting for a break and close below. Excuse me. Which is going to come right here. Break and close below. Oh, what do we get? Look at that. We get a move down. Same thing here. We can keep going again. It happens a lot. This is why this is something I would do on a daily chart where I don't have to watch it that much. Inside our mother bar, inside bar. Nope. Break and close below that. Break and close above. Excuse me. That high is right here. Nice little rally. Right. You can even get another one right here. Boom. Boom. False breakout. Let me just change. Maybe I change my pointer. False breakout to the downside here, right? We don't get involved, so we're waiting for a break and close above. Break and close above comes right here, right? We see our move up. Same thing here. Boom. Nope, that's not an inside bar. Take that back. Nope, nope, nope. Look for our next one. Look for our next one. Right here. Mother bar. Nope, this one's a little bit below it, I think. So not going to count that. There, I know Todd wrote one, Charles. But it had slightly different. I had on my chart. It had slightly different. Well, it looked slightly different than what I was looking for. I don't know why. The same thing right here. Look at that. Inside bar. You guys see it? Oops, where's my mother bar? Yeah, so maybe I'm like I said, might not have been the one you wrote. Might have been the one he wrote, but I just lost my deal here. There we go. Look at that. Mother bar. Inside bar. You get your break and close right there. Boom, rally down. You guys see how that break and close below is adding a little bit of a safety net. It's you know, it's keeping you out of some of those false moves. If you have one, Charles, let me know. I had one from Todd. I asked for him to write me one a while ago. It was in here. So I have inside bar mod and inside bar plain, but something was weird about it that I didn't understand. It was, I don't know. Todd always does fancy stuff to it, so he probably made some, I don't know, maybe I didn't mess with the settings. Probably blew up my computer doing this. I don't remember. It was a long time ago. I only had the inside part, but no close below. Yeah, I think that's what. Well, the traditional rules when you hear about it is just the break. It's not the close doesn't matter at all. So I think that's what the one that Todd wrote. I think that's what his indicator did as well. It was just as long as it spikes below it, it's fine. I just started looking at the close the other day because I was getting a lot of false breakouts. I was getting a lot of false breakouts, and I was saying, well, is there a way that I can add a little bit of a filter? I was also thinking about just myself as a trader, whereas, if being a little selfish here, if I'm going to trade this, right, guys, I want this to be a higher time frame strategy. I want this to be something that is on the daily, something I can come in once a day and say, look at my chart and say, think about it like this, right? If you're trading, this is the daily time frame. So we get 1 bar per day. So we're already going to know there's an inside bar, right? We're going to know there's an inside bar a day in advance. So say we get our inside bar on today, on Monday, right? We already know, okay, there was an inside bar on Monday. My only job on Tuesday is to see if we break and close below. I can easily set up my schedule to check my charts at 5 o'clock or whatever time it is when your bar is closed. Say, is there a break and close below? And if not, get short at market, right? It's that simple. I don't have to worry about putting a buy stop order there and then maybe it getting filled during the day, but then reversing back up and hitting my other order. And then I have to adjust my first order so I don't get reversed and whipsawed. No, I come back. I say, I use an example like this. I say, all right, look, what do we have right here? Okay, we got our mother bar. Doesn't mean much yet. Boom. Okay, Akil, we have an inside bar. So let me bracket here. Let me bracket there. My only job the next day to see is if we get a break and close. So let me make sure I'm in front of my computer at 5 o'clock. Do we get a break or close either up or down? Nope. All right, let me check the next day. Look at that, break and close. What do? I sell at market. So I'm short right here, right at this red line. Short right at this red line. My stops are somewhere above the, right above the, I guess the highs in this case of the mother bar. And now the market takes me for a wild ride. Hey, welcome, Vern. Just doing a little Monday Q&A. Mondays are typically the closed door session where we just chat whatever questions 12-week transformation members have, whatever is maybe bothering them, whatever they find a little difficult to learn. Perfect chance to bring it up in Monday's session, and we can dig into it a little bit in detail. Just talking about inside bar trading strategy today. Nothing that's in the 12-week transformation, but we're at a point where we just graduated a lot of traders. So the questions sort of dry up. People, the more people get it, the worse it makes for these Q&As. Isn't that something, right? The better job we do of teaching this stuff, the worse it makes for the Q&As. It's like, hey guys, you have any questions about structure? Nope, crystal clear. All right. Now Jimmy says, this would be more of a long-term investing. What kind of stop loss and range were you looking for? It wouldn't be long-term investing. More of a position trade. You're looking, you're probably carrying these trades for days. When I think investing, and I'm real particular with these words. When I think investing, I'm thinking you're taking personal stake in the company. Investing is more fundamental. So for some reason, if you get long euro, there's something fundamental that makes you want to be long euro for the long haul. And I'm talking months to years. So it's still trading because we're not, we're not picking a side. We're not saying, hey, I only want to get short or I only want to get long. We're taking it whichever it is, but it's more of a position trading strategy, something that you're going to hold for days, possibly weeks, just because it's on the daily chart. We never know. You can see this candle, 2 days we rally down. Sometimes it may be longer than that. The problem is here's the next step, right? And again, this is why it's a process. I think we can all agree that I just showed you guys. We just walked through and we saw what, 4 or 5 examples of how this works, right? Would you guys agree that this, at first glance, eye test again, this is something that probably just the entry technique seems like it would work? I mean, we can scroll through and find some more inside bars if we want. Here's one right here. Here's our high. Here's our low. Break and close above. Let's see if this wins. Nope. Here will be a loser right here. And you get one down here. Boom. Boom. You enter right here. Right back up and got a winner. So like anything, it doesn't work 100% of the time. But scrolling through examples, it looks like it works more than it doesn't work. Here's another example. Waiting for the break and close. We save ourselves from this false breakout down here. We're not filled on sell stops. We get a higher high, higher close. We would enter up here. Let's see if this wins. It goes up. So again, the eye test tells us that, we just looked at maybe like 6 examples. I think we saw, what, 1 or 2 losers in there? Pretty good, right? Now, the important question is, and this is the one that I haven't had time to dig into, stops and targets, right? Because there's 3 things you want to know. We always want to know entry, stops, and targets. I would say we know entries, right? We take the high of our mother bar, high or low of our mother bar. We wait for the break and close. We enter next bar market. So we're looking if-then thought process. If price action closes beyond our range, and we know that we define our range being the high and the close of the previous mother bar, then we enter next bar market. That's entries, right? Stops are easy, right? Stops, we can say, we know stops need to be below or beyond the high or low, the opposite high or low of the mother bar. And we can say 10 ticks, we can make it an ATR if you want. That's something we'd have to kind of dig into in the future. But I would be safe to say that you can probably put stops literally right below the lows of that mother bar. From what we've seen and what I've seen so far in the eye test, we don't often spike beyond. If we spike beyond there, we typically lose. So we got an idea for entries. We got a first rule for entry. We got our rule for stop. Now the issue is targets. How do we take targets? And this may not be, here's the tough part, this may not be a strategy where you get a consistent 1-to-1. Because we're waiting for that break and close, it's going to vary. So that's the next question. What do we do for targets? An original idea we had was we look for previous structure. However, that's not always the case, because look at this. Let's say we enter right here on our breakout. If we're shooting for previous structure, previous structure high is right here. Are we really looking for a target of this much and a stop of this much? Right? I don't think so. We got to win about 90% of the time if we get that. And structure is going to be in different places each time, so that can be kind of, the consistency is going to be a little hard. Charles says, if it were me, I would start with 1-to-1 stop placement and go from there. Dan says back test it 1-to-1 and 2-to-1 risk reward. What's another thing for you guys that have, and don't spoil this one. Don't give the answer, Charles. For you guys that have ever tested, I don't know if you guys have ever tested mechanical systems. What's a dynamic approach to taking another way we can think about taking targets? I like the 1-to-1 idea. What's another way? I'll give you a clue. We do it with our stop losses a lot, or you see me do it with my stop loss. Fib extension, nope, that's going to be tough because we're breakout, so we're not really going to have a place to draw fib extensions to consistently. Boom, there we go. ATR, ATR. A lot of the mechanical systems I used to trade, targets were based off ATR. We had one ATR, or one ATR, two ATR, three, four ATR targets, average true range. And what that is saying is, once we get the breakout, we're trading for an extension of a certain percentage of the average true range. So two things I would write down is, one thing to look for is a one-to-one measure move. That makes it really easy because we just have to be right more than 50% of the time. Another thing is ATR. So let's scroll through some more. And again, this is all the eye test, right? You guys follow me? This is still the eye test. This is still all the thought process that's going through our head, and we just click through. We don't track data. I want to get as much information as I can before I backtest, because I don't like backtesting. I don't like backtesting. What I hate more than backtesting is backtesting the same thing multiple times when I don't have to. So I want to have a pretty good idea of what I want to backtest before I do it. But let's look at it. Let's look at this inside bar right here. All right, we've got, again, these things come a lot, as you can see. And it could be filters like with overall trend, but here's an inside bar right here, mother bar. Here's our entry, right? Breakout to the high side. So if we're measuring one-to-one, we know our risk is right down here. I should probably not have a black chart here, but whatever. Here's our risk. If we're going one-to-one, that's a nice, simple way to do it. One-to-one, we're looking at targets being right up here. Looks like we just, oh no, look at that. Looks like we just hit targets on a one-to-one, right? Let's look for another example. Here's an inside bar going potentially to the short side. Again, looking at a mother bar right here, our inside bar right there. We're waiting for a break and close, either up or down. Let's scroll through. What do we get? What do we get? What do we get? Nothing, nothing, nothing. Boom. Break and close to the downside right here. Let's measure out our risk and reward. Looks like the same amount of risk right here. Here's our mother bar. Here's our potential reward. Should probably make this somewhat of a different color. See if we hit it. Boop, 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 boop. Did we? I don't know. Looks like we came very close and got stopped out. Maybe a few pips. And you just keep scrolling through and finding these examples. Here's another one right here. Inside, nope, that's not one. Take that back. Here goes one right here. Mother bar. Inside bar. Break and close to the upside. Risk is looking like this. One-to-one risk reward will put you up here. This one stopped out. So you go through, you test that one-to-one risk reward idea. Just by the eye test, I would go through, also test that ATR idea. Say, hey, what is the average true range on these candles? Forgot where my entry was at. Average true range on this candle was 132. So 132 is looking at a move from 114 to 115.32. Still wouldn't hit it on this one. And you just tested two different theories. Does one look to be working better than the other one? And then once you finish those tests, then I would go into the actual back testing. That's when I would finally break out the spreadsheet, go through the actual back testing, see what your win percentages are, see what your average win, your average loss is, and determine if this is something that is worth trading or not. Then for you guys that maybe are into other things, you could look to add filters. You could say, well, maybe I want to add a moving average. Maybe I want to add a 13-period moving average. And say I only trade the breakout if it's above the moving average. Or I only trade the breakout whether it's below the moving average. Maybe you want to add something like fib dots or parabolic SAR. Something that you can trail your stops. So as the market's going up, your stop isn't consistent. If you're trailing for, say, a big breakout, you're able to trail these things a little bit lower as they go. And you just do the same thing. You add those filters. You eye test it. You keep track of what looks to be working, keep track of what looks to not work, and you come up with that theory. And hopefully that theory ends up working. Dustin says, still not able to access. What's the password, Charles, for today? Do you know? Does anybody know? Oh, there you go. All right, so that's a little bit on inside bars. What questions did you guys have going into this week? I know a few of you are new. Let me know what you guys would like me to review. Hopefully we can I got 2 trades on today. I got still got the dollar CAD position on from last week. I got filled Aussie dollar too. We're just kind of in these consolidations. Aussie dollar is moving in the right direction. We had the big cipher pattern on Aussie dollar, and then dollar CAD we had the Gartley pattern. So running into structure though, which is a worrisome. But now, Charles, you said you traded this in the past. Did it ever work out for you, or just yeah? So did you get filled? Yeah. I'm long Aussie dollar. We actually spiked past pretty big. We had our orders were at 77.01. We had marched all the way down to 76.80s. Yeah, so I'm long that. You never know. This may not work either. This may not work either. I can tell you the breakout works. The target, that's the issue that needs to be tested. I can tell you when it breaks out from that mother bar, it goes in that direction. The question is how far. That's the part. The question is how far in that direction does it go? And does it go that way? Does it go that far enough times to make it worth it? I got a feeling there may be an inverse risk reward in some cases, which is okay. The cipher has an inverse risk reward as well, and that's a wonderfully working pattern. So Dan says I was waiting for the bat down below, didn't get filled. I see it in purple, 76.74. Yeah, I wasn't even that wasn't even a bad on my radar. I'll show you what I didn't like about it. This wasn't a bad that I was looking at. Didn't like the fact this B leg higher than this B leg. Constellation has it drawn out. You guys know I don't trade everything Constellation trades. Um, there's nothing wrong with trading everything Constellation trades. It's just not me. It's just not the man I am. Just not the man I am. Jimmy says, I noticed that descending wedge in the structure. I noticed the descending wedge in the structure with the cipher. I saw it later into the weekend. The confluence was overwhelming to me. Let's go to lower time frame. Maybe. That's good. If the confluence is overwhelming, that's a good thing. There's so many things popping out to you. You talking about this down here, Jimmy? Something like that. Yep. If the confluence is overwhelming, if you're getting, I mean, that's the whole point of the CTS system. We want to take trades where everything is lining up. We don't want to be the trader just to take trades just for the heck of it. Like, oh man, there's a nice looking wick. Let's take it. Or hey, a double top. Let's take it. Oh, I went broke pretty fast just trading double tops. It's very easy. Not all double tops are good. What's the point of a double top if it's not at structure? Nothing. Right? So we just don't want to take the double tops. We want to take the double tops that come at previous structure that are at the end of an ABCD pattern, which have a Fibonacci cluster on it and a bunch of RSI divergence, right? We want everything lining up in the table. We want, like Jimmy said, where everything is just overwhelming. Like, oh man, there's so much here. I mean, that's what that should be our mindset when we enter a trade, guys. We should look at a trade and say, man, there is so much here. I have to buy it. Have you guys ever seen a trade like that where there's so much there? You're like, I gotta buy this. Like, I'd be stupid not to buy this. That's how every trade should be. Every trade you see you should be looking around and being like, I can't believe price action is still here. Does no one else see this? Like, is this like, is price action really sitting here and giving me a chance to enter? Like, this is too good to be true. Jason always says it should be like, the market puts a bag of money on the table right in front of you and says, take me, come on, just take it. There's no better example than that. Those are the type of trades we should look for. And trades that aren't like that, we should just pass on. If it's not like that, we should say, I'll wait. I'll wait on it. There's no need to get involved in trades. We don't need a million trades. Great examples in the syndicate last week. We only took 8 trades between Jason and myself. 8 trades an entire week between 2 traders. Not a very active week. Didn't lose any money. That's a win. We actually gained some money. Shade mostly on Jason's side. I didn't do much last week. I was basically breaking. But yeah, those trades where everything is on the table, where it's overwhelming, those are the ones we want to make sure we're a part of. Of course, we want to make sure it fits our rules, but those are the ones that are special. Doesn't mean they're going to win. We never know if anybody's going to win or lose. There's so many factors to that, but we want to participate in them. I like that. The confluence was overwhelming. will you be doing the live room this week since you'll be in Alabama? I will be doing the live room tomorrow and partially on Wednesday. Tomorrow and partially on Wednesday. I could do it Thursday. I just really don't want to be honest with you guys. I've done it before on the road. It's just not the same. So the only time I'll typically plan on doing it on the road if I've missed like a lot of time. Like if I had to take this week off and then next week I was on the road again, I feel bad about taking 2 weeks off, but I'll just run a half week session this week. I'm not going to force anything on the road. So we'll do Tuesday. We'll do a short session on Wednesday. And then Thursday, Friday, we'll be on your own. If I find anything, I'll post it to the trade floor. But short week. Good old Alabama. Woohoo. Then we'll be back the week after that, and then we got then we're gonna be heading towards April soon. Technical Trader Workshop in April. The Death Week. So you guys have no more questions. We've got a quiet group. Telling you, Charles, that break and close above that break and close above makes a big difference. Look at this right here, another one. False breakout. Doesn't get filled. Higher high, higher close. Actually, you can even make it a little bit, that's going to be the same one. Higher high, higher close right here. To the moon. Look at that. Obviously, you can't catch all this, but I'm probably excited for no reason. But look at this thing. Guys, this is 500 pips right here. You notice this, right? You see this move right here? This is 500 pips. Let me say that again. This is 500 pips right here in 8 days. From this break and close above to this. 500 pips in 8 days. Just saying. Just saying. Charles says it's the break and close above. Yeah, the break and close above the high and low of the mother bar. So if this is something you want to take on as well, Charles, let me know. I told him I won't have any time to really test this aside from I won't have any time to test this until summer. I've got limited time now, and then we're doing the technical trader workshop, which I'm going to be completely dead from for about a month afterwards. Between that and we're going to have a flood of new 12-week transformation members come in. Yeah, the mother bar. Well, the mother bar bull or bear doesn't. The mother bar bull or bear doesn't determine direction. The only thing that determines the direction is the breakout. So when we get the mother bar, and if you guys are sick of hearing about this, I'm sorry, but no one else had any questions, so I'm going to talk about it. The mother bar doesn't matter if it's bullish or bearish, at least for right now. I'm sure there are filters that can be added in. All I'm worried about is bracketing it, bracketing. There you go. All I'm worried about is bracketing it, and then the break and close below. So this would be an example of a loser. And what you got to pay attention to, is is this a loser just because it's a loser, or is it something that, hey, our moving average is still green? Do we only want to take them? This is a what? We got a 9 period. Let's put a 13. Let's add a 21 period moving average. There's so many things that go. This is why creating systems takes so long, guys. You try to make it as good as you can. You only take it if the 13 is, you only take it in the direction of the moving average cross. So as the 21, as the 21 is below the 13, do you only take it in that direction? For you guys that maybe have Liberator as well, do you put on the Liberator volatility bands? Do you do something like this? Do you say only take it when it's a certain color? So many things you can add to this. So many things you can add to it. All right. There we go. We got some people flooding in late. Akil, are there times where we go, or times where we go on the Break to Jason's War Room and he mentions a few potential trades or trades that he took, and when we analyze it with you, it's a different story. I understand you guys have different trading style, but as a new trader, it's sometimes confusing. Obviously, I would have to see a specific example to tell you why, but yeah, it's just because we're two different traders. Now, most of the time, here's what you'll see. When you notice that, and again, the question is, sometimes when we take our break, we'll be looking at something in the live room saying, hey, I want to get long pound dollar. And then Jason will be talking about, hey, I'm short pound dollar in the war room, and we're getting two conflicting signals. Most of the time when that happens, Dan, it's because we're on different time frames. Most of the time, Jason is doing most of his trading off a 60-minute chart. So he's looking at the daily as his higher time frame. He's looking at a 60 for taking trades. I work down from my top-down analysis in a live room, but a lot of times we'll take trades on the lower time frame, say the 15 or the 5. Most of the time when you'll see that happen, it's because we're on different time trading. I'm on a day trading time frame. He's on a swing trading time frame. So he's looking bigger picture. I'm looking smaller picture. Now, there are times we'll have opposite opinions. But most of the time when you see that, it's because we're just looking at different time frame. So he's looking at something that is going to last longer than what I'm looking at. I'm looking for maybe a brief retracement. Say we got something like this. I'm looking for markets right here. Jason's looking to get short right here. On the lower time frames, I'm looking to get long in anticipation of that bigger structure move. So a little bit of both, but we are different. We are completely different traders. We're completely different people. With that being said, we see most of the stuff the same way if we're on the same time frame. Jason's a lot more aggressive than I am. Typically, I will wait for a little more confirmation than him. He's kind of just, hey, let's take it. I'm like, let's wait a little bit longer. But does that make sense? Yeah, most of the time it's just difference of time frame. And that's what I say. If you're going to be a day trader, guy, really what you see on the daily chart analysis really means nothing to you. I mean, we look at a candle like this. How big is this candle? This one candle right here in the daily chart, 106.50 to 108.23, almost a 200 pip candle. If we're a day trader, we're looking for what, 20 pips? Is it possible to get 20 pips bearish or bullish within this candle? Oh yeah. So the big picture really doesn't mean much at all. The big picture really doesn't mean much at all when you're a day trader. To be honest with you, if I were a day trader, I would care less what's happening on the daily or the 240 charts. It's not going to affect your trading at all. It's good to have a perspective just in general, but it really means nothing as far as your trading. To be honest with you, the 60-minute is going to be your higher time frame. Jimmy says, but yeah, Jason is more aggressive than me. And I'm sure he has a lot more experience than me. I'm sure I'll be there one day. I'll just get tired of waiting and be like, whatever, I'm so confident, let's just take it. I've already started. If I was a lot more conservative a couple of years ago. I could not take a trade unless it had a double top with the RSI oversold bought with divergence. And I missed a lot of trading opportunities because of it. So we tend to get more aggressive as we get better. Jimmy says, when there's a breakout of a wedge, flag, or pennant pattern, do you look for targets at structure? Yeah, either structure or Fibonacci extensions, depending on if there's structure or not. Sometimes there's just no structure, so either structure or Fibonacci extension. So if we get like a flag pattern like this, we get a flag like here. We can look for targets at either a retested structure right here, or bring in a Fibonacci extension, swing low to swing high of that flagpole, and look for targets, say right up here at a 127 or even a 1618. Of course, being aware of if there's any structure looking left as well. But structure is always my first, my trading philosophy is based on structure. So structure is always my first, the first place I look for. And again, I'm not a big trend continuation trader either, so I'm very non-aggressive with my targets. It may not seem like compared to what you guys are doing, I'm not aggressive at all with my targets. I want to get my money. I want to get my money off the table as quick as possible. With second targets, I'll tend to be more aggressive with second targets. First target, I want to get a little bit in my bank as quick as possible. Get in my wallet. Do you guys trade a lot of pennants and wedges and simple patterns like that? Or thinking about it? Another breakout, Charles. Another breakout, Charles. You get a loser right here. Here's a loser. Yeah. Here's the issue though. You get something like this. Actually, this one's not too bad. I would say when you lose, you lose pretty big, but this isn't that bad. This loser is only about loser. 125 pip loser. That's not bad for a daily chart. Look at that, another one. Inside bar. Inside bar. Sell it right here. All right. If you notice a pattern that you're filled on and then a flag, trend continuation pattern period, would you look for a graceful exit or wait to be stopped out? Once I'm in the pattern, all I care about is being in the pattern. I won't adjust anything. Once I'm involved in the pattern, it can wedge, triangle, flag, whatever. I won't adjust my trade at all. The only time I will adjust it is if a second pattern forms. This is rare, but if a second pattern forms within the pattern, and I'll typically adjust targets for that. So I don't even know how to draw an example of that. I guess if we had a Gartley like this, and we're looking something like that, right? Gartley pattern, and our targets are right. What here? Only time I would adjust is if maybe we, and I can't, it's hard to find an example. Maybe we set up something where a Gartley would be like right in here. Then I would adjust a little. That, I don't know, this is a bad example. But no, I won't. If I see a flag or a pennant, I just trade it how it is. I don't adjust. I value advanced patterns a lot higher than simple patterns. Do you notice those patterns a lot? I do notice those patterns a lot, so it does interest me if there is a heavy confluence with structure or advanced patterns. I still have to do back testing, forward testing to determine if they're valid to use. Um, I don't know. Um, I'll tell you this. I only trade them. I personally only trade them if they're at structure. Um, I'm not a flag or triangle trader. They're technically not in my trading plan. I can, if they come into structure, I can trade them in structure based trades. I don't just trade random flag patterns. So I won't do anything if I just see the market. If the market just comes up like this, I really don't care. Only time you'll see me trade them is if we had something like this. Say we get a breakout like that, and then we get a flag pattern that comes back into structure. Then I trade it as a structure-based trade, basically a trend continuation trade. But I don't trade them by themselves. I don't actively look for wedges and triangles and stuff like that. Only if they line up with a structural level that intrigued me to begin with. Doesn't mean it's bad. I see a lot of them that break out. I just don't. It's just not in my trading plan. Yeah, so don't. Not. I don't want to make it seem like it's a bad thing. They're just not my. I won't say not my cup of tea. I just don't have a plan to trade every single one. But if it lines up with structure, then we can make it work. But these things happen all over the place, especially when the market's trending. They happen all over the place. Anything else? Another one, Charles. 300 pips. Obviously, you wouldn't get all 300 pips, but anything else, gang? All over the place today, but that's the fun about Q&A sessions. Here's a loser. Nope. Yep. Here's a loser. Found the loser. Look for the. That's another thing, guys. Whenever you're back testing, look for the losers. Try to purposely look for losing trades. That's the best thing you can ever do. Look for losers. A lot of time, we only want to find what's going to make our system work. So we kind of turn a blind eye to losing trades. Look for losers. Try to find as many losers as you can. But if there's nothing else, we'll call it a day. you have any questions that you maybe were afraid to ask or didn't want to ask, shoot me an email. Feel free to. But you guys should be bringing questions to these Q&As. Again, they're different. Back the first round when we did 12-week transformation, we used these Monday sessions were training lessons. That's because we opened up the course 1 week at a time. They're not specifically training lessons anymore. It's an open course, so we have people signing up at all different times. We have people signing up during the bulk sales. We have people signing up last week, this week, 2 weeks ago. So everyone's at different spots in the course. So no longer are we dedicating a Monday to say, hey, today is trend continuation Monday. So it's up to you. It's up for you guys to bring questions during the week, saying, hey, I saw you do this during the week. You kind of went fast through it. Can you, can you recap it, or can you tell me why you did this? Or hey, had a question about pennant patterns. Saw that you took this one but didn't take that one. Can you talk a little bit about your filters? And those are the questions that you guys should be bringing. And feel free, either write them down and bring them on Monday, or feel free to shoot me an email to say, hey, Keel, I got something that I noticed you did today in the live room. Can you talk about it in more detail next Monday? I keep track of those things. So again, if you're getting everything perfectly fine, then that's good. It just means we're doing a good job here. But this is the time, aside from the live room, where you get kind of more of a personal one-on-one type of Q&A. So don't be shy about it. There's no such thing as a dumb question. So just bring it. Anyway, until next time, I'll see you guys tomorrow in the live room. Plan your trade your plan. Hopefully, I got you. You guys shouldn't be worried about this inside bar thing. You can see I'm pretty excited about it. Just thinks that I won't have time to really dig into it. But Charles has no life. He doesn't. He just sits around all day. So maybe he'll do it. But certainly something that looks like it could be okay. Like I said, the hardest thing would be getting those specific rules for targets, finding that right mix where you're getting enough out of it. You're not shortchanging yourself by missing out on the big moves, because you may need that. But you're also not getting too greedy that you're leaving a lot of profit on the table. But I will see you guys tomorrow in the room for some live trading. Hopefully dollar CAD and Euro Aussie pan out in our direction. And until next time, plan your trade your plan. Have a great rest of your day. Take care.
All right, good morning, traders. Can you guys see my screen and hear my voice okay? Yes. Good. Well, as you guys know, we have a brand new, we have a bunch of brand new people in here today for today's Q&A session. Just want to say welcome. This is something we do every Monday. This is a live Q&A session. It'll start around this time. Now, the live room typically starts an hour earlier. So Tuesday through Friday, we'll be starting the live room trading sessions at 8 o'clock. But on Mondays, we push it back a little bit because, well, it gives me some time and gives Charles some time to wake up. Typically Mondays, well, they were my off day before doing this, where I don't really trade on Mondays. I relax and look at them as being like a weekend. So I'll allow myself to get a little bit of extra sleep. Now, real important for you guys that are watching on the recording or that can't make it every week on this Monday live session, these things are posted each and every week. Go over to live sessions. There's two things you can click. If you actually, when you hover over the live sessions tab, you'll see a drop-down box that says Monday's Q&A. These are going to be really the Q&A sessions that we're doing now. So each Monday, this is going to be updated, or whenever Charles gets the recording up, it'll be updated and whatnot. However, if you click on the actual thing, the tab that says live sessions, you're going to be taken to a different page which has the live sessions of when we used to run the 12-week transformation a little differently. In the past, we would run it how, again, I would only open up a single module per week, meaning I would only, week one would only be reading a price chart. You wouldn't have access to week 2, week 3, none of that stuff. And each Monday was kind of like a training session, so it's a little different. Each Monday was week specific. Because we've changed the way we've done things to make it more on demand, knowing that you guys, you guys have said that you like it more when you have control over what you can learn. It's kind of open season. But my advice for going through the course, and I know that not all of you are going to follow this, but
I'm going to say to you. My advice is you take 1 week at a time. You guys that are brand new, you should be on module 1. The only thing you should worry about this week is week 1 reading a price chart. You shouldn't be worried about Fibonacci, double tops, double bottoms, any of that stuff. The best way to progress through this course is by taking it 1 week at a time. Everything is set up in a way that each topic builds on the last. And if you want to progress the best, take it 1 week at a time and really master that in 1 week. So before you go on to drawing Fibonacci's and ABCDs and cipher patterns, learn how to read a price chart. I got an email the other day from a trader asking me if something was a valid cipher, and it was wrong. And if you don't know how to measure an impulse leg, if you don't know how to identify a swing high, a swing low, and outside return, you're not going to be able to identify these advanced patterns. And you're going to be picking legs that are wrong. You're going to be entering patterns that are wrong. You're going to lose a lot of money not trading the right way. So trust me when I say, take your time, go through week 1, master that, meaning go through it on the weekend. This is the course that a lot of the successful traders that come through typically take. They watch the video on the weekend. They come to the Monday Q&A with whatever questions they have about the video, meaning they'll watch reading a price chart on Saturday, Sunday. Monday, they'll write down questions that they have. Monday, they'll come to the Q&A. They'll ask questions and clean up whatever whatever was missing. And then they take the rest of the week to simply work on it. And that means by themselves, taking a half an hour each day to scroll through charts, drawing new swing highs, new swing lows, stuff like that. In the live room, they don't worry about the Gartley patterns or the CTS trades or the double bottoms, double tops, all the fancy stuff we do in the live room. Because the live room is going to get pretty confusing, guys. It moves at a very fast pace, and I trade a lot of different techniques in there. So it's pretty fast moving. If you try to understand everything, you're going to get lost. So my advice for the live room is focus on whatever week you're on. If you're on week 1, ignore everything I say in the live room except for stuff that has to do with structure, price action, and how the market moves. What week are you on, Jason? What week are you on in the training? You're on week 7. The Gartley pattern. So going off what I just said, why are you worried about money management yet? Money management doesn't come until what? Module 3, I believe, at the very end. Week 12. You're on week 7. You should not be worried about money management yet. Now, when it gets time, when you get there, I can answer questions you have on money management. Yeah, I will do it. Yeah, I will do it. My Q&A session is on whatever you guys bring each week. So whatever questions you have each week, I will bring out. I will do a Q&A on it. We have different members all at different places. You're on week 7. We have a bunch on week 1. We have some on week 12. Yep. So whatever you want to talk about, I will address. Now, I would do this first. Make sure you do this. Make sure you watch the video on week 12 on money management. Make sure you go to live sessions. Make sure you watch all the Q&A on money management, live session week 10, and make sure you do all that stuff first. Now, again, it concerns me a little bit that you said you have. Now, you said you're on week 7, but you've already watched this stuff on week 10. Again, the best way to progress through this course is not by skipping around. But yeah, if you have a question, I'll answer it. But aside from that, welcome to the 12-week transformation, guys. I'm here to guide you on your journey. We have many alumni that are still on the trade floor. We have many members that are towards the end and towards the beginning. Jason's example, right in the middle of it. We have many that are towards the end of their journey. Take advantage of these traders. They have been through the grind already. They have been through the ups and downs. They have also been through the struggles of learning and learning the hard way. Many of them have skipped ahead and had to take a step back. So pick their minds, use them as a learning experience. Yeah, Danny's almost done. Yeah. It may start off rocky at first, but it comes together. And when it comes together, it's a beautiful thing. All right, Jason says, I'm honestly okay with patterns. Are you okay patterns? I've done 150 hours of back testing and counting. I just know the money management side will let me down if I don't master it, hence my question. Okay, so what is your question about money management? What would you like to know? And again, for any of you guys that are new, this is the open question part of today. So if there's anything that you had a question about, whether it be on week 1, whether it be on week 14, whether it be on just using the or navigating the software here or the trade floor, we can shoot them in. I just wanted to do that opening spiel to introduce you and hopefully guide you on the right way to progress through this course. But yeah, Jason, shoot your question. We can start with some questions on money management. I think I have my spreadsheet up already too. There we go. I don't know how we had a good weekend in Syndicate last week. I swear we got hammered, but it works. But well. No software available for Mac. Charles can answer that better than me. I don't think so. Most trading platforms aren't built for Mac in general. I know traders that use Mac computers, they often use like a parallel system where they're running Windows off of it. But I know the trade floor does not work for Mac. We are going to be to an all web or all desktop based deal. So it's going to be all web based. Jason's going to be introducing that, I believe, slowly over the next couple of weeks and months. He's got it built out, but we want to. Yeah, I'm not sure when. It's built out. It's not pretty yet, but it's beta version. So we gotta work through the bugs yet. So usually when we get something like that, and again, Charles may know better than me, but when we get something like that, we usually introduce it to say 100 traders at a time. That way we can work out the small bugs, and then we give it to bigger and bigger groups. And that's for, again, the syndicate, the trade floor you guys see here. This is all going to be going away. This is all going to be web-based. But it takes time. We build this stuff out ourselves. So we don't buy it from a third party or anything like that. So Charles said the new trade floor is beta version in the office, and we will release to a few traders at a time to work out the bugs. So it's coming. Just be patient. Again, the worst thing, especially in the syndicate, we've got over 2,000 members of there, and we've got about 2 people on staff. Basically, Charles, OG, and Darren will handle all the emails. So when you test something new and new stuff it's going to have bugs in it. And when you get 2,000 angry emails at the same time, it's not fun for anyone. But as Charles said, you can use Parallels or Fusion. You can also just run Boot Camp straight off of Windows for you guys that learn Macs. I'm glad Charles is in here. I'm not a computer person at all. So. All right, what's the shoot in the question, Jason? Is this the right one? This is the money management spreadsheet. I got so many of these. Many issues right now due to the fact that I was introduced to MetaTrader with a third-party overlay by a company in London. I'm moving to Ninja and I'm struggling with the actual functioning of NinjaTrader right now. So is functionality of Ninja? Okay, so what's the issue? What's the issue that you have with Ninja? Just getting used to it, getting past the learning curve, or what? And your problem was with the equity curve. You got to give me a question, Jason. You're not really. The delta slowdown multiple. Okay. The delta and slowdown multiple. The delta is going to basically tell you how aggressive and how non-aggressive your money management is going to be. Yeah, you're saying stuff, but you're not giving me any questions here. But yeah, that's why I say we explain everything pretty thoroughly in the video trainings. That's why I say make sure you watch those first. But the delta is essentially how aggressive you want to be in upping your position size. So if you have something like, and we can look at an example right here. Right now, this is based off a $5,000 delta. If I were to make this a $1,000 delta, which would be very, very aggressive, you can see that it would rapidly increase the position size. We're up to 3 already by week 3, and then we're back down to 2 after a losing week. 3, 5, 6, 7, 6, 7, 8, 9. So if you're having a really aggressive strategy and you really want to be aggressive with that money management, you want to have that delta as low as possible. Now, as you can see, there's ups and downs to that. After just 2 weeks of trading, you've already upped your position size, and look at this, bam, you've upped it just in time for a big drawdown. Well, now you're back down to 2. Now you're going from basically 3 to 5 in 1 week to 6 to 7, back to 6. So if you're now, luckily, we're pretty. This is our syndicate stats for the year. We're pretty consistent traders. We don't really go through big drawdowns. So if you're someone that has a minimum, maximum drawdown, meaning you're looking through your back testing numbers and over the hundreds and hundreds of trades that you back tested, you never really had a drawdown over, say, 10%. You can afford to use a very aggressive money management system because you know you're not going to give something back. However, if you're a trader that goes through big losing streaks, if you're a trader that goes through weeks that have 3% drawdowns, 5% drawdowns, realize that when you have a bigger position size, that bigger position size is for winning and losing weeks. So when you win, it's great because you're winning trading a 5 lot instead of a 2 lot. When you lose, you're also losing trading a 5 lot. So you're giving a lot back to the market. And you can very easily go from trading, again, trading a 2 lot and then bumping all the way, or trading a 5 lot, excuse me, and bumping all the way back down to a 2 lot because of one bad week. So your delta, of course, that's up to you. I would highly recommend you using a non-aggressive delta. The name of the game isn't about boosting that money as quick as possible. It's about survival. And the worst thing you can do is go backwards. The worst thing you can do is have 2 very, very good months of trading, up that position size, over aggressively up that position size, have 1 bad month, and then be back, back in the negative, back past where you started. A great example, say we come in here this week and we lose 200 pips. Right now we're at a 9 lot, right? Let's say we have a big losing month. Let's say we lose 200 pips in the month, or I guess this would be the week, but the week. I guess we already bumped up. Let's do that. Let's say we have a 2-week drawdown. We've bumped up. Now we're turning that 3% drawdown into a 12% drawdown. That 3% drawdown into 11% drawdown. And you catch that bad streak, you're going to go down very, very quickly. So again, the delta just controls how fast, or how aggressive, I should say, your money management is going to be. Does that help you out some, Jason? And the slowdown multiple, you don't need to really worry about the slowdown multiple. That's just the smoothing of it. But the delta is something you should be in control of. So you said your sound's been cutting in and out, but hopefully. Gretchen says, how about Robert's back question? Sure. Robert says, hey, Kill, I'm demo trading the back pattern on a 240 chart, euro dollar. Just want to know your thoughts on the trade. Well, let me ask you this, Robert. And again, you guys are gonna learn. I'm gonna be a little tougher on you in here than I was in not the 12-week transformation, the technical trader workshop. Just please understand it, because I want you guys to do well. In all honesty, I do care about every trader I work with in the technical trader workshop, but many of those guys are phonies. They're just, I shouldn't say phony, but they're not serious about trading. So I'm not gonna put out a lot of effort in making them good unless they want to get good themselves. With you guys, I am. So I'm going to be a little hard on you and just, it's nothing personal. I just want to see you be good. Now, the question is, what do I think about the bat pattern on the Euro-dollar 4-hour? Again, Robert, I'd like you to be more specific. What exactly do you mean by what do I think? My thoughts on the trade. Because again, my thoughts on the trade is, hey, it's a nice trade. It's that's like asking me, well, Akil, do you like the pound dollar? Oh yeah, I don't mind it. So try to be really specific with your questions. That way I can give you a real answer. Asking for my thoughts really doesn't tell me what to answer. So do you mean, do I think it's a valid bat pattern? Do I think it's a good trade for you to take? Let's add on to that. And that goes for anyone. It doesn't have to be Robert. It could be anyone else who wants to answer that or wants to ask that question. But I'll draw it out. We have our bat pattern looking like this. Let's just get rid of this. Put this crosshairs back on here. We got our bat pattern looking like this. We've got an X to A. We've got an A to B. We've got our B to C right here. We've got our C to D coming down to the 886. And again, traders on week 1 shouldn't even worry about this. None of your concern. You haven't got this far yet. And Jan says clear on the daily. Yeah, daily or 4-hour, either one, yeah. Sorry about that, Jason. I know you're having issues. But yeah, it's a valid bat pattern. Yes, it is valid. Yep. Again, what are the rules for our bat pattern say? We need a 50% retracement. For that B leg, we get that. C leg obviously is deep enough as long as we don't come past this our A leg, as long as the wick doesn't come above our A leg, we've got a valid C leg here. And then we're looking for a completion at that 886, so 105.29. So yep, this is 100% a valid pattern. Not the smoothest pattern in the world. It's not the easiest to identify, especially when you go out to the daily chart, it gets a little easier. This is a much bigger pattern. Again, if we pop out to a daily, it's going to be easier to see. But a valid pattern nonetheless. Gotta get my microphone back. Michael said, what do you recommend using for Mac boot camp or parallels? That's Charles. That looks like a question for you. But seriously, for you guys coming in, I wouldn't even worry about advanced patterns. Guys, just all you should be doing this week, and I know it's slow, I know it's boring, I know you're gonna hate me for saying this. All you should be doing this week, let me get the DSR levels off here. All you should be doing this week is scrunching up your chart and practicing measuring swing low to swing high, outside return, swing low to swing high, outside return, stuff like that. And for you guys that need a little help doing that, I always recommend doing everything manually. I got a good question from a guy this morning on my blog, was asking me about, hey, Keel, how come, I asked Darren in the Technical Trader Workshop, how come you don't publicly give out the cipher results or the cipher backtesting data? And I said, well, because so many of you traders would just shortcut it. Let me ask you this, guys. If I gave you all of the backtesting data I had in the cipher pattern, would you backtest it yourself? And I'll get to your question a little bit, Danny. Seriously, if I gave you every single piece of data I had on the cipher, all my backtesting results, would you backtest it yourself or would you just go out and trade it? Be honest. I wouldn't go back and backtest it. Why? Backtesting is horrible. I would just trade it myself. But when you do that, you learn nothing from it. You learn nothing about yourself. You learn nothing about your system. You don't really gain a belief in it. So I'm always a big fan of doing everything manual. So for you guys that are on the structure week, go through it, take your line to draw it out manually. Now, if you need help, there's a few indicators here on Ninja you can use to help. And I think every system, every trading platform should have this, whether you're using Ninja or not. One is going to be the swing indicator. Again, go to your indicator box. Go down to the swing indicator. Again, it doesn't just have to be Ninja. It could be every quality trading platform should have this. But go to your swing indicator. You can play around with the strength. I like doing 13. I like doing fib numbers, and I look for the bigger swings. But add that on, and that's going to help you out. You can see it's going to post little dots of where the most recent swings are, and that's going to help bring your eye to those swing highs and swing lows. You can see swing low to swing high, outside return, right? Orange to green, outside return. That's going to help a lot with just identifying what levels your eyes should be looking to. Another one is a zigzag indicator. I'm not a real big fan of the zigzag indicator at all. But I know a lot of traders that I've worked with in the past, they've said this has helped them as well. If you put on the zigzag indicator, and I'll have to zoom in a little bit. Again, this will actually give you, can you guys see that the blue line on my chart? I need to get this bigger. Give me a yes if you can see the blue line on my chart. Yeah. The zigzag indicator will actually draw this stuff out for you. Now again, you have to play around with the got to play around the parameters of it. And I'm not too familiar with the zigzag, so I'm not sure what would make it better or worse. I think O2, let's try that. Yeah, I'm not too familiar. Play around with it. This one will also draw lines on your chart to kind of make it a little easier for you to see the swing lows, the swing highs, outside returns, stuff like that. Again, I still recommend doing it manually, but if you're brand new, if you're really struggling identifying the stuff, the swing indicator, which is the dots here, is good, and also the zigzag is good for just getting used to seeing it. And I would work it in a way where maybe on day one you spend it with using the swing indicator to zigzag, and you slowly wean yourself off, or try drawing it on manually first and then using that as some type of confirmation. There's one more too. And again, I don't really like indicators, but just from traders in the past, they've told me about these. Where is this? The pivot point. What was it called? It was some pivot point, higher high, higher low. I don't remember the exact name for it. I might not have it on here. If I remember, I'll type it into the 12-week chat for you guys. It was something where it actually draws out the word higher high, higher low for you on here. But you guys should be doing it manually. But those are a few to help. Now, Danny's question. Danny said, Akil, I have a few questions about risk reward on patterns, but I feel we may confuse. No, you can feel free to ask them here, Danny. Again, this is an open Q&A. We're no longer running it 1 week at a time. This is the topic. It's open Q&A. So you have the same right to ask your question as everyone else does. So feel free. Plus, a lot of the newer traders, they haven't gotten to the point where they can really ask questions yet. They're kind of still wide-eyed, and it's pretty simple at this point. So hopefully it's making sense. But yeah, go ahead and shoot it in, Danny. All right, Danny says he's going to wait a while, so don't wait for me. What other questions do you guys have? Have you guys started going through charts and drawing out the ebbs and flows yet? Have you guys started taking your line tool and drawing swing highs and swing lows and physically writing them in? How many of you guys have done that? Robert says yes. Good. Vern, yes. Nah, Vern, you've been here for a while. Yeah, it doesn't matter what it doesn't matter what time frame you do it on. I would say the higher time frames, there's a lot less noise, as Jan wrote. When you get, I don't like minute charts. You go down like 5-minute charts, you'll get a lot more data, but there's a lot more noise there just because of news and impulsive reaction. So a good chart to do it on is daily 4-hour, but it's good. You need to train this skill, guys. You're gonna get so tired of me saying it, but you need to train it. It's the only way you're gonna bring your eyes to it. It's that reticular activating system. You've got to train it, and it stinks now, but eventually it's gonna pop out to you. And then when we get into stuff like trend continuation trades, and we get into stuff like advanced patterns, these impulse legs are gonna stick out to you. I practice on range bar charts when Ninja manages to load them up for me. Here's my advice with range bar charts. And for you guys that are unfamiliar, range bar charts are just a different type of chart. They look the same as bar charts, very similar to Renko charts, but they don't base price off of a time. So for example, if you're on a 15-minute chart, you're going to get a candle every 15 minutes. The range bar chart, if you're on say a 5 range bar chart, you're going to get a candle every time the market moves in a range of 5 pips. So if it goes 3 pips down and 2 pips up, that next pip up is going to create a new candle. And what it does is it gives a nice, it gives a much smoother look at price action because you don't really get the massive wicks and whatnot. So it gives a really good look at price action. The problem is you're unable to get a lot of data with it. So for you guys that are trading range bar charts, my advice is once you load it up, do not close that chart down. Do not close it down. Keep it up. As long as you keep it up, the data is kind of saved on there, and your Ninja will remember it. Once you close it down, it's got to do that whole grabbing the data process again. It just takes a long time to load up. So once you leave it up, or once you bring the data up, and you don't really need over, for trading wise, you don't really need over a few days. But once you bring it up, don't put it down. Gretchen says, I haven't gotten my links passwords, but still will start immediately. How'd you get in here, Gretchen? You haven't gotten links to what? To the website, Gretchen? Huh. Okay. I'm glad you can make it in here. Yeah, it's no rush, no rush. Okay, guys, we got 12 weeks. There's no need to rush through everything, to anything. Yeah, that's surprising. It also could be. I mean, guys, realize I know Darren. Darren was home. He had a family emergency on Friday, so I'm guessing he's a little behind with stuff. I know a few of you were asking about DSR indicators and whatnot. He's probably, if he's in the office, he's probably working that out today. I see Charles writing in. Hey, Akil, I'm new to the Talk Transformation. I have trouble. I'm having trouble deciding if it's still the trend or not when there are huge spikes in price. What does it matter in those cases? Well, here's the question. What do we know reverses a trend, guys? What do we need? If we have something like this, right? If we have something like this, what do we need to know to confirm this trend? Type it in, guys. What do we need to know to confirm this trend? Yep, we need a lower low, lower close. So if we get an instance like this, right? If we get a candle that comes all the way down here, if we get a long wick, and now it's kind of the question, the wick doesn't matter. We don't really care about that wick. We need to pay attention to where the candle closes. Do we close beneath previous structure? That's what's going to give us that confirmation of a trend continuation. So the wick may make the chart look a little choppy, but it's important we know what we're paying attention to. And in this case, it's the close of the candle is more important than the wick. For as far as structure identification goes. For trading, the wick can be very important. For you guys that saw the war room meeting this morning, Jason took a trade on what? Pound dollar 60 minute. Jason took a trade on pound dollar 60 minute where the wick can be very important. Again, one thing he was looking at was this. If I can, yeah. He's looking at the recent flow of the chart. We have our new structure low right here. We have our, technically we even have this if you want to chop it up some more, but we have our little consolidation right here. Boom, boom. We've got our lower low, lower close right here, correct? All right, give me a yes if you guys see this. We have our lower low, lower close right here at 175.58. Yes or no? Yes or no? Participate, come on. Oh, it'll help if I scrolled my thing down. There we go. We have our lower low, lower close right here. We then come back up to previous structure, right? Our previous structure highs are right here, right? This is our last outside return. We get to that level, we touch it, nothing happens. Market fights through it, wick goes above it, closes below. 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 Sorry about that, I got the headset mic on, so I'm knocking the wire on this thing. But so we can use these wicks as ways to enter trades by just knowing how to read it. But this still comes with the same principles of knowing that, well, it takes a higher high, higher close for us to know that we're looking for a bullish rotation in this case. And even though we test our outside return, as long as we don't get that close above that level, we're still thinking bearish. Jason says, any idea why my video is cutting out? Maybe try a different what do they call it? Try a different browser, Jason. Try Firefox or Google Chrome, or try a different browser. Sometimes that works. We have had the issue before. Yeah, and that's what I mean by entering next bar market after that confirmation. So if you were someone to say you were someone that was trading a trend and you wanted to get short. Let's see if I can find an example for you. Let's see if you want to get short here. You're a trend following trader. Now, I don't necessarily, this is not a trading style, so don't go off and trade this, guys, but just using an example. We can even use this right here. Say you're someone that's a trend following trader. You're a breakout trader, I should say. And you're saying, well, here's our new structure low. You're waiting for a confirmation of that trend to the downside. You're waiting, you don't get it there. Bang, right here you get your lower low, lower close. If you're someone that's going to enter next bar market, this will be your confirmation candle, right? The lower low, lower close. You would say as soon as the close of this candle happens, and it's very important we wait for the close. As soon as the close of this candle happens, then I'm entering the next bar market. So your entry would end up being right here as soon as it closes. And you'd be involved in this move to the downside. Now, again, I don't recommend trading this way. I recommend trading on the pullback, but just using it as an example of what I mean by next bar market. And market means the type of order. You know, there are limit orders where you do something like this, where you put a limit order down there, and it says once the market hits that order, then you're filled. There are stop orders where you do the same thing, where you can say, hey, once the market hits that order up there, I'm filled. At market orders mean you're buying the market right now where it's at. So right now, dollar CAD is at 125.86. At market means you're just getting involved. Boom, right now, I'm long, like that. Yeah, yeah. Waiting for the retracement is the right move. There's a breakout strategy you can use using a buy stop. It's not bad if you use the risk reward the correct way. I'm not a fan. I don't personally use it. I know Jason uses it. I don't personally use it. I'd rather wait for retracing, but I'm not a true trend. I'm not a breakout trader. I'm not a trend continuation trader per se. So I have different, I have different things I look for. But it's not necessarily a bad thing. Is this a cipher right here? I think we've got a cipher. Let's get onto the 5-minute chart real quick. I didn't forget about your question, Denny. I'll get to it. I just have that shiny thing syndrome where I see something. Look at that. I see something and I get my attention goes to it. Look at that cipher pattern right there. Dollar CAD. Right at 125.80. Probably a good amount of profit in here too. Look at that. 125.80. Nice little cipher there. Shoot this into the syndicate real quick. I won't be too detailed with it, but tell me something we stumbled across while doing some training. Bull cipher at, what were we at here? Bull cipher at 125.80. 125.79. Boom. Anyway, back to our regularly scheduled program. All right, let me get to Danny's question. I know Gretchen has one as well. I can find yours, Danny. All right, Danny says, after going through some videos on YouTube, I noticed you trail stops when you trade big patterns. To be honest, it's kind of threw me off since in my mind, I thought you never trail your stops unless you were very, very close to your target one. I did notice you base it on structure as well, but I just want to see the bigger picture. Yeah, I think you're under the wrong assumption that I never trail stops. I actively manage trades, correct? Yeah. Based on structure. If I have a chance to protect myself, I take every chance to protect myself as far as when trades are in progress. Now, most of the time you see that on structure-based trades. Pattern trades you typically don't get, unless they're pattern trades, you typically don't get a lot of time to trail stops because they just, the targets are so small. You're just looking for that 382 retracement. Nothing really happens, usually just shoots up to 382 or it fails on you. But every once in a while, if you're on a longer term pattern, you'll see it ebb and flow up just because it takes more time to get there. So say like a 4-hour pattern, you may see the market ebb and flow up because the pattern has to play out over days. Or a 5-minute pattern, you're either going to just get stopped out and roll down or roll up and hit targets, one or the other. But yeah, I don't trail stops based, when I trail stops, I don't do stuff like, hey, 10 pips below or anything like that. Everything is based off structure for me. You don't like to trade early morning at 2 a.m. No, I have no desire to wake up 2 a.m. I've tried that before. I know it's a very the London Open. The London Open 2 a.m. my time is the London Open, which is a great time to trade in the markets. It's probably, I would argue that it's the best time to trade the markets. The London session is beautiful. A lot of the movement in the markets come during that London session, especially after everyone's asleep during Asia. For my own health and personal enjoyment, I have no I have no intentions of waking up 2 o'clock. Then he says also the fact that you got stopped out of Euro Yen. Can you go over that, please? Yeah, Euro yen rolled over this morning, I believe. I don't have my data feed. I believe I got stopped out of Euro yen. Maybe I didn't. Maybe I should go check that. I assumed I did. Where were my stops at? Maybe I didn't get stopped out of Euro yen. Hold on. I'm pretty sure I did. I didn't connect my data's not up this morning on this computer, so let me just see where we at here. 8, 9. Yeah, 40, yeah. 26.47, yeah. Maybe I just missed it, but I should have been stopped out. My stops were down at 26.47. We had a what was this, Gartley pattern, bat pattern? We had this on Euro yen from Friday. What's the question though, Danny? Was it about trailing or anything, or? But yeah, 2 a.m. I'm not waking up 2 a.m. I did try that before with a certain system. I tried to wake up every 4 hours to check it, and it just did not work well. Yeah, ATR. Yep. Gretchen says, last week on day one, we were looking for double top. While second top form, a wick went higher than the first top. Does that second top now have to close higher than the recent wick, or just forget about the close above the wicks of the first top? In order to have a higher high, higher close, Gretchen? Yeah, and typically in those situations, you don't end up having any type of trade. But you're saying, Gretchen's saying we have something like this, the market comes up, we have a double top. So our initial highest high is right here. We put in a double top where the market does, the market does something like this. Let me know if this is right. Right, something like this happens. And you're asking, our next close, does it have to be higher than our original double top or our new structure high right here? Right, is that what you're asking, Gretchen? Which wick should we look at? Yeah, it would have to close above. This is going to be our new structure high because this is our new highest point. So it would have to be above this highest one. Because our structure high would go from right here to right here. See if I can find an example on a yeah. So here's a good example right here. Say we're looking at the market coming down, and we're saying that this is our new structure. Nope, it would be right here. This is our new structure low right here. Market comes down. You see ebbs and flows. New structure low, outside return. New structure low, outside return. We come down. We create a we create a new structure. Well, we create a lower low, but not a lower close. Correct? Before bouncing back up. If the market came back down to here, this would be our new structure low. Our new structure low would shift to this area. So this wick is now our lowest low. So we would have to break and close below that in order to have a new structure low. That's a very good question. Yeah, and Danny, here's the reason I didn't use an ATR stop based on this, excuse me, 113 stop based on this Euro Yen trade. Again, I have that personal rule where I can't have stops over 100 pips away. Our entry was up here, right? 37, something like that. Just see if I remember this. Our entry was somewhere at that level, 37. I think it was. See how my memory is. Yeah, it's right around 37. That 113 inversion stop would have put me above that 100 pip mark. Does that make sense? I got the feeling you're asking, how come you use ATR instead of the 113? Yeah. So I couldn't have it here at down here. That's going to be 125. So my ATR was about 40 something, which put me, I think it was like 42 at the time, which put me right down here. Within my 100 pip area, I'd like to be longer than that, but you know, I was still about a little bit away. And then I ended up actually exited on Friday and reopened it after the gap. So I got back in at a very lower point, and still got stopped out. So. Yep. I really thought getting back in, I got in at a lower level, and I thought that would make a big difference. I got back in at a little above the 127 level, because we were basically at break. I think we were up a little bit on after Friday. It wasn't enough to put my position at risk of gaps. So I exited and I re-entered Sunday. I just got back late Sunday. But anyway. Yeah. I got stopped. Yeah, it stinks, but again, that's the money management though. You know, I don't want to exceed that maximum risk per trade. I don't want to get in the habit of taking over 100 pip stop losses per trade, because that's gonna, well, that could potentially, if I catch a big drawdown, that's gonna leave me in a bad place that I don't want to be in. So same thing with the euro dollar. I haven't entered the euro dollar trade because it's too big. I have my eyes on it, waiting for a different opportunity to get involved. But the euro dollar trade, going back to the 4-hour we looked at earlier, it's just too big. We're looking at bring this up for you guys. Euro dollar. We're looking at an entry down at, it's more of a daily chart trade, entry down at 105.29. If we're using a 113 pip stop, I believe we're looking at almost 150 pip stop loss, if I remember correctly. Might have been more than that. Yeah, 141 pips, which I can't personally do. Darn rules. But we have rules for a reason, guy. We have rules for a reason. So I'm hoping to get a different opportunity down here. It would benefit me greatly if this thing kind of rolled down towards structure, because this would be a big difference if we can get down here. You see, I can get down to 70-something pips, but we'll see what the market gods have in store. Yeah, I don't know, Jason. Charles is our IT guy. Maybe he knows. I'm not good with computers at all. So I don't know. When I see upload speed of 30 and download speed of 30 and upload speed of 7, that's like French. I do know. I went to speedtest.com once. I know I have a lot. That's about all I know. But yeah, if aside from changing browsers, maybe shutting some stuff, maybe you have too much running in the background, maybe. Those are the only things I can think of. I mean, everyone else seems to be fine, so I know it's not on our end. So I don't know. Maybe shoot Charles an email. He can help you out some. I don't know. Are there any other questions you guys have? We typically try to keep this for about an hour. And again, if you don't have questions in the first week, that's fine. You come to a stage where, you know, everything seems simple, and it should be very, very simple, very, very easy the first couple weeks. But when we start adding on to stuff, that's usually when the questions start coming. When we get into the stuff like Danny was talking about ATR stops or trailing targets, or especially when we get to CTS or the double top, double bottom. Understand if you don't have questions, that's not a bad thing. Don't feel like you have to have questions. If you don't, it just means you're getting it. And if you do, that's not a bad thing either. My job here is to assist you with what questions you have. And at the perfect time to ask them is in the Monday's training, but also you guys have my email address. If you don't, it's akil@tradingpower.com. If you feel a little bit nervous about asking questions here or asking them in the live room, or if you're watching on the recording, of course, feel free to shoot me an email, and I check my email a few times a day and respond pretty quickly. Maybe not today. I feel like today's somewhat of an off day for me, so I'm going to go work on the garden and try to find some inner peace. I feel horrible after last week, guys. No offense to you, but the workshop takes a lot out of me, and then I worked all day Saturday and Sunday at a track meet, and I came back with neck spasms, which I usually get when I'm stressed out, and so I need a day for me. I haven't had an off day in a while, so this is going to be it. Yeah, it's fun. Typically, me and Jason split it. That's how we keep the stress under control. Just like Turning Point, where I'll do an hour session, and I'll take a break, and he'll do an hour session. This time was just me for 3 hours straight. I'm like, oh man. Yeah, take it again, Antonio. This is why it's on demand. So please take your time, guys. There is no benefit in rushing through the course. There's no correlation in whoever finishes the course fastest becomes a great trader the fastest. No, typically it's the opposite. Those who rush through it go out and trade live and blow accounts because they haven't had the time to really build on the psychology and everything else. Those who take their time for it and say, you know what, we had a great gal, Elaine, who just got through the course, and she said, she told me before the course, she said, Kiara, I've got it planned out. So no matter what happens, no matter how long it takes me to understand this course, I'm not going to trade a live count for at least a year. She said, if I get through the course and I feel good, I'm going to go demo, but no matter what happens, I'm not trading live for at least a year. So she already had it planned out. And I'm like, that's great, because she has no temptations. She's still trading demo right now. It's going well, and she's not rushing into things, and have that plan. Because the best thing you can do is trade live when you're ready and just go straight into making to consistently profitable trading, then rush to trade live and then kind of go backwards and go through the learning process, but losing money in the learning process. That learning process is going to come no matter what, and we might as well keep our money safe while we're going through it. So, but you're going to hear that from me every week, guys, so just get used to it. Just like Jason says, he hopes he's not that annoying guy. I'm going to be that annoying guy to you. And don't worry, Jason, I was that annoying guy when I went through my training course. Those are the ones I remember. So I'm pretty sure I'll remember you. I know I'll remember Danny. Oh man, can't wait till Danny's gone. I know I'll remember you guys when you're done. And that's good. When you guys, I hope you guys stay in contact. When you do, I'm not scratching my head like, well, who's this again? What year? I'm like, oh yeah, Danny, yeah. So it's good. Ah man, taking the course again. Yeah, keep a note of that, Charles. We're gonna not let Danny take the course again. We're gonna put him on that. We have a Trade Empower block list. We're gonna for people. We actually do have a block list for those who aren't allowed to partake in anything we do. Yeah, it's very hard to get on that block list, but like you cannot get emails, you cannot get into courses, to live training, and Darren's really good at that stuff. So stuff like fake email addresses doesn't work. We had one guy that tried to I'll leave you with this story. We had a free giveaway or something. No, it was the stupidest thing. We were doing a technical trader workshop, and we're saying, hey, whoever signs up like the most friends, I think we gave away a trading computer. And this one guy just, he tried to create like 100 different email addresses and just keep signing up and just trying to get over the system. And we caught him. And this is the funniest story. The guy tried to fight it. And Darren actually had Darren had a picture of this guy's porch. Let's just say that. And he mailed him a picture of this guy on his porch and said, hey, do you really want to go down this path? we'll leave it at that. I probably shouldn't get into any more details than that. But yeah, that was pretty impressive. The guy backed down. I mean, you can look at IP addresses and all that. You can find out when someone, I don't know, wasn't that serious. Yeah, Darren's like a super spy ninja type guy. He's don't mess with Darren or Jason. And now Charles is over there. So sure Charles has like 4 or 5 guns and destructive devices by now, just by just by affiliation. They probably signed a contract and gave him a gun. Oh, well, here's your first check and here's your pistol, Charles. Welcome to Trading Power. All right. Danny says, so we don't have access to the live room and trade floor after 12 week is over. No, I believe that's gone. You should still have access to the 12-week private chat, though, I believe, Danny. And typically what you can do is you get, once you're a training course member, you get stuff at a discount. I'm not sure if the syndicate's at a discount because it's so cheap anyway, but I know you get yeah, you get the course website there. I know you can get a discount if you want to stay in the live room or something like that. You may get a syndicate discount. I don't know. I don't deal with the money stuff. But you should still have access to the 12-week chat, so you can help mentor some of the younger members. We can subscribe to the live room though, right? That's how Keel earns his dollar. Yeah, you can. Well, you have live room. Live room's free with what you guys have right now. Yeah, you can subscribe with a live discount. Yeah, I don't. In full disclosure, I really don't make a lot of money off the live room. To be honest with you. live trading rooms aren't really big money makers, to be truthful. I do get a check off it. Don't get me wrong, I do get a check, but it's compared to other things, it's not. It's not really time for dollar. It wouldn't make sense if that was my main source of income. Let's put it like that. If the live room was my only way of earning income, say I wasn't trading or doing other teaching stuff, that wouldn't be enough to really do anything in life off of, for me at least. For me at this stage of my trading career, I should say. But yeah, I believe that's what we've done in the past, Danny. So I don't see why it should be any different. Typically, once you're a member of Trading Power, you'll get discounts for almost everything for life, as far as like training courses or live room stuff like that. But yeah, I encourage you staying there. It's great support. The last thing you want to do is it's a lot of eyes on the market. I really like having, and I consider you an intelligent trader, Danny. You bring some really good ideas to the table. That helps me a lot too, because I have an extra eye on the market that I can trust. So it's not like a random guy typing, "Hey, Gartley on gold," and I'm like, do I really want to waste time going there? I know if you type something in, it's legit. So it makes life easier for me too. And it really, yeah, I really want to turn this into a virtual prop firm, guys. That's why I like keeping these groups small. We don't let everyone into the 12-week transformation. I like keeping them small, and I really like isolating the good traders because I want to have a virtual prop firm. I want to have you guys stay in the live room and have it be a place where we still have newer traders in there, where we still have, traders that are looking to learn, looking over our shoulders. But I want to have a really core group of, say, 20 traders that are consistently profitable, that are good, and we can just rock the markets. That is my dream. Me and Jason do it in the syndicate. We've been making a killing. We did it with our mastermind group, but I'd like to have that on a daily basis in live room where, I don't have to watch a certain pair. I don't have to watch pound Aussie because I know Danny's looking at it and he can, whatever happens on pound Aussie, he'll let me know. I don't have to, Jason could be watching the euro dollar pair. I can be doing the teaching the younger traders while you guys are having ideas. We can look at them, review it, and make some money off of it, and all be happy. That's my dream, but it takes time. I've only been doing a live room for 3 years, so it takes time to build that, build that type of I don't even know what to call it, dedication, or build that type of environment, I guess. But people that come through that are successful, and people that stay in it, it helps a lot. So we'll see. But all right, guys, good Q&A today. We're going to be in the live room tomorrow, 8 o'clock New York time. So an hour earlier than what we started today. Again, for you guys that are new, just my advice is to sit back and just take it in. It's going to move fast. It's going to move fast. You're going to hear a lot of terminology that may not make sense. It's going to feel like, things are going 100 miles per hour. The learning curve takes about 1 to 2 weeks. So give yourself some time. And once you get familiar with the terminology, once you get once you get used to basically the process we run through every day, it gets very, very, it gets a lot easier to deal with. So until next time, plan your trade your plan. I'll see you guys tomorrow in the live room, and make sure you're out there training that RAS. Take care again. All right, good morning, traders. Welcome back to another week of fantastic experiences here with Trading Power. Just made it back just in time. Just grabbed a cup of coffee, kissed the baby, and got back just before the timer hit 0. So I'm off to a good start this weekend. But seriously, guys, welcome back. Charles says good morning to everyone as well. Great pictures over the weekend, Charles. Was that a zoo you went to visit? Where'd you go? I'm highly disappointed now. But nice pictures. I keep telling the wife as soon as our kid's old enough to get on a plane and not totally disrupt and annoy everyone, we gotta get out there to Kansas City and have like a, we're gonna put all the babies in one room. Jason and his soccer team and your kid, my kid, put them all in one room, and let's just get a man escape trip or something like that. We just leave and never come back. But great pictures. Welcome back, guys, to another week. Many of you, this was your first week being involved with us. What did you guys think? Was it what you expected? The markets and watching two professional traders trade live in the markets, was it everything you expected, or was it more? Was it less? Did it seem fast? Was it busy? Was it overwhelming? It was a pretty big week. It was a very busy week for Jason and myself. Again, we fired off about 21 trades throughout the week, trading ideas through the trade floor, which is the second most we've done all year. We had another week where we did 22, but it was a pretty active week, and I hope you guys, again, we did make some pretty good profit. We were able to increase our equity curve by about 4%, which is always good. We're on a heater this year, knock on wood. But I hope you guys see the ups and downs of it. That's the main goal. Because again, making money isn't hard. I'm going to be honest with you guys. Making money in trading isn't hard. It's basically just having a system. The hardest part, as you guys are finding out or have found out already, is trading that system day in and day out. That's the hardest part. And I just hope we were able to show that to you. I know Friday was a great example. We were up about 220 pips going into Friday. We're having a great week. This is good. Really, you just want to, keep the money and not screw anything up. And then Thursday night, wake up Friday morning, I see that 2 of my positions have been hammered by you London traders, and I'm like, come on, man. I'm gonna give it all back, and it wasn't all back, but it was. I had about 125 pips of losses, and it's like, you do all that work, the ups and downs, grinding it out. You do all that work to get a I'll try to bring up an equity curve for you guys. You do all that work to try and get a positive week, and then you start giving it back, and it's like on the last day, and I wrote in my trading recap, I think I wrote this, I'm not sure. It's kind of like, it's kind of like you're playing soccer, and your defense, your team is keeping a clean sheet, and then you give up a goal in extra time, and it's just heartbreaking. But you guys were also able to experience the fact that we traded through the plan on Friday, right? And what did we do? We had a monster day. We made back. We lost 100, or I lost 125 pips over London. I made 145 on Friday. So we made it right back, and we didn't do anything fancy. That's what I want you guys to see. We didn't do anything fancy to make it back. I didn't start, go into super aggressive mode and start taking aggressive trades. I didn't start doubling position sizes and adding positions. I just traded the plan. I traded the plan, and we were able to fight through and drag ourselves out of that drawdown. You can see this is our drawdown right here. This was Friday. Boom, 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 boom. Boom, 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 boom. And we came back from that, which is good. And that's again, those are the eye-opening moments in trading. Here, what are we doing so far? Look at this, Charles. I know you're impressed. Look at this is a pretty darn good looking equity curve, isn't it? Look at that. We got our bumps and bruises in here, but we're going in the right direction. This is pretty. Smooth that out a little bit. It's looking pretty good. But hope you guys are able to experience that. Yes, I did. Immediately. I'm not sure if you guys, some of you follow me on social media, some of you don't. I'll show you exactly. I got the perfect picture to explain how I felt after Friday's sessions. Many of you saw this already. I'll show it to you guys. This is my actual response. I transformed. Where's it at? There you go. Perfect. Yeah, this was me after Friday. Different face, but guys, the body is essentially the same. For you guys that were wondering, that's essentially what I look like. You know, aside from the face, maybe a little more muscles on there, but close. You know, close. But seriously, that's exactly how I felt. I love this picture. Like when you make a comeback like that, we try to take emotions out of. We do take emotions out of our trading decisions, but to make a comeback like that and end the week, it's boom. You just slam the microphone down and you go on to have a good day. So yeah, that is me for anyone that's wondering. I also found this morning. Here's a very good a share. A good friend of mine and a former client shared this with me on Twitter. He says, you want to know the difference between a master and a beginner? The master has failed more times than the beginner has even tried. So I want to share that with you guys as well. So what else do I have for you guys before we kickstart things? Off to a good week so far. Made about 96 pips on the Euro Yen. Let me show you this, guys, because here's what I did on Euro Yen. This can be potentially a very good lesson for you guys. Euro Yen, you guys remember we entered a bat pattern on, we entered on Friday or Thursday? Friday night we entered a bat pattern on Euro Yen? Or a deep Gartley 1 to 2? X to A to B. Looks like a bat pattern. X to A to B here. B to C, C to D right here. Do you guys remember this? Give me a yes if you remember this pattern or this trade. All right, and this trade essentially did nothing. We rallied almost down to targets at one point, about 13 pips away, and then we came all the way back up, which kind of hurt, to be honest with you, but we came all the way back up on Friday. And Friday we ended right here, basically break even. And a big question that many traders have is, Akil, what do I do over weekends? Do you guys have that dilemma? Do you hold trades over weekends? Do you take them off? Does anyone have that dilemma going on in their head? Give me a yes. Yep. And it's a difficult question because it's you don't want to hold. Well, you do. There is danger in holding trades over the weekends. Gaps can occur in the market if there's any type of big news that comes out over the weekend. It can gap the market, and the market can gap hundreds of pips, and it could be beneficial to you if it's in your direction. It can also be detrimental if it's not in your direction, and we never like putting ourselves in that crapshoot position. However, if you're a swing trader, many of the trades you take, you're going to have to hold over the weekend. But one thing I do is this, because I prefer not to hold trades over the weekend. So in this particular scenario, price action had came all the way back up to break even during our weekend gap. Here's our weekend gap right, what was it, right here? Right here. Price action that came all the way back up to break even. So what I did, and I brought this onto the trade floor, what I did was I just took the position off because there's no point. I posted euro dollar. What did I post euro dollar? Uh-oh. I was rushing last night. Maybe I did post it. I don't know. No, I put euro yen, Danny. Yeah, I posted euro. I posted euro yen. Yeah, I'm not going crazy. Yeah, it says euro yen. What I did though was I exited here, or maybe you meant on Friday. I posted. I exited right here at break even, because again, at break even, there's no real benefit of me holding this. And what I said was I will wait until the weekend is over, and once we get to open on Sunday or Sunday my time. Once I get the open on Sunday my time, we're going to see where price action's at, and I'm going to re-enter. So if there's no gap, which there typically are no gaps, I was going to enter just back at market, the same price that I exited at. If there was a gap, we'd see what happened. And what happened was during the weekend, price actually gapped from about right here at 128.50s all the way up to about 128.74s, giving me on my re-entry, giving me about 20 more pips of profit and 20 less pips of risk. So I re-entered on this trade. Typically, gaps are filled about, I don't know the percentage. I'm not going to give you a false one, but typically you see gaps get filled. We didn't close above our X leg. I don't even think we broke our X leg. So it was still a perfectly valid trade, and just re-entered again at a better mark and was able to make a little bit more profit out of it. And the same thing with the Aussie CAD trade. Aussie CAD trade had actually gapped past the cipher. I don't actually remember where it was at. Oh, here it goes. Aussie CAD had gapped past the cipher. We had a cipher pattern completion looking like this: X to A to B, B to C, C to D was somewhere up here. So our cipher pattern completion was at 95.39. The market opened up at 95.53. So again, you get a little bit of a better fill on here. So that's how I handled the gaps this weekend. But typically gaps do fill. So if you see gaps in the market, you can expect that they will fill. It doesn't mean that just because you see a gap, you want to enter a trade. You still want to have a reason for entry. So whether it be like this example in front of you where it's an advanced pattern, or whether it be a structure-based trade, you still want to have a reason for entry. You can't just make up a rule that says, oh, it's a gap, so I'm going to buy it automatically. Because you still have to have a place to put stops in. You still have to have a good risk reward. But don't be scared off of gaps. Again, when the market gaps up, typically we see a fill of that gap occur right after. Typically, you never know, but typically you do see that. Robert said, would you adjust your fibs if you get higher high, therefore adjusting targets? Yep, I always adjust my fib to the D leg. Always adjust your fib to the D leg. So my Fibonacci retracement, instead of my initial targets being right here, they had to move up to our D leg. Yep, even with the gaps, you always adjust them to that highest point. And I think that's why a lot of traders get in trouble. There's been a trader talking to me through email, and I feel bad. He's not a member of my training course. So I make a habit of I don't like to give advice to people that aren't a member of the training course. I think that's just fair for you guys, and it's fair for myself, so I don't get overwhelmed. And this guy's talking about, hey, patterns haven't been working and stuff like that, and he's kind of going. You see, he's mentally taking a hit with him, and I just think there's a lot of things he's doing wrong. But I just don't know. But I think this could be one of them. He could, maybe he's not adjusting targets. I don't know. But yeah, you always want to drag targets to that highest point, because anything other than that is not a real Fibonacci retracement. I mean, this is, if I just draw them right here, I mean, it's a Fibonacci retracement on my chart, but it's not really a retracement of any type of price action based move. Also, with your previous trade, would you enter if you missed the initial setup? Yeah. With the going back to the euro yen, yeah. It was 100% valid trade. There are going to be times in the market where maybe you wake up, or maybe you don't identify a pattern. Maybe you miss something and you log on to, say, the 12-week chat, and you see, hey, Mark has written in, euro yen Gartley pattern, a bat pattern, and you missed the original entry right here. But when you woke up or when you turned on your computer, price action was up here. as long as the trade is still valid, it's still. And to be honest with you guys, if you can get a better fill, guys, that's a good thing. Now you don't want to purposely wait for it. You always want to try and enter where the pattern completion is at. But sometimes you'll get lucky. Sometimes you'll be like, man, I didn't even see that. Price action has moved up 40 pips from the original entry. Guess what? You just saved yourself 40 pips of risk. If you've got a stop loss up in this area, where the person who originally entered right here to 886, they're looking at a stop loss of about that. Well, because you've entered late, guess what? You've almost cut your stop loss in half. So yeah, it's a good thing. But just make sure the pattern is valid. Again, these advanced patterns are valid as long as that X leg isn't penetrated. So as long as we don't pass that X leg, as long as, technically speaking, as long as the wick doesn't pass that X leg, it's still a valid pattern. Now, between me and you, if the wick passes it and you get a close below, that's still a very, very good sign. The pattern is technically invalid, but it's a good sign from a structure standpoint. But yeah, if you hop in late, that's not necessarily a bad thing. Again, don't do it on purpose. Try to hop in at the right moment, but every once in a while you'll hop in late. But going against that, Robert, if it's the other way around, if you hop in late before, then you may get yourself in trouble. Make sure you still measure out your risk reward, because if you hop in late, meaning the market has moved past the initial entry, now you're increasing your risk and you're minimizing your reward, and that's something you don't want to get in the habit of doing. Yep. When you take a pattern, do you look for additional confirmation once you see the pattern, or just take it? I look for just the pattern. I just take it. I am an aggressive trader with advanced patterns. So as soon as I see a pattern, what do I have on my radar? We'll just use this. As soon as I see a pattern, I put a limit order in. So the Euro Aussie has one. As soon as I see a pattern, I put a limit order in and I look to take it. It's not going to be a good example. Let's go the other way. But yeah, I don't need double top. I don't need RSI, any type of divergence. I just take it. Do you look for structure? No. And you don't really need structure for pattern, because here's the deal. Every pattern we have is going to contain structure. Every pattern we have is going to contain structure. If you look at the formation of a pattern, this is how a pattern forms, right? The market does some jazz beforehand, blah, 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 and then we get something like this, right? We get an X to A. Right? What does this X leg represent, guys? This X leg it's an initial structure high, right? And then the market does this. We get an X to A, A to B. We get a B to C, and then we get a D completion somewhere up in here. But remember, every time we have a pattern, aside from butterflies, the only one that we teach that doesn't complete up there, we have the X leg represents our structure level. And this is why we put stops above X, because we want stops above previous structure. So we don't need extra structure inside here. That X leg is going to be our structure level. And that's why it's so important we get stops above X all the time. Yeah. Again, the thing with advanced patterns are, relative to the rest of what you'll see in the market, they have a relatively high completion percentage, meaning most of this, if you're a structure trader, most of the stuff you get is going to be 50-50. Let's just be honest with you. You know, maybe a little more depending on how good you are. Advanced patterns, you're typically going to have a higher win percentage with them, just because there's more involved. So I don't think you want to. A lot of traders look for confirmation, where we'll say, okay, we have an advanced pattern, but I'll use a double top entry technique, or I'll wait for the RSI to be oversold. And what happens is, because these things often hit on a dime and roll over, you never get that chance for confirmation, and you can end up sabotaging your trading by waiting for confirmation and not just taking the trade. Now, that's something that I advise you test. I've never personally tested out how trading advanced patterns using a double top or a lower low, lower close, or needing RSI to be overbought. I never tested out using any filters on advanced patterns. So I can't tell you from a statistical point of view that one is better or one is worse. I can tell you from experience that you're going to miss a lot of setups waiting for confirmation. That just goes for in general for any strategy. You're going to miss a lot of setups waiting for confirmation. And with a strategy that's proven to have a high win percentage, you really don't want to get in the habit of hand picking which setups you trade and which one you don't trade. Rather, you want to trade every single one you can find, and you want to trade as many as you can find because you know over time it's going to bring in profit. But that's something that when you go through the back testing process, if that's something that's on your mind, I would certainly advise testing it out. There's no harm from it. If it works out better, then guess what? You saved yourself some pips. You found a less aggressive way to enter patterns. If it doesn't work out, well, no. Now you have an answer to your question. You're no longer thinking. You no longer have a pattern that fails, that does something like this, and you no longer have those thoughts in your head. Well, maybe if I would have if I would have waited for a double top, I wouldn't have taken the loss. And then this won't bother you as much. How do you combine this with the CTS system? Well, the CTS system involves advanced patterns, so you just give yourselves 3 points. However, what I would say is this: they're two completely different systems. So I wouldn't even look to combine them. There is a part in the CTS system that says advanced pattern. I typically don't worry about that, but they're two completely different strategies. Advanced pattern trading is 100% different from structured trading. So look at them as two separate systems, two separate strategies. Don't look to combine the two. Robert says, the only reason I ask is because I see many patterns and hard to know which are better than others. Yeah, that's the thing. We don't know. They're all the same. I wouldn't say any advanced pattern is better than another advanced pattern. A bat pattern is a bat pattern. I don't think one is better than the other. I don't think we need to look for one is better than the other. I think what's important is that we have a strategy that has a proven edge, a strategy that has proven to make money over time, and our job is to trade that strategy. So it's not like a CTS trade where you can say, well, a CTS 10 is better than a CTS 4. That's something we can quantify and say one is better than the other because we have that point system built up to tell us when we have more things lining up on the chart. And advanced patterns stand on their own. For me, a bullish bat pattern in a bull market is just as good as a bearish bat pattern in a bull market. Now, there may be differences what you can do with extended targets and whatnot, but I don't think one bat pattern is better than any other bat pattern. One may look better, you know. One may be a clean, nice, smooth one, and one may be a choppy one, but I don't think we can say one is better because they're all the same thing. Now, again, if you do decide to do the back testing and you test for something like only trading it when D is overbought or oversold, and you can come to a conclusion that it makes a difference, then you can start making statements like that, and you can start making, say, adjustments to your rules. But you've got to have those numbers first. And again, that's what I advise you guys do. I mean, you guys have a lot of questions, and you know, I'm not going to have the answers to all of them. But trading is going to be your journey. Trading is going to be your, you know, it's, you know, I think of it as like you're being dropped in the jungle and you're just looking to, you know, kind of find like the meaning of life. It's your journey. Make what you want out of it. Use this as an experience to grow. There's nothing bad that can come from testing. You gain knowledge. Nothing bad ever comes from testing. So when you guys have questions, you know, if I'm saying stuff like, hey, I don't think an RSI being overbought or oversold makes a difference, you don't need to immediately shoot that idea down just because I don't agree with it. You know, go out there and test it. See if it does. Answer that question for yourself. It'll be amazing what you can find. Again, a great example. Darren, when he found the decipher pattern, he wasn't even looking for it. Darren was looking for something else. And he found the cipher pattern on that journey. If that's not a great example of you know, just, you know, taking that journey and seeing what the market gives you, I don't know what is. Or you just see the NAC test, or I'm a little behind on the question. You just seen the back test numbers. You know you at the end you will come in. Yeah, that's what any strategy is, guys. Any strategy with an edge means that if we consistently trade the plan, we will make profit. You guys have seen so far that I'm a very confident trader. One of you guys said earlier that I keep my calm. It's because, guys, I know with full confidence that I'm going to make money at the end of the year. I have full confidence that I will turn profit at the end of the year. I have no doubt. How much profit? Now that can vary, but I have no doubt that I will turn profit at the end of the year. Why? Because I know my plan is profitable. I know my plan is successful. I've traded this plan for many, many years, and every year it has brought me profit. Now, what I don't know is on the micro level, trade by trade, I don't know which trades are going to win, which trades are going to lose. I don't know what days are going to be good, what days are going to be bad. I don't know what weeks are going to be good, what weeks are going to be bad. Months. I don't know that. But I know, big picture, I'm going to make profit. And that's what allows me to stay so calm. A great example Jason always uses, I cannot find a video to save my life, but we had an episode 2 years ago where I just got hammered in Gartley patterns. The first half of the year, probably the first 5 months of the year, Gartley patterns just were not doing me well. They were, maybe 50% completion ratio. They still made money, but they weren't working. In fact, maybe they lost money. I don't know. It was a bad year for Gartley's. And I remember crunching numbers. I did a weekend review video, and I was saying that, guys, Gartley's just aren't doing it for me. I may have to look into this at the end of the year. And it's important, I said, to the end of the year. I didn't make a rash decision right there and then to say, hey, I'm just going to stop trading Gartley's. They didn't work. And what I continued to trade Gartley patterns. I caught fire the second half of the year, and they ended up being very, very profitable. And that was a great example of, again, we don't know when the profit's going to come. But once again, it proved to me that if I do follow that plan, if I just keep trading them consistently, it will come. It will come. Akil, one of the things I do now, but I really think it's going to help me retain more profit, is instead of finding a reason to enter a trade, I find a reason not to enter the trade. In other words, I am more picky. I think that's excellent. That is something that I used to preach a lot. Find a reason why you shouldn't be in the trade. Because we can always find a reason to be in a trade. Look for reasons why you shouldn't be in the trade. If you can't find any reasons, that's a very good sign that you have a good trade setup. Yeah, I think that's good, Nanny. Jason says, so you trade every pattern you see. Yep, every pattern that meets my rules, I trade it. Whether I want to or whether I don't want to. And you guys will see many times in the live room, one of you guys will shoot me a pattern, be like, hey, Keel, Gartley pattern on Aussie dollar, bullish. And maybe my entire confirmation bias is bearish. And I'm like, oh, man. Yeah, I guess you're right. It is a Gartley. And I'm kind of wishing that, I'm kind of hoping it touches the 786. So I don't have to enter, but it's like, oh, man. All right, yeah, so I got to trade it. So I'm not happy about every pattern I trade. There are some that completely go against what I'm thinking in the market, where, we may have, I may be very bullish the euro dollar. And all my higher time frame analysis is saying get long, get long, get long. I don't do much fundamental analysis, but all the fundamentals are saying get long, get long, get long. And then I see a pattern that is short, and I'm like, But I still got to take it. But realize also with patterns, we're not looking for this. We're not looking for a reversal in the market. With a pattern, we're only looking for this. We're only looking for a brief retracement, a little bit of relief. So that's something that can help you out mentally. A pattern is a pattern is a pattern. Amen. Yep. You need to be very confident in your system and trading plan to follow the patterns, even when you are a losing streak, knowing the system will. Yep, you do. It's all about belief. You have to 100% buy into your system. It's no different for any of you guys that played sports where you're an athlete, you're a player, and the coach is preaching to you something, and you just have to buy in 100%. or you're part of a group team at work, and your boss is laying down the guidelines, and you have to buy in 100% to what he's preaching to you. You got to buy in. If there's any doubt in your mind, the market will exploit that. The market will find a way to make you lose money. Very manipulating. It will find a way, and if the market senses any type of doubt or fear, it will use that against you. And yes, I am talking about the market as if it is a living beast. It is. It is a living, breathing beast, guys. It's not just candles on your chart that exist. The market is a living, breathing beast, and it's out to get you. It feeds on the weak. It feeds on the weak. Akil, how long have you traded your current plan for? I've traded my plan continues to evolve. I've been a pattern trader since I started. I restarted my trading a lot of times, guys. I've blown some accounts in the past. I've been a pattern trader since I started trading with Trading Power, or since I went through the training course. I would say I've been trading patterns since 2011, 4 years. Now, during that time period, I've evolved. I started off just trading Gartley patterns. That was the only pattern I traded. Again, this is after I went through my phases of trend continuation and ABCD patterns and stuff like that. I only traded Gartley patterns, and I slowly just added different patterns. I added the BAT pattern. I added the cipher pattern. And over the last few years, I've gotten more and more into structure. So my philosophy is, you start with one strategy. You master that strategy, guys. Then once you master it and you're 100% confident in trading it, 100% confident in identifying it, then you add something else. So don't be that trader that goes out and wants to trade, 5 different advanced patterns and 4 different structure trading strategies at the same time. You're just going to overwhelm yourself. Trade one. Once you have mastered Gartley patterns, once you get bored and you're like, nah, this is too easy, then while you're trading and making money off of Gartley patterns, use that time to start backtesting BAT patterns or backtesting cipher patterns. And then once you master cipher pattern, then use that time to backtest the next pattern, and then just keep adding on if you choose. You don't have to. You can easily be a one strategy trader and make tons of money. You can increase your portfolio. But if you want to do different, different strategies, and partially I do it because I'm in education. I have a, I guess you could say, an obligation to know different ways to trade, because I work with different clients that have different, different needs. But for me, even if I wasn't doing that, I have a pure passion and interest for the market. So I like figuring out this puzzle. And structure trading to me is a lot more exciting than pattern trading. Patterns are really, really good. They're simple. I can fire. Hold on. I can fire on a pattern real quick. I'm break even on Aussie dollar. Darn it. Hold on real quick. That stinks. I forgot to set targets on there, so I didn't make any money off it. Mistake. Anyway, yes, I just have a pure interest for the market, so I'm always evolving. I'm always looking for different ways to trade, different ways to tweak my system. But start with one thing, and take your time. As you get better, then slowly start, adding more opportunities to you. Again, roll through these questions. Adam says, is there a point in 12-week transformation where we come up with a portfolio? Is that something we do on your own time? Yeah, we can talk about that, Adam. Yeah. Ultimately, you're going to have to come up with your own portfolio. There's no magical portfolio out there that I can say trade. But we can definitely, when it's time, we can definitely talk about how to determine what, how big my portfolio should be, what pairs should be in it. Do I want to diversify? Do I not want to diversify? Stuff like that. Yeah, that's certainly something we can go through. But that comes back testing is going to tell you a lot about that. When you back test, you're gonna have hard data that says, well, this strategy works better on this this pair than this pair, and you can kind of hand pick. Once you have an idea of how many pairs you want to trade, you can essentially hand pick the pairs that had the best results. A great example, if you're looking to trade cipher patterns and you plan on trading 4 pairs and you back test 8 of them, you can easily just pick the 4 that had the best results. That's the best way to do it, as long as it doesn't leave you overexposed. But yeah, we can definitely talk about that on the we will definitely talk about that on the way. Again, I'm sorry I'm late on questions, but you guys are typing in some pretty good ones, so I'm just scrolling through them. I've been looking at your pattern trades and been trying to find out your reasons why you take the pattern and whether you had an additional filters or not. Nope, I just take them. Nothing fancy. I take them. To be consistent, do you have to trade every day? What if you need to take a day off? That's a good one. You want to be consistent in your trading. That is something you want to do. Now, taking a day off here or there isn't going to hurt you. I got to take a day off. I'm not going to be here this Thursday, guys. So I got to take a day off this Thursday. It's not going to hurt you too much in the long run. However, if you're making it a habit, especially if you're a day trader or intraday trader, if you're making it a habit to take random days off, that is going to hurt your performance because you're missing opportunities. And every time you miss opportunities, you're getting away from that consistency. Now, if you're a swing trader, it's easier because you can place trades. You can take an hour out of your day, do your analysis, place as many trades as you want to do, and then go do what you want with your day. If you're a day trader or intraday trader, you have to be more active in the markets. So taking a day off you don't need to trade every day. I typically don't trade Mondays. I don't day trade on Mondays. But you do want to be consistent with your trading time frame. You don't want to just take random days off. You don't want to say, oh, well, I'm not going to trade today. No, I'm not going to trade tomorrow. I'm going to take this whole week off. That could come back to bite you in the butt, especially if you're a lower time frame trader. My problem is not making money, it's keeping money. And that's often the hardest problem. It's easy to win, it's also easier to lose. Does that not risk more than 20-30% of your account if you happen to spot a lot of patterns at one time? Do you have I think it's going back to the portfolio question. Yeah, I try not to put myself at any more than about a 35% risk at any given time. So if I were to take everything that I had on the table, I would put myself in a position where I wouldn't lose. Worst case scenario, I wouldn't lose more than 35% of my account. That's my max drawdown. I try to stick to is 35%. That's kind of the mark where it's like, okay, slow down, Akil, slow down. For beginner, is it better to day trade or swing trade? Either or. It's really more so what fits your schedule. What are you able to do? They both have its benefits. Day trading, you're dealing with a lot smaller risk levels. So mentally, it's easier to handle because you're getting stopped out for maybe 20-something pips, which is really nothing. On the negative side, though, day trading, the markets move extremely fast. So if you're not really on point with your pattern analysis or your price action analysis, you may miss a lot of trades. You may go into panic mode because it happens so quick. Swing trading, you're dealing with bigger risk levels. You're dealing with keeping trades for days, which can be torturous to some people. Seeing a trade, like the euro yen, seeing a trade bounce up 100 pips, bounce down 100 pips, and day after day after day, and staying in there. However, you also have a lot more time to do your analysis. You can be a swing trader. You can look at your chart. You can identify a pattern a week or so in advance, and it gives you that much more time to scroll through your plan and make sure you're doing it right. So there are pros and cons to each. I don't think one is better than the other. I think from a pure, if it's from a pure analysis standpoint, and we take psychology out of the question, I would say swing trading is probably a little easier just because you have more time to do the analysis. But either way, I always recommend do what fits your system, or do what fits your schedule. If you're someone that has a job, and you need to be active at that job, you probably don't want to be a day trader because you can't give it your full attention. So swing trading may work better, where you can come back and look at the charts every hour, every 2 hours, every 4 hours, and make a decision. If you have an open period of time to day trade, there's nothing wrong with day trading either. Day trading, you get a lot more reps, you get a lot more repetition, which allows you to build that RAS quicker and quicker. So you would stop placing limit orders once you get, yeah. Now here's the thing, I set up my portfolio, Jason, in a way where I'm not going to hit that 35% risk. Technically I could, but I set up my portfolio in a way where if I have my maximum loss on each pair, if I have a trade on each pair I take, and I calculate the potential for that maximum loss, I'm not going to hit that level. And that's why I don't trade. You guys, I don't trade massive position sizes. You guys don't see me trading 20 lots or anything like that, because it's going to allow me to reach that drawdown, that maximum allowable drawdown level, a lot quicker. Because I have such a large portfolio, I've got to decrease that position size to a level where it's not going to get me in trouble. Again, the big thing that happened to me, you guys remember my stories, I lost 30,000 in about a week because I was trading a big position size on a massive portfolio. I was trading a big position size on an 8-pair portfolio, and 6 trades got triggered at the same time. And I lost a lot of money. I don't want to go back there. So I trade about 11-pair portfolio right now. I can stretch it out to about, I think, 13. I think that's the max I can do. 13, 14, somewhere around there. But I trade a small enough position size where I can afford to get filled. This will never happen. That's what I shouldn't say. The likelihood of this happening is rare, but I set it up where I can take a position on all 11 of the trades, or the pairs I trade. I can get stopped out for my average loss on all of those trades at the same time, and really not dent my account. Does that make sense, guys? Here, let's put it like this. Let's say you go through your back testing, and your average loss is, let's just say, let's do 100 pips. Make it easy. 100 pips. If you know that your average loss is 100 pips, and you can do maximum loss as well. Let's do average loss, because typically you want to go off your averages. Your average loss is 100 pips. If you have a 10-pair portfolio, right, and you take 100 pip loss on each pair at the same time, you're down 1,000 pips, right? You take your average loss on each one at the exact same time, you're down 1,000 pips. You go calculate your position size. What type of position size would you need not to meet your maximum allowable drawdown? If you're trading $5 per pip, can you do $5 per pip with 1,000 pip? Why did I bring a calculator out for this? $5,000. Monday. Can you afford to lose $5,000 and still be within that maximum allowable drawdown of your total account size? If not, then maybe the most you can trade is 2, because now your maximum potential drawdown is $2,000. Make sense, guys? Calculating that worst case scenario, how does $2,000 affect you? And again, this is going to change with your portfolio size. If you have an 8-pair portfolio and not a 10-pair portfolio, you're looking at your maximum being 800 pips. If your average loss is 50 pips, now you're looking at 400 pips. Now 400 pips, you're looking at minus $800. Well, maybe that's not even a dent in your account. Well, maybe now, and you can keep adjusting. You go through that during the money management section, guys. So I don't want to get too deep into it because a lot of you guys are nowhere near there to begin with. That's kind of an idea of how you want to think of that worst case scenario, and just make sure you're setting yourself up where you're in a position where you won't blow your account. That's the goal. You don't want to blow your account. Jason says all the time, if you have a chip in a chair, as long as you have a chip in the chair, you're in the game, referring to poker. If you got some chips in the table, if you got a chair at the table, you can play the game. If you can play the game, you give yourself the potential to make some profit. If you don't have a chip, you don't have a seat at the table. Well, if you don't have a chip, you won't have a seat at the table. If you don't have a seat at the table, you have no opportunity to make profit. So it's all about risk management. You don't want to blow that account. You want to have enough where you can still enter a trade and you can always make that comeback. You can always turn your trading around and make up for those earlier losses. But if you lose everything, you're out. You're out of the game. Do you swing trade? Yeah. This Euro Yen right here is, most of the trades you see me shoot through the trade floor when I do syndicate videos, these are swing trading timeframes. 4 hour for me, 4 hour, 60-minute is swing trading for me. I actually started off as a swing trader. The only reason I day traded was because Jason asked me to run a live room. I was quite fine swing trading and playing golf all day. Well, trying to play golf all day. I'm not sure what I was doing is considered playing golf. I'd be all right for about 9. I'd have a good 9-hole run. But when it got bad, it got really bad. Really bad. How did you overcome your psychological traps? What techniques have you used? What I did was I just focused on process over outcome. I didn't focus on how much profit I can make or how much money needed to be earned. I focused on strictly just following the plan and not making mistakes. That was the main way I graded myself. How many mistakes did I make this week? And I'm a big believer in the Kaizen philosophy, which is continuous improvement. So try to get a little bit better each time. So I just said to myself, hey, Q, start keeping track of how many mistakes you're making. And, each month, my goal had nothing to do with trading, nothing to do with profit. My goal was to make one less mistake. So if it was January and I said, hey, in the month of January, I made 20 mistakes, then my only goal for February is to make 19. If I can make one less mistake, then I'm on the right path. If I made 19 in February, then my goal in March was to make 18. And I knew if I kept that up, I would eventually get to 0. Maybe not 0. I still make mistakes, but it would get, I made one today, but it would get really, really minimal, where I'm only making maybe 1 or 2 mistakes a month, something like that. And, with me right now, it's maybe 1 or 2 mistakes, every couple months. But it was really the process. It was really following the plan. And I valued that over the outcome. I didn't really care about pips anymore. I was at a point where I had just lost a lot of money, and I basically said I'm probably not gonna make it as a trader. I just don't have enough money to live life anymore without getting a second job. So I'm just gonna follow the plan and see what happens. And good things happen when you follow the plan. So if you trade 11 pairs and you have a swing trade and day trade on every pair, it's only 22%. Well, swing trading and day trading are completely different. Those are 2 different accounts and 2 different portfolios. Well, technically now they're the same portfolio because I kind of linked them together for you guys. They used to be 2 separate portfolios. It just got confusing in the live room. But there are 2 different type of accounts for that. I wouldn't combine your swing trading and your day trading if you don't have to. I would keep them separate. But if you're able, if you're, a lot of you guys are overseas, if you're able to place different trades on different, if you're able to do something like place a swing trade and a day trade on the same pair, we can't do this over here in the United States, but you guys can overseas, then yeah, you'd have to count that as basically doubling your portfolio. And you'd have to take that into account. You'd have to take in your average loss on your day trading pairs as well, and put that into the process. So it wouldn't necessarily be 22% because your average loss on your day trade isn't going to be 50 pips or 100 pips. It could be 30 pips, but you would have to take that into account if you're doing it both on the same account. You also probably don't want to be day trading 11 pairs. If you're risking 1% of your account on every trade, say I don't believe on one. I don't get into that. I just don't. That's not my way of doing it. I like to keep a consistent position size. I don't really get into the game of, well, if my stop loss on this trade is 50 pips away, well, that's only half of my maximum allowable drawdown, so I can double my position size. I don't get into that. I think that takes the consistency out of it. How do you track your maximum? How do you track your possible max exposure when you're trading 8 to 10 accounts? I don't see why you would trade 8 to 10 accounts, Mark. I don't. Why would you have 8 to 10 accounts? I think that's probably too much to have on on your own. Yeah, I don't. I get you would do the same thing and have. You would do the same thing and just have your, depending on the account size of each account, you'd have to calculate different your different maximum allowable drawdowns per each account. Yeah, I don't see why you'd be trading 8 to 10 accounts, but you just have to do it individually based on each account. So if you have a $5,000 account, you got to write down, hey, my position size is this, or my maximum allowable drawdown is this. If I have a $50,000 account, well, this account, I'm able to do this, and just keep them separate. And I would say print out something really, really big on your whiteboard and just make sure that you know exactly what you're trading on each account. Mark says, I'm asking about during a period of active trading, how to keep track of how much you're exposed. I don't think backtesting is possible during multi-pair trading. Yes, it is. If you're backtesting, you're going to have all the results for a specific time. You're going to have all the results on all the pairs that you trade during your backtesting. So as you go back to your backtesting, you're going to know each individual. You're going to know the results of each individual pair. You're going to know, hey, how did euro dollar do? What was my ending profit on euro dollar? What was my biggest win streak? What was my biggest losing streak? What was my maximum drawdown? Stuff like that. You're going to know that on each individual pair. When you create a portfolio is no different than just combining all of those individual pairs. So when you do the analysis, you just take your euro dollar, your euro yen, your pound dollar, whatever your dollar yen, whatever you're trading in that portfolio, you just put it all together and lump that into one result, and then redo the numbers based on that. But you'll have all the individual results from pair to pair, because you do back testing separately per pair. You guys should be doing it. You shouldn't be just back testing random pairs. You should be doing all your back testing on euro yen, all your back testing on pound yen, and keeping those separate in separate tabs if you have it, say, on a Excel spreadsheet. And then when it's time to create that portfolio, you have all the stats, and it's just putting the pieces together. Jason's laughing at me trying to play golf. Akil, do you have a demo account where you can quickly demonstrate how to place a ninja? Okay, yeah, I can do that. Let me just see if there's any other questions that I missed on here on the back testing or whatnot. I've noticed sometimes that you get to different patterns or even same patterns at different price levels. Do you take them both, even if the first fails? I noticed that you sometimes get to different patterns or even that you get to different patterns. I'm not quite sure what you're asking there, Rob. If you can maybe rephrase that a different way. I'm just not sure of the question. Can you explain how to have 2 accounts for different strat? Yeah, you just have to physically open 2 different accounts. So it can be with different brokers. You can have one account with FXCM. You can have another account with Gain Capital. Just you can have multiple. You got to get a multiple account license on Ninja. You can open different accounts on NinjaTrader. The multiple account license is gonna cost you a little bit more, but you can do it. For example, if you look at my, I've got a few accounts on here. So I would do it just like that. Are we going to discuss the online lesson? Yeah, if you want to, Gretchen. Yeah, this is free and open Q&A, so you guys can ask whatever you want. Again, it's when I first did the 12-week transformation, there was no such thing as open enrollment. So it was, hey, the transformation is starting today. You sign up today. If you miss it, you're gonna have to wait till next year. And what we did was I went through 1 week at a time. So I would go through week 1, because everyone in the transformation was on the same page. Since then, just because we've gotten it as a request, you guys like on demand. You like being able to work through things at your own pace. So now we have open enrollment where you can sign up at any time. So we have people like Danny who's in week 12. We've got a few of you that are in week 1. We got people in week 4. We got people all over the place. So everyone's at a different point in their training. So no longer is the Q&A or the Monday training session going to be dedicated to one specific training lesson, because different people are just at different places. That's why it's a Q&A. If you have a question about something you went over this week, you can feel free to ask it. A few people are on the money management right now. That's why they're asking questions about back testing and maximum exposure. But I'm here to answer whatever questions you have. So if it's a structured question, shoot it in. We'll go over something. If it's not, then I'll go over whatever you guys are asking. But it's no longer going to be one specific topic just because we don't run the course that way anymore. And Charles said we talk about multiple patterns on a chart. If we have multiple patterns on a chart at the same time, a lot of it depends on the situation. We had one on dollar yen the other way. If I can, I will take both. If it's an opportunity, for Rob's question. If I can, I will take both. If I can't, I will often take the first pattern that occurs, assuming the risk reward is okay, assuming the profit margin is fine, or I'll take the pattern with the most risk reward. Typically, I'll take the first one that occurs. Like I said, the only time I won't will be, like last week we had one in the dollar yen where there just weren't enough pips to be made, or if the risk reward is really, really bad. Typically, if I get something like a cipher and a bat, but they start at the same leg, I'll take the one with the better risk reward. But if it's 2 completely separate patterns, I'll take the one that completes first. If that helps you out, Rob. And then real quick, who was it? Jason asked a question. How do you place an order on NinjaTrader? 2 ways. You can just go over here. You can go to your chart trader, open this up at the top. It says chart trader. It's going to give you a little triangle over here. You go to your account. You make it whatever position size you want. You can right click right here. If you want a buy limit order, you put a buy limit order on. If you want a sell stop order, whatever order you want to put on, if you right click, it'll give you the option right here to put it on. So that's the chart trading way. Again, go to chart trader, open up your little side panel, right click, buy limit, sell stop like that. You can place it on your chart that way. You can also go to your control panel. You can also go to your control panel and do it manually from up here. So you can go to currency. You can enter euro dollar, and you can go limit order, quantity, price, and then do it from there. So whichever way whichever way you want to. But again, there's a lot of tutorials on Ninja, guys. Ninja does a great job at explaining everything. So make sure you go through those tutorials. Yeah, and Charles said the order type will change if you're above or below. If you're below, limit, sell, stop. If you're above, sell, limit, buy, stop. Yep. Does NinjaTrader have to stay running for you to execute, or can you turn off your computer? You're going to have to check with your broker. Most brokers, the orders will stay with them, so your Ninja does not have to be up. However, there are a few brokers where the orders stay on the platform and not. If it's one where it stays on the platform, your Ninja has to be up. So it's very important you check with your broker for that. Again, if it stays on the platform, if the broker leaves your orders on the platform and not with them, it has to be up or it won't get filled or triggered. And you can get into a lot of trouble doing that. I used to have a computer where that would happen and it would go into sleep mode and or restart due to some system cleaning or whatever it does every once in a while. And I'd wake up and maybe miss profit because, well, price action went through my level, but my computer shut down, so my Ninja wasn't up. So check with your broker for that. All right, we're about an hour so far, so we're gonna start wrapping things up. Can you use hidden diversions with double tops as confirmation? No, hidden divergence is for trend continuation. Regular divergence is for double tops and double bottoms. Still on module. You guys wait to the very end to ask these questions on module 1. Come on, guys. You couldn't have asked this in the beginning. Wait till we get an hour in. Now I got to rush through it. All right. Still on module 1, wondering how to identify minor and major structure levels. Well, a big help is your DSR levels. You could bring in your DSR levels and set the major and minor structure levels. I always set the major structure level to 4 times the time frame, the minor to 2 times. Typically, here's what I would do. Structure levels that are on daily, my higher time frame, so daily charts, those are going to be my major structure levels. So if I'm looking on Euro Yen daily, say I'm a 4-hour trader, structure levels like this, boom, boom. The major swings on my daily chart, these are going to be my major structure levels when I go down to my lower time frames. Structure levels on your trading time frame or your lower time frame, say like the 60-minute, these are going to be your minor structure levels. A good trick to also seeing major structure levels are where are places where the market hit multiple times. So if I were to move this up right to here, you guys can see looking left, market has hit this level 1, 2, 3, consolidated here for a 4th time, 5th time, 6th time. So drawing that, I always like using the line tool. You can do F6 if you're here on NinjaTrader, hitting F6 and just drawing that horizontal line out, and then just scrolling back and seeing how many times that price action hit this level. And if you can see that price action has hit this level numerous times, it should be a very important structure level. But typically, your major structure levels are going to come off your higher time frame. So if you're a 60-minute trader, again, it's going to be your daily or your 4-hour structure levels you see off those new structure lows and outside of returns. Those are going to be your major structure levels. Your minor structure levels are going to be stuff like this, the little hidden blips inside. And of course, if you're a day trader, your higher time frame is going to be 60 minutes. So then, what you see on the 60-minute chart is going to be your major structure level for your day trading time frames. Gretchen says trading outside returns week 2 PDF page 3. The ABCD pattern says it is a counter trend trade and to short at D, but we are in an uptrend. What if it turns into a 3 drives pattern? Seems like a very low probability trade. I'll tell you what, if it turns into a 3 drives pattern, you're probably going to make some money off of it. Remember, counter trend trading, here's what we're looking for. Here's an ABCD pattern. A to B, B to C, C to D, right? If it turns into a 3-drive pattern, we have to see a retracement, right? Retracement could come here, retracement could come here. We don't really know where that retracement is going to come to, but we have to see a retracement. You can easily have targets hit on that retracement. And if you're a counter trend trader, you're not looking for a full reversal, Gretchen. You're not expecting the market to fully reverse. Counter trend just means you're looking for a little bit relief. It's very important to realize that, guys. When we find counter trend trading opportunities, if the market is trending like this, right? If the market's trending like this, counter trend doesn't mean we're looking for a full reversal. That's not what we should be looking for at all. Counter trend just means we want to get a little bit, we just want to catch the outside return, right? All we want to do is catch the outside return, and the market can go on continuing whatever trend it wants to do. And we know how to identify outside returns, right? We know Fibonacci's, we also know look left, structure leaves clues. So it's important not to get greedy. We're looking for just a little bit, a little slice of the pie, and then we're out of the market. We're not expecting a full reversal. If you're expecting a big move, you're going to want to be a trend continuation trader where you hop on at the outside return and then you ride the trend up. Does that make sense, Gretchen? Counter trend is against the trend. We got to remember that. Yep. It's against the trend. All we're predicting is this, a little move. This is what we want. Even with patterns, right? Again, patterns are counter trend trades. X to A to B, B to C, C to D. With a pattern, all we're projecting is a 382 retracement. That's why our targets are there, right? If we expected a full move, I'd have targets down here every time, right? All we're expecting is this. This is all we expect. It's not a full reversal. That's why I'm not a big fan on trailing profits or trailing targets and whatnot on these advanced patterns. All we're looking for is a little blip. I want the market to move a little bit before it comes back up. This is all I want, guys. This is all I want. Now, there are times where we can expect maybe something like this, and that has to do with our overall analysis, but all I want is this. All I want is this little bit of blip. And that's for any counter trend trading opportunity, even double tops. We come up here, we get a double top, boom, boom, boom. All I expect from a double top is this. I want a little move back to the 382. And market can do whatever it wants. We're like, I don't want to call it snipers, but we're just again, we're like mercenaries. We come in, we're like smart thieves, let's say that. We come in, we don't need to rob the whole bank. We don't need to rob a whole bank. We pick a few safe deposit boxes. We get enough and we get out before we're caught. You try to rob the whole bank, you're usually going to get burnt. Cops are going to get you. Can you physically show us how to crunch your charts from the 30-day to 1 hour? I wouldn't use a 30-day, but you just enter just 60. It takes you down to the 60-minute chart. Enter whatever number you want. You want 4 hour, enter 240 here, and it takes you to the 4 hour chart. And yeah, for you guys, don't be Gretchen and I forgot who else asked it. If you have questions about the module, try to ask those right away. Ask those in the beginning, or shoot me an email over the weekend saying, "Hey, Keel, this is what I'd like to go over on Monday." That way we can spend more time on it. Again, I like to keep these things to an hour just because I have to do something later in the day. But yeah, feel free to shoot me an email saying, "Hey, Keel, can we talk about ABCD patterns and whatnot?" And that way I can turn it into a lesson. I can make the first half of this into a lesson looking at that first and foremost. Yeah, so feel free. Yeah, don't be scared. Again, these are different than it was in the past. Shoot me those questions. We can look at it. But does that make sense about the ABCD pattern? Is that good, or let me know. I'd like to shut things down, but if it wasn't clear, I'll do it. setting up a fib inversion,
Yep.
all you're doing is this. Same Fibonacci extension, except you're going backwards. Typically, you would do something like this. For a Fibonacci extension, you would go, say, from swing low to swing high like that and back up. For a Fibonacci inversion, it's the same thing. However, you're going from the previous move. So you're going from your swing low to swing high. But instead of the most current move like this, you're going to the previous move like that. But same settings for the Fibonacci. Same 127, same 1618. Robert says, I think most of us are in week 1. A lot of you guys are. We had a big group coming after the Technical Trader Workshop, but not all of you. And that goes for people watching the recording as well. We have people, again, on week 12. We have people week 5, week 10. There are people all over the place. But again, if you guys have something you want to ask and you want to make sure I go over it, shoot me that email or shoot me a message through the trade floor saying, hey, Keel, here was my concern for this week. I didn't get a chance to, one guy asked me a question about impulse legs for patterns. I didn't get a chance. Sorry, I think it was Kevin. I'll email you back later today, Kev. I didn't have a chance to go over it today. We had a fiery day. Sometimes these Mondays are pretty low key, but today they were pretty active. Good, yeah. Yeah, I have no problem answering questions, guys. It makes Monday fun. What happens is typically when people get to the ending weeks, they know everything already, and they're just in the point where they need support. So we come into these Monday Q&As, and it's like, hey, what do you guys have questions about? I know everything, Akil. I just need to continue training myself. So, all right, we're done for today, guys. We're a little bit over what I wanted to do, but good session. We kept it active all the way through. Some pretty good questions. We did a little bit about structure, did a little bit about money management and setting up that portfolio for you guys that are later on in the training. I will see you guys tomorrow in 12-week transformation. If you guys have any questions I didn't get to, just feel free to shoot me an email. Shoot it to akil@tradingpower.com. I check it a few times a day, and I'm pretty active at responding to you guys, so feel free to shoot me that. I did go over to Trade on Ninja. Yeah, it's Jason. Just go watch the help videos. Yeah, watch the record. Just watch. Everything is explained on the Ninja help videos. It's pretty simple. Again, it's basically if you can right click a button and buy. But just go over to help videos. They explain everything. They make it very simple. So until next time, guys, plan your trade, trade your plan. I'll see you guys tomorrow in the live room.